The top names in business are on Bloomberg.
Technology has a big role to play in healthcare in multiple ways, and we're very heavily invested in that. The whole interface between tech, AI, biopharma is a very interesting space. Much of the healthcare industry, particularly if you look at the UK, you look at the US as analog, it's actually quite staggering. Stuff is on paper still, and forget AI. I need a basic technology adoption.
Nobody covers business like Bloomberg.
One minute remaining. I'll be leading with US housing starts number.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
10 seconds.
It was the way an August week should be. Essentially pretty calm, if anything, very positive and happy. Everyone getting ready for a 2-weeker before they head back.
One spot 238 million, one spot 238 million, lower than forecast, one spot 333 million. Building permits, one spot 396 million, one spot 396 million, lower than forecast, one spot 425 million. Canadian manufacturing sales minus 2.1%, minus 2.1%, which is higher than forecast, minus 2.6%.
With us here, Bloomberg economics and policy correspondent. What do we got?
Bad news on a housing standpoint, because housing starts fall by 6.8%. The forecast was for a 1.5% decline. Last month, they grew by 3%. Building permits also down by 4% after a 3.9% gain in June. The forecast was for 2%. So it looks like at this point that builders are not confident in their ability to either sell these houses or to get them built. If you look at the charts for the number of houses under construction, they've come way down at a time when they're having trouble finding construction workers. So that may be part of it. But also affordability is difficult, and it's just not a good housing situation. And I know Anne-Marie's all over this. This is more of a political issue at the moment than even an economic issue.
So we have posted out the Canadian manufacturing sales July reports and the housing starts US July reports on the feed for anyone interested.
That has no affordability or no entry point into the housing market. Just quickly, actually, the response in markets is notable. You're seeing some of the declines extend in the equity market ahead of the in bond markets. You see yields go even lower. It does seem like maybe on a quiet summer Friday, people are just trading on anything, and if it's a slight bit negative, you get the sort of knee-jerk, bad for stocks and good for bonds. It does raise this question, though, Mike, about how much of this really does reflect a housing market that is stuck in two very difficult places. On one hand, you have the idea that it is getting more costly and difficult to build houses and less optimism there. On the other, affordability is really low considering how high rates are and the inflexibility of people to actually move.
Yeah, the Fed is going to be lowering interest rates, and that will help with mortgage rates, but mortgage rates won't go down to the 2s anymore or the 3s. Mortgage people did a survey this week that said people aren't really going to start refinancing or taking out new mortgages till we get to 5 or below. So that'll take a little while. And then the primary issue is we don't have enough houses. There aren't enough houses to buy, and there aren't enough houses being built. And so from a political standpoint, the candidates want to talk about ways to get more houses built. That's going to be the major issue.
Well, it's one of these things of how is this cycle different from other cycles? And previously, when mortgage rates came down, you did see housing prices come down because there was enough supply and people could get to them. Of course, the supply picture isn't there. And realistically, how do you do that at a time when housing builders don't want to build houses because they're not sure the demand is going to be there?
It is difficult. They know the demand is going to be there. I think it's a question of when the demand is there. And if the builders don't want to be stuck with inventory, that they had to work off. They did that for the last couple of years because they went into the COVID era building a lot of houses, and then all of a sudden people wanted to move, and they built more houses, and then people stopped moving because COVID kind of went away. And now we're at a situation where there's, in a couple of years, a lot of property coming online. Not enough, but a lot coming online. And around the country, not in New York City, but around the country, that depresses prices.
With the sentiment yesterday being downbeat in the housing market and the data today, is it surprising? Because everyone is expecting the Fed to cut rates. Shouldn't it be moving in a better direction?
Well, you could argue that, but at this point, people aren't seeing it. I mean, rates have come down quite a bit. We're in, 6.5, down from 7, and still moving
people
lower.
Are refinancing.
And there is a slight move towards refinancing, but there aren't a lot of people who have rates that are that high that they can refinance. And what we're basically living through here in terms of affordability is the consequences of having low rates for so long. Mortgage rates went down so far that everybody refinanced or got new mortgages at very, very low rates. And why do you want to move? And that clogs up the housing market.
Michael McKee, stay close. Thank you so much for being with us, and we will be with you in ample time next week at that Fed symposium. I'm so pleased to say, joining us now, former Labor Department Chief Economist Betsy Stevenson, also a Bloomberg Opinion columnist. Betsy, wonderful to see you. Thank you for being with us. We're going to get into what we can expect for Jackson Hole next week, but before we go there, I'd love your reaction to some of the housing conundrum that is increasingly percolating itself into policy proposals, putting aside what's actually been proposed, which a lot of people said is not going to see the light of day. What do you think is an appropriate policy reaction to try to create a more even playing field in the housing market?
I think that there are a couple of things that really need to be done. And so you can actually listen today when Kamala Harris gives her speech about housing, whether she addresses these. But one of the things we have to do is just get housing built faster. And that's going to mean cutting through some of the red tape. Everybody really wants to make sure that only certain kinds of housing goes up around them. All of this not in my backyard type policy. And you have communities that really slow down the process of building housing. We want to, we really need to speed that up. We need to make it easier and cheaper. And we're also, we need to make sure that there are the incentives in the system for building affordable housing. And so we're looking for making sure that there are policies in place that are really trying to put their thumb on the scale to give builders the incentive to want to build something that is affordable. And then the third thing I think we really are going to have to address is what I call mortgage portability. We have people locked in to mortgages that are under 4%. We're not going to see that again for a long time. And they're stuck in their houses. They're baby boomers stuck in big houses that need to downsize, but they can't afford to downsize because they'd give up a really affordable mortgage. What we could do is make it so they could take their mortgage to the next house to try to get rid of some of this mortgage lock. Because if we don't do something to address the mortgage lock, I think we're going to be stuck with that for quite some time.
Wow, this was something that was actually done in the 1980s in a certain way to allow people to have some portability. Is this something that you're actually hearing anything concrete about?
Stocks Europe 600 index pairing gains, trading little change now.
Not something I'm hearing concretely coming from any of the campaigns. I think what you'll hear more about from Vice President Harris are ways to incentivize the building of more housing and making sure that housing isn't becoming more of an investment commodity by big corporations that buy up lots of housing and push the prices up. That's one of the concerns you've seen out of the whole Biden-Harris administration is the corporatization of certain sectors and how that affects affordability for everyday Americans. But the end of the day, I think what you just asked about, what do we do about mortgages? I think that's got to be part of it because the Fed is not going to cut rates enough that you're going to be able to go back to those locked in mortgages. Have with a 30-year mortgage locked under 3%, I don't want to go anywhere. I don't need to go anywhere, but I know people who really should downsize, and they've done the math, and they literally pay more to buy a house that it costs, half as much because of how it would change their mortgage rate. I do think that's a policy issue that I'd really like to see addressed by by Vice President Harris at some point.
Betsy, to your point, though, that's not the conversation right now. The conversation, or at least the proposal that we're likely to hear today, is give $25,000 to 1.4 million new homeowners and try to get 3 million, incentivized via taxes, 3 million new homes to come onto the market. I know the likelihood of that actually coming to fruition is one conversation, but I want you to just take that proposal at face value. How successful will that be at achieving some of the things that you're talking about without creating distortions in the market?
You know, there's a lot of families that don't have the seed money, the down payment necessary to make a purchase. And it's become harder to come up with that down payment because you're just spending your 20s and 30s paying your student loan debt. And then you might want to have kids. And then you've got the very, very high cost of early childhood education, of daycare. When and how are you supposed to save up to be able to put a down payment down? So I think she wants to address that problem. Of course, what economists would say is, well, wait a minute, if we hand out more money to a housing market with pretty fixed supply, do you know who gets that money? The people who own the houses. And so you have to, if you're going to do a policy like that, it's absolutely essential that it gets paired with expanding the supply. Otherwise, literally all the money just gets captured by the people who already own the housing. So I do think that there are some reasonable policies in there to try to expand the supply of housing. I agree with you to say, like, look, you've got to get all this stuff passed. You've got to get the tax credits being proposed passed. You've got to get some of the red tape that's being proposed being actually cut. And some of that red tape is not at the federal level. Most of it is actually at the local level. So how do we get local communities to do that? I will tell you that New Zealand had one of the highest housing price crises, I think. And it's very confusing. New Zealand, they got plenty of land. Why are their houses so expensive? And what they did was they cut the red tape, cut it substantially, and they saw housing prices actually come down. So it is possible to do it. Building more housing is always the answer. It always works. The question is, can we actually get those incentives into the system, passed into law, and make sure that we get the expansion that's necessary to to actually get what they're claiming we'll get, which is more housing and therefore cheaper housing.
Betsy, the Biden-Harris world want to be viewed as the competent camp, although their proposals, people are saying, are pie in the sky, and frankly, some of them wouldn't even work, like price gouging. Then why aren't they talking about things that you're talking about, like cutting red tape?
So, first of all, I think they are talking about cutting red tape. And, junk fees was a big issue for the Biden administration. And I think that was one that was particularly close to Vice President Harris's heart. And, that's not government red tape, but that's a different form of red tape, right? We're all confused about the prices because somewhere in, some fine print beneath what you're buying, it says, oh, by the way, it's actually another $40 for this hotel room because we didn't tell you about this extra fee, or for this flight, or for all sorts of things. So I think they understand that Americans want simplicity, and simplicity requires cutting red tape. It requires eliminating junk fees. It requires making sure that that the market's operating fairly. On price gouging, when I first saw that, I'm like, oh, okay, yeah, we all roll our eyes and say, oh, we can't fix prices. But at the same time, telling businesses that they need to slow their roll and they don't need to be jumping prices by large amounts at a time, that's not necessarily going to be bad. And I think particularly with the limits on rent increases, it makes a lot of sense. If you're sitting there and you get a notice that says your rent's going up 50% in a month or 2 months, you might not have a plan. You might literally find yourself on the street because how do you come up with that kind of money that quickly? So making sure that, no one needs to raise rent that fast. We have a lot of forward looking. We're watching here. Right now, we're learning all about the economy. We can form expectations about what's coming, and we can make a good plan that allows there to be slow price increases. Price gouging has always been against the law. And I think what you're hearing is, can we do a better job of enforcing it? But I will agree with you that there are trade-offs, right? When we say, no, if you're a hardware store with shovels stocked and a big snowstorm's coming in and you triple the price of those shovels, you'll get it, but it's a jerk move. And at the same time, what might happen is somebody who decides, maybe I want a second shovel in case one of my kids wants to help out, buys the shovel because the prices didn't go up, and then their neighbor doesn't get any. Right. So those are the trade-offs, right? And what they're saying is, I think we've leaned a little bit too hard on the price gouging end, and let's try to get some balance back in this market.
Former Labor Department Chief Economist Betsy Stevenson, thank you so much for taking the time. We really appreciate it. So that's the policy and the potential kind of ramifications. Really important to get a sense of where we are now in terms of the economic strength, especially heading into Jackson Hole next week. Joining us now, Ed Yardeni of Yardeni Research. And Ed, I just want to start there. I mean, there are a lot of proposals for how to make things better and to bring down inflation. How much is the Fed going to respond to the weaker side of things, or how much is the Fed going to respond to the strength and the resilience in sort of not needing them to have to cut too far?
Well, between now and the next meeting in September, we're going to get an employment number. And I think that employment report that we will get in early September, and that'll be for August, will reverse some of the weakness that we saw in July, which I think was to a large extent weather related. And if that's the case, that'll be one reason for the Fed not to do 50, but to do 25 basis point cut in the federal funds rate. In addition, we'll get a couple more inflation numbers between now and that meeting, and they should continue to confirm that inflation has moderated. So I think it all points out to 25 basis points, not some of the hysterical talk about needing 50 to 75 basis points, which we saw last week.
And why can't I make the argument, though, that going at 50 makes sense because we're so far away from the neutral rate that just doing 50 means that you just get closer to that. It's not something like an emergency cut, but it's just to get back to not being so restrictive.
Yeah. Well, I'm not a big fan of the neutral rate because it's a fantasy. Nobody knows exactly what it is. You can't measure it. You can't see it. There are people who use statistical models to try to estimate it, and it always seems to be changing. I think at the end of the day, we just have to see how the economy is actually responding to where interest rates actually are. And I think the Fed has actually normalized interest rates where they are currently. The economy is performing fine. There are clearly pockets of weakness in the economy. I call them rolling recessions. But overall, the economy has grown by over 2%. In the second quarter, on a year-over-year basis, it grew by over 3%, which is kind of a normal growth rate for the economy. So why mess with success? The big risk in lowering interest rates aggressively is that you get a stock market melt up. And the consequences of that is we then might be following it with a stock market meltdown. And I don't think we need to have those kind of excessive moves in the financial markets triggered by the Fed being a little bit trigger happy in terms of lowering interest rates.
Ed, if they do a cut and it's a big one, say 50 basis points, would that not signal to the market, though, potentially the Fed knows something, the market does not, and actually the economic conditions are deteriorating faster than people are expecting?
Yeah, absolutely. And by the way, it was only a week ago that there was all this talk about needing 50 to 75 basis points. If the Fed actually had on an emergency basis lowered interest rates, that would have worsened the crisis, because a lot of that was the unwinding of the carry trade that was going on a global basis when the yen was too strong. So if we lower our interest rates by more than necessary, and meanwhile the Japanese economy is looking pretty strong, and they go back to raising rates, we're going to get another carry trade unwind, which was pretty scary last week. So I think these central bankers have to be careful with the power that they have.
And I got to say, you are the one who really coined roaring 20s. You've been bullish on U.S. equities for a long time. Your biggest flaw just hasn't been maybe being bullish enough in terms of having to upgrade your forecast. So now the question is, do I hear a sense of change from you, that you're getting more cautious now ahead of a sort of, I don't know, threading a needle that seems like it's maybe not being threaded in the right way?
No, a few weeks ago, I raised my number for the S&P 500 from 5,400 to 5,800 by the end of the year. I still feel pretty comfortable with that. I just don't want to see us significantly exceed that, because I think that's melt up kind of territory. Already valuation multiples are really quite high. But honestly, we've achieved a lot of what I expected we'd achieve this year. I wouldn't mind if things just kind of simmer down a little bit. And I think they will. I think, we still have a presidential election up ahead here. We still have a lot of geopolitical risk, though oil prices are down a lot this morning. But I think by year end, we'll have another solid rally that'll probably take us up to 5,800, new record high.
Do you think, Ed, that we could see that 5,800 target achieved even with bond markets selling off in akin to basically what you're calling for, which would just be one rate cut? Currently, it's much more getting priced in.
Well, that's right. But I think the trade-off is going to be that the reason for the bond yield coming down of late, and at least until recently, the weakness in the stock market was a perception the economy was weak. I think we're going to see that the economy is actually doing just fine in coming weeks. So I don't really have a problem with the bond market continuing to be somewhere between 3.5% and 4% for a while. But I think the economy can withstand 4.5%.
Ed Yardeni of Yardeni Research. Always wonderful to speak with you. Thank you so much.
Thank you.
Have a wonderful weekend. Up next, setting you up for the week ahead, this is Bloomberg.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of I'm going to go get on and do it. It also gives me courage, because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice, saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. Go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
Today's CFOs focus on much more than just revenues and margins. Their impact goes far beyond the balance sheet.
The world is coming at us faster than it ever has. Our first job is to intimately understand and anticipate the consumer's needs.
You need to identify opportunities.
It's an incredibly fun job.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. New episode September 11th, only on Bloomberg. Brought to you by Workday.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
There, counting you down to the opening bell for the last trading day of the week. Here is the trading diary for the day and week ahead. At 10 a.m., we'll get University of Michigan sentiment. And around 1 p.m., Fed speak from Chicago's Goolsbee, who was speaking earlier this morning with NPR. At 2:45, Kamala Harris delivering campaign remarks focusing on her economic agenda. We will bring that to you on Monday. This is when it all begins for the Democratic National Convention in Chicago. President Biden set to deliver an opening speech on Tuesday. Earnings from Lowe's and Toll Brothers. Wednesday, we'll get Target, Macy's, and TJX earnings before the opening bell. And Fed minutes coming out at 2 p.m. Thursday, the Jackson Hole Economic Symposium kicks off, plus another round of jobless claims. It's a lot to get through. S&P U.S. PMIs also on Friday. Fed Chair Jay Powell delivering those key remarks. Danny, in that panoply of potential events, what are you most focused on?
It has to be Jackson Hole. And the thing I'm most interested in is not necessarily what Powell says, but what everyone else around him says. Because we've started to see this coalescing of FOMC committee members who are saying the time is right, that the risk is not going soon enough. The risk is waiting too late. And I say it's most interesting to hear everybody because of the conversation we had with Steve Rasciuto earlier this week, that because it's September, because we're heading into an election, they can't be seen as political in delivering a cut. And in order to not seem political, they need to have everybody in agreement that now is the time to cut.
I guess that Jackson Hole probably is what you're watching too, Anne-Marie?
No, I'm going to be in Chicago at the DNC, although I'll have one eye potentially on Jackson Hole to see what Jay Powell says. Because to Danny's point, it really is going to be potentially, through the eyes of some, they're going to look at this through a political lens, whether or not they go 25, 50, or cut at all when it comes in September, especially from the Republicans. We've already heard that from the former President Donald Trump, that they shouldn't cut ahead of an election. When it comes to the DNC, for me, it's really what happens after the DNC. Of course, there's going to be a tremendous amount of excitement and momentum at the DNC as they basically coronate Kamala Harris as the Democratic candidate, hopeful for them that they want her to be president. But what happens after? We actually have to see her sit down across from a journalist, not at rallies, and answer questions and details about these policies that they're throwing out.
All I can say is, and please forgive my skepticism, I hate saying this, but at what point can we take any policies, either from the Harris camp or the Trump camp, as anything serious, if none of them are going to see the light of day and all of them are trying to pander to a particular constituent?
Well, I think you have to take what Darryl said pretty seriously, which is that fiscal policy is going to expand whether or not we have a Republican or Democrat. What they spend on, what they prioritize is going to be different, but also that will only matter when we know what the composition of Congress is going to be. And then also tariffs. Regardless of who wins, some level of tariffs will be in play.
Which raises a question about bond market volatility. To me, this is what I'm watching. How volatile are bond markets? Because all of these events disproportionately affect bonds than they do stocks. How much are we looking, Danny, at an asset class that has a volatility that has traditionally been the haven, stable, steady as she goes type of securities?
And how especially vulnerable are we that we all just loaded back up into bonds? The JP Morgan survey showed the most net long on the Treasury market for the year so far. What happens when we maybe start to believe some of these policy agendas saying there is going to be a lot of spending, and does below 4% on a 10-year make sense?
Coming up on Monday, Lori Calvasina of RBC, Kelsey Barrow of JP Morgan, Jim Caron of Morgan Stanley, and Mike Schumacher of Wells Fargo. Have a wonderful weekend. We'll see you next week. This was Bloomberg Surveillance.
Huge upsets on day 4 at the Cincinnati Open. Defending champion Coco Gauff is packing her bags after she went out to Yulia Putintseva in the second round. The American was far from her best on center court after losing the opening set 6-4. Gauff leveled the match but collapsed at the end of the deciding set. And don't forget, Tennis Channel's live coverage from Cincinnati hits the air daily at 11 a.m. Eastern.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
A tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
Yeah, I think that it would be irresponsible for us to ignore the AI revolution. I think that as much as there is a lot of short-term hype, I think long-term it has the potential to be transformative. And so we are spending a lot of time thinking about what elements of it are structurally have barriers to entry. And so there is a winner-take-all element to that and which don't. And it seems to me that things like chips, things like infrastructure and systems has a little bit of that, because NVIDIA is so far ahead, it's expensive to catch up. There's, you know, the technology that it requires to build these chips are sort of based in Taiwan. What we're seeing is that some of the apps and some of the applications, there are no barriers to entry, right? Like, it's fairly easy to come up with, and I don't mean to belittle the complexity of it, but there are not moats around those things like they used to. So I think that there is less of a winner-take-all in that space. You're going to have to earn that spot, whereas it'll be fun to watch what happens. And I think there's going to be a lot of money burned in the process because somebody will develop something and a fast follower will come along and make it better and cheaper because data gets cheaper and more pervasive, and it's going to be easy for new players to come in and do interesting things. So I think we wait and we see.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry, and one that
the effective Fed fund rate unchanged at 5.33% for August 15th.
That other companies, how they use it and how they use large language models, and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Stocks have turned around to the downside. 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak is off today. Bloomberg Open Interest starts right now.
Coming up, stocks are on course for their best week of the year, but a weak reading on the housing market is derailing the rally. Also, caution from Austin Goolsbee, the Chicago Fed president, says the labor market and some leading indicators on the economy are flashing warning signs. Amid all of this, the yen carry trade is staging a comeback. ATFX has seen a 30 to 40% rise in yen shorts in the past week. Let's take a look at where markets are trading at the moment. In terms of futures right now, we do see down arrows. That turnaround happened after we got the housing starts number and building permits, both disappointing compared to the expectation. We see S&P futures down 0.5%, NASDAQ futures off 0.5% as well. And investors are pushing down the yield on the 2-year, still above 4% at 4.03, 4.04. Katie?
All right, if you take a look under the hood here, we do have some pre-market moves to talk about. We start with H&R Block posting better than expected results and raising its quarterly dividend by nearly 28%. That's not enough to lift the stock pre-market. Shares currently down about 0.9%. You also have Applied Materials out with earnings, meeting analyst estimates, but in the red, as you can see, after issuing a disappointing fourth quarter outlook. We're also, of course, keeping a look at NVIDIA. Shares this week jumping double digits, flirting with the biggest weekly advance since May of last year. That certainly helped to lift up the broader index altogether, Matt.
All right, let's take a look at what's going on in terms of the economic statistics this morning. We got on EcoGo, on your Bloomberg terminal, look at housing starts, a little bit disappointing, building permits a little bit disappointing as well, and maybe the problem is that this feeds negatively into the economy in terms of investment. A little bit later, in just about an hour's time, we're going to get University of Michigan consumer sentiment and the inflation expectations. We'll be paying close attention to that, and so will our first guest. Invesco Chief Global Market Strategist Christina Hooper joins us here on set. Christina, great to have you here. These markets are reacting in, I think, maybe an oversized way to each of these data points. It's not normal that housing starts would turn us around from 0.5% gains to 0.5% losses in futures, and yet today that's what we see.
Well, absolutely. And I think part of the problem is that we now see risks balanced, or in my opinion, I think the recession risk is higher than any kind of risk that we have a resurgence in inflation. And so as a result, markets aren't exactly sure how to react to data points. It was a lot easier to say bad news is good news. Now, bad news, we're not sure what it is. And I think that's part of the problem and adding to the volatility. But for me, I am focused on inflation expectations this morning because I think it's an important part of the Fed's calculus. We want to make sure there are no obstacles in the Fed's way. There's nothing they can point to when they meet in September, because they need to cut rates.
They need to cut. Is 25 basis points going to be enough? Because that seems to be consensus. I know for a short couple of days, people kind of were freaking out, but now everyone has come back down to that a little bit more, maybe in terms of what we're seeing the market price in, but economists are pretty certain about that. What's your view?
I think 25 basis points is enough to start, and it would be very appropriate for the Fed. Thinking about 2022 when they went to tighten, even though they were behind the curve, they started with 25 basis points. They quickly accelerated, but I think to save face, they started with 25, and I think they would follow a similar tack this time and start with 25, and if necessary, cut more in the following meetings.
Can we actually back up? Why do they need to cut rates? I mean, as Matt mentioned, we heard from Austin Goolsbee this morning saying that he's starting to get a little bit worried about the economy, about the labor market. Do you share that view?
I do. I think we're starting to see cracks form. It's largely among lower income households, but it is significant, and I think it is likely to spread. So every day we have monetary policy as restrictive as we have it today increases our recession risks. I think there's no other way to look at this. I don't think we have to worry about some kind of resurgence in inflation. I think that's very unlikely. I know the Fed is reluctant. Jay Powell doesn't want to be another Arthur Burns, but the reality is that he needs to be far more focused on recessionary risks.
And so wrap this into how you position a portfolio around this. This is a Fed that needs to cut rates. Every meeting that they don't, the risk of recession increases. I mean, do you start hedging for that recession possibility, or do you really have faith here that the Fed will deliver?
I think you hedge for that recession possibility, but I have to say it is not my base case. And so my positioning would be focused on smaller caps, cyclicals, an assumption that markets will discount an economic reacceleration at some point late this year, early next. But that's the purpose of diversification, is to hedge your bets, right? And so I think there needs to be exposure to defensives. Within a fixed income portfolio, it's important to have exposure to a variety of different sleeves, from municipals to investment grade to higher quality, high yield. All of those can play an important role. Some will work better in some economic scenarios than others, but I think it's carving together a portfolio that has a lot of diversification in an environment where uncertainty is rising is really important.
I have a viewer who's writing in with a question. How are you advising clients to invest over the next 4 months in terms of sector changes, allocation into other asset classes, maybe taking some gains off the table?
I think the very tactical view, 1 month ahead, would be more defensive. I think we're seeing a fair amount of volatility. We've got a relative strength indicator that has bounced back from 30 to close to 60 on the S&P 500. So I think in the very, very short term, defensive makes more sense. But I think opportunities are going to present themselves, especially if we see more volatility, especially if we see more sell-offs. And that has a lot of potential to offer openings for those who are significantly overweight cash. And there are many portfolios where there's a very significant overweight to cash. This fall might present a lot of entry opportunities.
And let's talk about some of the known unknowns when it comes to positioning and some of the technicals. And I'm talking about the yen carry trade. Of course, that unwind certainly spooked markets over the past couple of weeks. One of the most read stories on the terminal right now is about how that carry trade attracting hedge funds again. How worried are you? Do you think that we're past the bulk of the digestion there, or is there still more to go?
Well, I certainly think that the future holds a stronger yen and a weaker dollar. Now, there are going to be some phases in this process, especially as we wait for the next moves by both central banks. So temporarily, I think there is that moving back into the trade, but I think ultimately it doesn't look attractive.
Christina, I mean, we've been debating about this. You know, how deep do you dive into it? You're like an education junkie. I mean, you have a JD and an MA, and you're a certified, I'm looking at your CV, certified financial planner, certified alternative investment analyst, certified investment management analyst, certified financial consultant. I mean, how deep do you dive into this kind of opaque world of carry trades and try and gauge whether it's 75% unwound or whether it's coming back by 30 to 40%? I mean, how much does it matter?
I actually don't think it matters too much. I think we have to recognize that it presents the potential to create more volatility. Look what it did just recently. And so I think we have to recognize that this could happen again. I think it's hard to have that precision. There's a false precision in setting exact targets and coming up with specific numbers for something like this, as well as even targets for the S&P 500. I think it's much more appropriate to get it right directionally, to understand what the threat might be and what it might do.
So really quickly, just to sort of tie a bow on this, I mean, if we do see more of that volatility, given there's debate as to how much it actually matters, does it actually affect fundamentals, would those be buying opportunities if you saw it, you know, take down NVIDIA by 7% again?
Well, I certainly think triggering a sell-off presents buying opportunities, especially in an environment in which we have the Fed poised to start cutting. And I think, especially once they start cutting, we're in an environment that's much more, I think, supportive of risk assets. So it could very well present a buying opportunity. For individual stocks, it's harder to say, but I think in general, there's going to be some sell-offs in our near future, and that is likely to be a buying opportunity.
All right, Christina, it's always great to see you. Really appreciate you taking the time on a Friday morning. That, of course, is Invesco Chief Global Market Strategist Christina Hooper. And we do want to bring you some breaking news right now. This out of the political realm. Howard Lutnick named a Trump transition team co-chair. Of course, in the event that Donald Trump does win the presidency again, Linda McMahon also named to that transition team as a co-chair there. We're going to continue to follow that story, bring you more details as we have them, but it's a busy day in the markets right now. Let's get a check on futures. The S&P 500 currently lower by a hair in the pre-market, down about 0.4%. A little bit more if you take a look at the NASDAQ 100. Same thing, too, at the Russell 2000, those small caps. Of course, we had disappointing housing starts. That seems to be taking some of the momentum out of the enthusiasm that we've seen at the index level this week. But let's take a look under the hood now. We're going to do that with Abigail Doolittle.
Well, starting off with one stock that is dragging, Katie, the shares of Bumble right now down 3.7%. This as Cowen has cut the shares to a hold from a buy on the company's uncertain recovery path per their research. They say that the near-term opportunity is unclear given the gradually worsening paying trends plus industry headwinds. Into today, the stock already down about 60% on the year, so clearly in a world of hurt, and there is a 13% bearish short interest, so those bears really winning. Turning to a stock that's doing a little bit better, though, quite a bit better actually. Planet Labs up 9.3%. They are putting their first hyperspectral satellite Tanager 1 into space along with 36 Super Doves. They will launch on the Transporter 11 rideshare mission with SpaceX and expand by 400 spectral bands of data. And then finally, Lumen, these shares lower by a significant amount, almost more than 4% here. Wells Fargo has cut the stock on their weakening legacy revenue. They are saying that the private connectivity is a better reward, but in terms of that legacy, Matt, it creates an overall less favorable risk to reward ratio.
All right, very interesting stuff. Abigail Doolittle, thanks very much. Coming up, we're watching Rivian as the EV maker pauses production of those Amazon delivery vans due to a supply chain issue. We'll talk tech with Ed Ludlow next. This is Bloomberg.
most investors are intoxicated by the opportunity in artificial intelligence. $160 billion being spent this year. That's just one data point. Another data point is a $3 trillion market cap for NVIDIA against $80 billion of sales on a trailing 12-month basis. Obviously, a lot of growth is expected for NVIDIA and for other businesses in the space, but that is yet to materialize, and it's impossible to know what the scale will be of an NVIDIA or other players in the artificial intelligence ecosystem. I think investors are just so focused on the opportunity set, on what it can be, and it's a self-fulfilling prophecy. If you bought NVIDIA a year ago or 2 years ago, you're pretty excited about where it is today, and you think that it could go to the moon. As a result, you don't really focus on the risks. You're sort of just too excited about the opportunity.
On the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that.
Don't miss Bloomberg's interview with the
Let's get now to high interest to look at what's making headlines around the world. VP Kamala Harris is set to propose sweeping new federal subsidies for lower-income Americans, parents, and home buyers, alongside new programs to curb increases in rent and grocery prices. Her plan includes expanding the child tax credit to $3,600 from $2,000 per dependent, with a supersized $6,000 credit for newborn babies. Meanwhile, Donald Trump is trying to reset his campaign as he loses ground in the polls. Corey Lewandowski and Dan Murtaugh are back from his 2016 and 2020 campaigns, respectively. And breaking just moments ago, Howard Lutnick has been named Trump's transition team co-chair, along with former World Wrestling executive Linda McMahon. The two will chair his transition into the White House should he win. Meanwhile, back in the world of business, Texas Instruments is set to receive a $1.6 billion grant in the CHIPS Act grants and $3 billion in loans as well. The announcement came from the Biden administration and will help the company pay for one factory in Utah and two in Texas, with 2,000 more manufacturing jobs expected as a result, if it actually gets built. Katie?
And sticking with chips, Applied Materials, which is the largest U.S. maker of chip manufacturing equipment, it delivered an in-line sales forecast for the fiscal fourth quarter. But investors clearly were looking for a bigger payoff from AI spending. Bloomberg Technology co-host Ed Ludlow joins us now with shares down about 3% pre-market, Ed. And of course, when we're talking about Applied Materials, they're a key supplier to Taiwan Semiconductor, Samsung, Intel. And I guess those companies just weren't spending as much money as maybe investors hoped.
Yeah, it's not that Applied Materials did anything wrong. You know, in the third quarter, it was pretty decent, and beat on most metrics. But the street has very high expectations that all of the capital expenditures going into infrastructure right now, particularly relating to AI, is going to have ripple effects for everyone. Applied Materials is not at the sort of lead cutting edge of machines that make those top-end AI accelerators. That's ASML. But there are lots of other ways that it could be involved. For example, when we see high bandwidth memory kick off from Samsung, SK Hynix, and Micron, they provide machines for that. So the guidance was fine. It's just that at the high end of the range, people thought it would be a lot better than it was. And it just shows there's probably a while to go until this massive boom happens, or indeed that it's continuing at the pace we expect.
It's pretty amazing that they're not getting enough orders for the automotive business when, Ed, auto sales haven't slowed down, and you know that the number of chips needed in every car just continues to climb to eye-popping amounts.
This is the data to track for the bigger picture. You know, we don't have crystal balls, but it's as close as you can get to it looking at the chip equipment makers. Because if you look at Applied Materials commentary and results, it's consistent with what NXP told us, that more cyclical industries, like the companies that make chips for cars, are sort of giving off sluggish demand vibes. And that's very interesting because you're completely right. The number of control units in any given EV is a lot. But at the end of the day, it's a sort of confidence thing, and it tells us that in the end market for automotive chips, they're probably not as bullish or in a full investment mode as perhaps we thought they might be at this stage of the cycle.
And Ed, switching gears here, you're not just an anchor. You also write stories as well, and you break news.
Sometimes.
And you broke some news last night when it comes to Rivian. This is interesting. Pausing production of the EV commercial van that it makes for Amazon. What's going on there?
Yeah, there's some sort of part shortage, which happened at the beginning of August, immediately following the quarterly earnings that they just reported. I don't know which part it is, but essentially they've just stopped the line until it comes in. You know, it's an example of the kind of disruption that Rivian continues to have to deal with. Importantly, there's no sort of material impact to guidance, right? The line in Normal, Illinois is capable of building about 15,000 of those things you see on your screen. They have a surplus of them anyway. If you fly to Chicago and you drive the 2 hours to Normal and you get to Rivian's factory, you'd see hundreds of them on the concrete outside because Amazon's been pretty chill about taking delivery of them, frankly. And what's interesting is that in the final 3 months of the year, Amazon's busiest period, they actually hold off taking delivery of new vans and expanding their fleets because they're just too busy dealing with holiday traffic and packages. So it's like teething problems, but I want to know more about what's going on. And I think investors set a really high bar for Rivian because of all the names on the cap table, the holders, the amount of cash they're burning through. And it just shows they're not immune to what's going on around the world.
Well, much more coverage coming up on Bloomberg Technology with Ed Ludlow a little bit later on. Appreciate your reporting as always. More scoops. Rivian currently down about 1% pre-market. Now coming up, we'll take a look at the companies making the most social buzz today in our Social Climber segment. Up next, this is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Today's CFOs focus on much more than just revenues and margins. Their impact goes far beyond the balance sheet.
The world is coming at us faster than it ever has. Our first job is to intimately understand and anticipate the consumer's needs.
You need to identify opportunities.
It's an incredibly fun job.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. New episode September 11th, only on Bloomberg. Brought to you by Workday.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
All right, it's time now for Social Climbers, the companies making waves this morning. And first up, H&R Block reporting a strong fourth quarter that beat Wall Street estimates. The tax prep company also guiding for another year of revenue growth. Shares flying right now, currently up almost 10% pre-market. Next up, Bank of America is adding to its list of sports sponsorships with a deal for the FIFA World Cup. Bank of America will be the first banking partner for the event in 2026, and the bank plans to have a physical presence across the host cities to tap new and existing clients. And finally, AST Space Mobile is confirming an early September window for its inaugural commercial satellite launch. The telecom company says that the satellites will be the largest ever to be deployed commercially in low Earth orbit. And of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal map.
All right, Take a look at what's going on in the markets right now. We had futures up just about an hour ago. Then we got housing starts out. That data disappointed, as well as building permits. And as a result, we are now pointed down just about 7 minutes into the open. One of the other big deals in markets, definitely the last couple of weeks, but it seems to be re-emerging, is the carry trade. And I want to talk to Damian Sassower about that. He's Bloomberg Intelligence Chief Emerging Markets Credit Strategist. And I thought of you, Damian, as I was reading about all these EM currencies that are swirling around. Like, the carry trade is an abstruse thing. We can't really put our fingers on it or wrap our hands around it. You can't really measure it, but Nomura was out today saying that it's back on right now as borrowing in the yen is being traded into higher yielding currencies. What's your take?
Well, you really can't measure it, but of course I try to, right? So let's talk about the debt of Japan. And we're not talking about the $4 trillion in Bank of Japan debt. We're talking about $20 trillion if you include GPIF, the biggest pension fund, and all the state-owned banks. And let me tell you something, all of them are positioned outside of the country in non-dollar assets. So what you're talking about is that repatriation of yen back on shore. And what that did is it caused this massive unwind. Traders were caught the wrong way, et cetera. But look how quickly it's come all the way back. And it's not just the yen carry trade. It's all leverage positions for that matter, Matt. It's payers in the U.S., in the U.S. Treasury market, steepeners, flatteners, all of the curve trades. A lot of that came off. A lot of that's coming back on. You've got the VIX now down below 16. And what I'm finally seeing in terms of currencies, not just in developed and emerging markets, are finally paying attention to monetary policy. So we've had 19 major emerging and developed market central banks, announce on rates over the better part of the last month. 9 of them have cut. So now what you're seeing is those who really can't afford to keep interest rates this high are basically cutting rates ahead of the Fed, and their currencies are taking a hit for it.
Another good word for the carry trade, I think, is nebulous.
Yes.
Another good word. That was the word.
That's the word you used, and I thought that's a great way to describe the carry. Thank you, Kate.
I got a lot of words, but we were talking about this with Christina Hooper, and she said, zooming out, the path of the yen is stronger versus the dollar. You think about that divergence that you're talking about between EM and DM. You think about just the Bank of Japan versus the Fed. Those two are diverging.
Right. Well, I think what you have to do is you have to decompose exactly what generates a total return in a carry trade. Well, there's 2 components of it. There's movements in the spot FX rate, which is what we're seeing and what we're talking about with yen now back below 150 and approaching 140. I don't even know where it is today. And the interest rate component. And let me talk about that interest rate component for 1 minute, because let me tell you something. Yields in Turkey are 50% overnight. Yields in Brazil are 10.5%, and they're over 10% in Mexico. So, when you talk about, the carry component, the interest rate return on these carry trades, it's significant because of these yield differentials, and that's not going away anytime soon. So I think what we're seeing is a reversal. People are putting back on the carry trades if you listen to them more and some of these others, and I expect that to continue.
Just got about 45 seconds left, Damian. We got a viewer writing in and asking, if the Fed cuts rates, does that force the hand, I guess, further of the other global central banks that you're watching?
Well, at least they're not asking about my jacket. I'm on radio today. But let me just talk about this. If you're talking about really Fed movement and what that means for the rest of the world follows the Fed. Some of these central banks are trying to get ahead of it, which is what we're seeing over the better part of, the last week. New Zealand, the Philippines this week. Next week, we're going to see Sweden probably cut rates again ahead of the Fed. But really, at the end of the day, it's other countries who started cutting, like Brazil, who are now pausing. Other countries like Mexico, who are not moving as quickly as we otherwise have thought. And again, these are countries whose policy rates, their overnight rates, are over 10%. So, on a relative basis, you've still got 500 plus basis points of carry cushion that's going to save the day.
I know you're on radio and YouTube with Tom Keene right now doing surveillance. I know you're with Tom because you quoted the VIX. And he's never had a Walter's hot dog. Did you know that? I heard this morning. I was listening to you guys on the way in. Tom has never had a Walter's hot dog.
I don't know what that is.
The greatest hot dog in America.
You split it. They cook it in butter. It's delicious.
Made in Mamaroneck.
Oh, it's great
Celebrating
stuff.
their, I think, 105th year anniversary. Just delicious.
Is that fat-free?
Damian Sassower, thanks very much. It's fat full. All right, more on these falling markets coming up. We're going to talk to Linda Dissel when we come back. This is Bloomberg.
can you have dinner with friends without hinting at what you're thinking about? And do you ever get suggestions from your friends at dinner, this is what you should do? And how do you respond when they kind of say, maybe you should lower interest rates? You just keep eating or what?
You might define the word friend to mean doesn't ask you about interest rates. So, no, people don't do that generally. You know, people I don't know will always say, hey, cut rates. Somebody said that in the elevator this morning.
Did that influence you or no?
I said, thank you, sir. You know, and no, but I mean, you know, people say things, but you know, it's fine.
So in some parts of the society these days, people are making decisions based on something called artificial intelligence, AI. Have you thought about, you know, calling up ChatGPT and saying, you know, here's all the data we have. What do you think about would be a good idea? Have you ever thought about that, or they're not going to like you to do that?
We haven't done that. I mean, we have done little things like we've asked ChatGPT to generate questions for the press conference. And I'm happy to report for
1 minute remaining for the cash equity open and the market on open imbalance.
So.
What about my questions? How do they compare to my questions? Okay.
No comment.
Right, so they weren't that great. Okay.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
We are moments away from the start of the cash trade. This is Bloomberg Open Interest. I'm Matt Miller. We saw a real turnaround in futures this morning. We were headed up. We're still
We look now to the market on open imbalance. The S&P 500, 40 million to the buy side. NASDAQ 100, 100 million to the buy side. Dow 30, 45 million to the buy side. Mag 7 stocks, 75 million to the buy side.
Stock exchange, you've got what looks like Q2 ringing the opening bell. And on the NASDAQ, Smokey the Bear, 80th birthday. That's excellent. He's quite young, actually. I would have imagined he was older. Only you can prevent forest fires. Let's get a quick check on the major averages this morning as we kick off the session here. S&P 500 down about 0.25% right now. NASDAQ 100, so the bigger tech stocks down 0.5%. The small caps on the Russell 2000 down a little bit less than 0.25%. One of the stocks that we're watching at the open is H&R Block. Earnings there beat estimates in the fiscal fourth quarter. H&R Block announced a $1.5 billion share buyback as well as a 17% dividend increase. So giving money, returning cash to shareholders, that's what the market likes to see. There you can see the full quote. Let's get over to Katie Greifeld right now. Katie, what are you watching?
Yeah, not as rosy if you take a look at Applied Materials. We were just talking about this with Ed Ludlow. Of course, the chipmaker sales forecast, it came in line with estimates. That's good news, but the bar was really high. Shareholders clearly looking for bigger returns on the AI investment. Shares currently off about 4% just a couple seconds into the cash trade. We also want to take a look at NVIDIA's week because the stock rose by more than 12%, of course, lifting the S&P 500. Lifting the NASDAQ, also bringing the company's market value above the $3 trillion mark. Let's take a closer look now with Bloomberg's Abigail Doolittle.
Yeah, lots of rally action this week, Katie, for big tech and the markets overall right now. Yesterday, actually, I should say, we had these indexes up 6 days in a row. But take a look at tech on the week. Supermicro Computer gaining 22%, basically in a bull market after having dropped in a bear market. NVIDIA, I don't know whether or not it's still in a bear market. I suspect it's not, but the degree of the bear market, probably this stock may still be in a correction from its peak. We'll be taking a look at that chart in the 10 o'clock hour. Micron up 14%, Broadcom. So you see this broad rebound for the chip space as investors are buying the dip from that big sell-off, induced in part by too far, too fast, the yen carry trade. Let's take a look at technology relative to the other sectors, because we are going to see this massive outperformance, up 8%, the best week since 2022. Discretionary discretionary. There's also some big tech in there. Financials, healthcare, and then you can see that the more dividend-oriented, rates-oriented sectors on bottom. Real estate and utilities not even up 1%. So big outperformance for tech. One question, though, is will it last? There are some similarities to the monthly chart of the NASDAQ 100 to 2022. Out of the 2020 pandemic low, you can see this big rally. The RSI overbought for a period of time, but then it started to cross it lower. It didn't happen all in one stroke in 2022. It took some time. Well, take a look at this massive rally that we've had for the NASDAQ 100. Interestingly, similar to into 2022, the trend reversing. The point of a trend line is not to see the trend, it's to see when it reverses. The RSI starting to come out of overbought. It suggests at some point, Matt, that the big tech strength that we've had this week, well, that may not be the case.
It's amazing how overbought it was, though, Abigail, in 2022. And we were talking this morning with Christina Hooper of Invesco. She mentioned the RSI as well. We're not quite there yet, right, where we were in that last big rally.
Yeah, we're not there, and it's unlikely that we will be. So that was truly overbought, to your point, between in June of 2021 into 2022. Right now, we were right above 70, now at 69, which really points to the uncertainty. Not quite as robust here, but still a pretty tremendous rally. Last year, the first half for the NASDAQ 100 up 40%. That was the best first half for the NASDAQ 100 ever. So lots of steam rising there, and now it seems to be evaporating a little bit. It's going to be interesting to see whether or not we have something similar to what did happen in 2022.
All right, we'll definitely keep our eye on it. Abby, thanks so much. Abigail Doolittle taking you through the technicals. Let's bring in Linda Dissel right now, Senior Equity Strategist at Federated Hermes. Linda, we've seen an incredible bounce back from the Manic Monday that we had last week. What are you doing right now? I mean, I think a lot of people used that drop to get back into tech stocks that they'd sold off. At least the 13F showed us that a lot of big hedge funds had taken some profits. Where are you positioned?
Well, good morning. Thanks for having me. The VIX that spiked was a kind of a rare spike. It was an extremely rare decline from that spike. And history suggests that when the VIX goes spikes like that, you should expect some more tremors before you think you're out of the woods. So we're suggesting still that, you know, even though it's all over the map as to whether this carry trade is over, your commentary about what's going on in the technology sector is very interesting. And like it seems like every quarter we need to bite our nails as we wait and see what NVIDIA tells us in terms of their earnings and their outlook. And that can also just on its own be a time to pull back yet again. So we think we're still going to have some volatile months now.
Yeah, NVIDIA doesn't report until August 28th after market. That certainly will be a lot of fun. But let's go back to the carry trade, the nebulous carry trade that we've been talking about. It's extremely technical in nature. It's not going to alter the fundamentals of an NVIDIA, for example. And Linda, with that in mind, if we do see more volatility around the carry trade, fears of that unwind, is that a time to really buy that dip?
Well, you know, again, the numbers as to how far we are through the unwind of this carry trade are all over the map. So it's hard to really suggest that that bit of it is done. It's probably largely done, but because these names, these technology names are so widely owned all around the world, it's hard to believe that, you know, one couple of day trade is, you're done. It's really hard to believe that. And it seems impossible for the experts to really pin down whether it is, which is why I bring up earnings season anyway. Regardless whether people bought on the dip or not, people are still heavily invested in the large caps tech sector, which we like, and we like the broadening of the market. We're simply suggesting that more volatility is likely to come as people are on edge, traders are on edge. It's the summertime trading environment and the like.
How confident are you? I mean, this earnings season has been very strong, 11, 12, 13% growth in terms of profits, and the rest of the S&P, after you take out the mega cap stocks, which has been in an earnings recession for the last 6 quarters, is finally turning a profit. Do you expect that broadening to continue in the second half?
Well, yeah, it's very, very interesting. The broadening is such a great thing to see because it gives you more confidence that it's not just a handful of names. And indeed, it's been a much stronger second quarter than many thought. We've suggested that we're going to watch profit margins and see what the guidance is. So the guidance that came out of the second quarter, you saw a more broadening of companies reducing their guidance. You've seen a more broadening of companies raising their profit margins. 2/3 of the companies had profit margins up in the second quarter, which is great news. But you've seen for third quarter earnings per share expectations brought a broadening of bringing that down. So it could be kind of a pivot moment potentially, or at least let's not get too excited and continue to extrapolate. It's just one of those things. It's much like the jobs market. Are we having a problem or not in the jobs market? Are we having a problem or not in the retail sales environment? It just, things are staying stronger for longer, but we're all just biting our nails for the flip over, and third quarter will be interesting.
Yeah, well, that's where I wanted to go. And you talk about this nail bite moment. I wonder if we're seeing the high water mark, because already you're starting to see some Q3 estimates come down for earnings, depending on which measure you look at.
Yes, indeed. Depending on what number you look at, the earnings figures for the second quarter were 11-12%, and that's being brought down to 6%, maybe when all is said and done, maybe 8%, but a decrease to be sure. So we are expecting that more of this concern will start to eke its way out into the into the various parts of our economy and our markets. But still, we think, look, we have a 55-20 figure for this year end in the S&P, and that's where we're at right now. That argues for continued volatility on the downside, strength after the election, and we have a 6,000 target for next year. So a broadening of a slowing, but still no recession is kind of our bottom line.
All right, Linda, that's a good place to leave it. Really appreciate you taking the time. That is Linda Dissel. She is Federated Hermes Senior Equity Strategist. Have a great weekend. Now, coming up, with Mpox being declared a health emergency, we speak to Dr. Seth Lederman. He is the CEO of Tomix Pharmaceuticals, which has a vaccine candidate for the virus. That conversation coming up next. This is Bloomberg.
So a number of people, I think from Homeland Security and or the CIA or NSA, have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements. And TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money. If I had invested with you, which I wish I had, what kind of rate of return would I have had over that 10-year period of time?
Over 100% a year on average. On average.
100% a year, that's pretty unusual.
All right, let's take a look at what's going on in the market right now. Just about 13 minutes into the trade, we are still down only about 0.1% on the S&P 500. We had been up this morning. And then housing starts came out in a disappointing way, building permits as well. And as a result, we turned around. The NASDAQ 100, the big cap tech stocks, are lower right now, and the Russell 2000 is gaining. So a little bit of a rotation this morning, Katie.
A tiny rotation. We'll see if it can build a little bit, but it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Wells Fargo going all in on Fox with a double upgrade from sell to buy. The analyst attributing his bullish call to the company's sports streaming opportunities. Next up, Bank of America says that Estee Lauder no longer a buy. The firm downgrading the beauty giant and cutting its price target by $40. The analyst cites weaker than expected performance in China. And finally, TD Cowen cautioning investors on Bumble as it cuts its buy rating on the online dating site. The analyst cites an uncertain path to recovery thanks to fewer users, the lack of other portfolio brands, and broader challenges in the online dating space, Matt.
All right, let's get to an issue that has been popping up on the most read for the last few days, and that is Mpox. The World Health Organization has declared the fast-spreading Mpox outbreak in Africa a global health emergency, and now as the variant changes, it leads to more challenges trying to contain it. The Director General spoke about his concerns.
WHO has been working on the Mpox outbreak in Africa and raising the alarm that this is something that should concern us all. The emergency committee met and advised me that, in its view, the situation constitutes a public health emergency of international concern.
Joining us now is Dr. Seth Lederman, CEO of Tonix Pharmaceuticals, which has a vaccine in development for the virus. Doctor, really appreciate your time this morning. Tell us about this vaccine. I believe it's not in human testing yet. So is it likely that you get it through testing and out in time, I should say, to contain this virus?
Yes. First of all, thank you for having me on. We've done advanced animal testing, and we're ready to start manufacturing. And we are glad that WHO has declared Mpox a global health emergency of international concern. Our vaccine at Tonix is a live virus vaccine, and that allows us to vaccinate potentially many more people to lower cost. And we think it has the capability of making an impact on public health.
And how long do you see the threat of Mpox remaining? And I mean, extrapolating that out, how big do you think the market could potentially become here?
Well, it's frightening to think about it, but 2 years ago was the most recent public health emergency involving Mpox. And in that, 32,000 Americans have become infected, and it's now endemic in the United States. But this new strain, Clade 1b, which, by the way, was first detected outside of Africa in Sweden yesterday, is expected to come to the United States. This is believed to be more contagious than the Clade 2 that infected 32,000 Americans in the past 2 years, and also approximately 20 times more lethal.
I remember when we were at the start of the COVID outbreak, and Angela Merkel, the Chancellor of Germany at the time, said she thought 60 to 70% of the population could get it, and that sounded insane. Of course, now we've all gotten it. Can Mpox get this bad?
Well, we're still learning about the transmissibility of this Clade 1b variant, but it does seem to be more transmissible than the clade 2 variant. In the United States, the clade 2 variant was mostly restricted to men who have sex with men. But in Africa, monkeypox, about 50% of the deaths are in children. So this is not technically a venereal disease, but it is transmitted by contact and also potentially by aerosol. So I can't guess right now how widespread it will become in the United States, but it is hard to imagine that it won't spread in the United States. And in fact, we really don't know. The HHS said yesterday they don't believe that clade 1B is in the United States yet, but we did, as far as I know, the CDC is not actively testing.
And I want to talk a little bit more about your specific vaccine and the trial that's underway. What type of trial is this, and when might we expect results to be published?
Right. So we haven't started a trial yet. Now we're reinvigorating our efforts because, frankly, interest in Mpox was maintained at Tonix, but not by health authorities or investors. So we're ready to jump on and get going again. But the difference is that ours is a live virus vaccine. It's a modern form. We call it a fourth generation, similar to the vaccine that Edward Jenner introduced in 1800, but we believe with much better tolerability profile, much better, 10,000-fold in animals. And this, when Jenner's vaccine was used to prevent smallpox all over the world, that actually kept Mpox out of the human population. So we think from a public health point of view, a live virus vaccine has the ability to block forward transmission and to be work with only one dose. And that's a big advantage, both in the United States and other countries.
Well, Doctor, we'll definitely keep an eye out for that trial start. Really appreciate you taking the time today to walk us through it. That, of course, is Tonix CEO Dr. Seth Lederman. Now coming up, best known for buy now, pay later loans, the fintech firm Klarna eyeing an IPO. More details next in our Wall Street Beat. This is Bloomberg.
At 10 a.m. Eastern Time, we get the University of Michigan data. Sentiment prelim forecast 66.9 on the prior 66.4, with a range of 69 to 64. 1-year inflation prelim forecast 2.9% on the prior 2.9%, with a range of 3% to 2.8%. 5-year inflation prelim forecast 2.9% on the prior 3%, with a range of 3% to 2.9%. Expectations prelim forecast 68.5 on the prior 68.8, and condition prelim forecast 63.1 on the prior 62.7.
Billionaire Gautam Adani founded one of India's biggest and most controversial business groups. After being rocked by accusations from short seller Hindenburg Research last year, Adani is now preparing for the company's future in a real-life succession story. Meet the family members he's hand-picked to take over the business as we deep dive into the facts and rumors surrounding the Adani Group. Inside Adani, a Bloomberg exclusive replays all weekend, only on Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Let's get a quick check on where stocks are trading at the moment. Right now, the S&P 500 getting towards little change, getting towards unch. We had been up about 0.5% on futures, then down 0.5% after the housing starts came out, and now we're looking very little change here, but still up bigly for the week. The NASDAQ 100 down about 0.3%, the Russell 2000 gaining. The S&P has been on quite a tear this week since it had such a disappointing Monday last week. Then it was unchanged at the end of the week. Right now we're up 3.6% for the week.
And we do have, of course, some data coming at the top of the hour. University of Michigan sentiment coming out. Of course, we're moving on every single data point. Right now, it'll be interesting to see what happens. But it's time now for our Wall Street beat. Swedish fintech Klarna is setting the stage to be one of the biggest U.S. IPOs of 2025. The CEO joined Bloomberg earlier this morning about the company's future.
We're probably going to hit over $1 billion in revenue in the U.S. pretty soon. So, and that has obviously made sure that we are doubling down our efforts to accelerate rolling out new services in the U.S. as well. But especially when you talk about things like bank license, it does take some time, right? They took us a few years to get our European banking license, so we don't want to make the dependency on the IPO to that.
And for more on Klarna's growth and their plans, I'm thrilled to say we're joined now by Bloomberg's Bailey Lipschultz, who covers IPOs and everything else. And Bailey,
noting spot gold rises to $2,500 an ounce for the first time.
I'm hosting Bloomberg Radio from 10 to noon, so if you get bored of this,
with Alex Steele.
With Alex Steele, yeah.
Oh, you're a lucky guy. Well, you have about 7 minutes, 6.5 minutes here. Tell us a little bit about Klarna and their plans. Does 2025 sound realistic?
I mean, it could be. When I talk to bankers, though, 2025 is kind of being chalked up to a lost year in the sense that you're coming out of the August lull. If you want to go public, you have to do it after Labor Day. You're really kind of threading the needle between that and the U.S. election. Do you want to go right before Thanksgiving, or do you want to try to, again, Thanksgiving this year is on November 28th, so when you look at the calendar, it's pretty choppy. So the bulk of activity when I talk to bankers and executives and investors is likely going to happen in the March to May timeframe next year.
So it's less likely, in your opinion, that they actually go in 2025, but they'll be big, right?
Big.
I imagine if it's one of the biggest U.S. IPOs, that means it's going to be one of the biggest global IPOs.
It would be. We don't know what the logic or thinking could be, but right now we're seeing, in Bloomberg's reported, Klarna could target a valuation of $20 billion. So if you kind of slice and dice how many shares they offer and kind of what they want that float to be, that'll be interesting. But when you got to look at this company, you got to keep in mind, they did a funding round in 2022 at $6.7 billion. That was a sharp drop from $45.6 billion.
At 10 a.m. Eastern Time, we get our University of Michigan data. Sentiment prelim forecast 66.9 on the prior 66.4, with a range of 69 to 64. 1 year inflation prelim forecast 2.9% on the prior 2.9%. 5 year inflation prelim forecast 2.9% on the prior 3%. Expectations prelim forecast 68.5 on the prior 68.8, and conditions prelim forecast 63.1 on the prior 62.7.
Interesting to see kind of what the receptivity is of investors when we get closer to potentially launching those IPOs, but it really feels like the others, the insurance names, the healthcare names, that's really what's going to make up the bulk of the post-Labor Day window.
All right. Bailey, thanks very much for joining us. Look forward to your radio show from 10 to 12 on Bloomberg Radio with Alex Steele. I want to take a look at gold. Let's take a longer-term look at gold, because the intraday chart is going to show you a little rise to 24.96. 2,500 is the level that it hit just a few minutes ago. And here's a one-year chart. This shows the incredible climb that we've seen in gold at a time when, especially in the last half of the year, when Bitcoin really didn't help during the Manic Monday, flash crash, gold continued to remain steady.
There's your hedge right there.
Coming up in the next hour, Liz Ann Saunders joins us of Charles Schwab. We're also going to talk to Evite CEO Ann Defoe. Stick with us on Open Interest. This is Bloomberg.
Liquidity is the lifeblood of an airline. We make very conservative decision making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day. I know the
1 minute remaining. I'll lead with University of Michigan sentiment prelim.
Have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
10 seconds.
We are 30 minutes
67.8, 67.8 higher than forecast, 66.9. 5-year inflation prelim 3%, 3% higher than forecast, 2.9%. 1-year inflation prelim 2.9%, 2.9% as expected. Expectations prelim 72.1, 72.1 higher than forecast, 68.5. And condition prelim 60.9, 60.9 lower than forecast, 63.1.
Will unveil her economic proposals at a rally in North Carolina today.
Seeing some upside in dollar and stocks after that release.
Let's get a check on what the markets are doing today. We saw the look for the week. They're still up 3.5% for the week, at least the S&P is, but unchanged right now. And this data that you see at the bottom of your screen has the potential to change. Any economic data point has the potential to change the direction of the markets these days. It's breaking. You see it there. University of Michigan sentiment a little bit better than expected out of consumers, 67.8. We were looking for 66.9. Current conditions, a little bit worse, 60.9. We were looking for 63.1. And then the inflation expectations, which I find interesting, a little bit higher 1 year, 2.9%, and 5 to 10 years, 3%. We're looking for 2.8 and 2.9% respectively. So.
All right.
Let's wrap our heads around this data. How shall we do that, Katie?
Let's do it with Mike McKee, of course. He is our Chief International Economics and Policy Correspondent. He's sitting right to my left before, of course, he goes to Jackson Hole next week. What do you make of these numbers?
They're pretty much in line with what we have seen. Now, the interesting question about the numbers and the current conditions index is that the previous Michigan survey did not capture the change from
We
Biden
have posted the University of Michigan Sentiment Survey August prelim report on the feed for all those interested.
With Biden out of the race, and it doesn't seem to have affected people's views of the current economy, although we do see a rise in expectations. Whether that's related to the politics or not, hard to tell. For the Fed, no change in the inflation expectations. That's good news, just fits into the narrative that they can continue moving towards rate cuts.
They've been winning the big game lately against Ohio State, but Mike Wilson kind of poo-pooed the data, saying, you know, it's inversely correlated to inflation, so he didn't seem to really care that much about it. How important is this to the Fed?
Well, the inflation expectations data is important to the Fed, along with what you get in the markets when you're looking at the various inflation measures, tips or swaps or whatever, because they want to make sure that inflation doesn't get ingrained. And the idea is that if people expect inflation to be higher. It will get higher because they will take actions to try to make more money or do something to offset that. So they keep an eye on it. It's been tame, and they've taken credit for keeping expectations in check, which they believe is because of their credibility on inflation. People believe they would raise interest rates, which they did. So they're relatively happy with this. In terms of the overall sentiment numbers, they don't bear a lot of relation to what people are going to do in terms of spending. Alan Greenspan's famous line, "We watch what they do, not what they say."
Right, that's an important one there. The S&P 500, though, erasing declines right now. We're back to unchanged. Before we let you go, I do want to talk about Jackson Hole. Of course, all the central bankers gathering in Western America, in the mountains. They always tend to make news out there. What might the headlines from this year's Jackson Hole meeting be?
I think they're going to be relatively tame. Jay Powell's going to get all the attention for his Friday speech, but when you think about what he can say, it's probably going to be, we've had more inflation data that is good news and keeps us on track, and maybe at some point soon we can start cutting interest rates. But he doesn't want to lock that in because there is still data to come, another CPI, a jobs report, etc. And then all the other Fed officials out there who are talking, and not all of them do, but they will probably say much the same. Austin Goolsbee seems to be now trying to set people up for maybe a dovish move in September. In other words, they cut rates, but they don't promise to cut rates again right away, or they do promise to cut rates again right away because he thinks they're going to need it. But beyond that, I don't think you get a whole lot out of it. I know Bill Dudley had a column today suggesting Jay Powell might talk about the framework review, but that doesn't start until the fall, so I don't think he'll front run.
One thing I want to get out of it is, I know that the surveillance is going to Jackson Hole, right? I want to see John Farrow in a cowboy hat and boots at the $1 Million Cowboy Bar. Can you make it happen?
I think John is staying here. I think it's just Tom and Lisa that are going.
Tom and Lisa that are going. And last year, Tom went to the $1 Million Cowboy Bar in his suit and bow tie.
He looked amazing.
Let's put it this way. Nobody was confused about who Tom Keene was in that bar.
I'm sure he's a celebrity there. Michael McKee, thanks very much for joining us. Be sure to tune in to Bloomberg for special coverage from Jackson Hole. Fed Chair Jerome Powell will speak on the U.S. economic outlook next Friday. We will bring you that live. Unfortunately, no Pharaoh in a cowboy hat. We're joined now by Liz Ann Saunders, Charles Schwab, Chief Investment Strategist. Liz Ann, it's been a pretty crazy couple of weeks here after, the non-farm payrolls miss and then the Manic Monday. We've been, for the most part, off to the races because I guess we're no longer scared on the growth side anymore. What's your take on these markets?
Yeah, I think for now we did move into a mode of good news is good news. And you're right, it was in the aftermath of the non-farm payrolls report. And I think that's increasingly important in the labor market because the Fed has essentially told us that they haven't put the inflation data in the rearview mirror, but the labor market data is coming into sharper focus. And I think decision making around when they start, which is likely to be September, how aggressively they move, will be at least as much driven by what goes on in the labor market as what we're seeing in the inflation data. So, but I also think, as we've seen on a day like today, where you've got weaker housing data versus yesterday, where we had stronger retail sales data, is we are still dealing with cross currents in the economy. This is not a straight line in either direction. And when we start to cheer that, okay, the news is Goldilocks, like, you kind of get hit with something in the opposite direction.
And is that really the laser focus of this market right now, what's going on in the economy? Because we have all these earnings, we talk about them ad nauseum, and it seems like, at least at the index level, it's really the economic data that is just driving all the movement right now.
It is the economic data because of elevated concerns about recession. I think that was exacerbated through a couple of things. Frog in the throat. Number one, you had the fund manager survey come out from B of A suggesting that fund managers now have recession as their greatest concern. You had the intraday move in the yield curve back into positive territory. A lot of people think that it's the inversion of the yield curve that is kind of the recession warning. That's more the recession watch, and the uninversion is the recession warning. Now, it was only intraday and it came back down again, but you add that to the weaker jobs report, I think the economy is in sharper focus. And as it relates to earnings, second quarter was stronger than expected right now, running on a blended rate at about 12 or 13%. But throughout the reporting of second quarter, we were seeing a diminution to expectations for the third quarter, and expectations now are for a growth rate about half of that. You add in the concerns about the cost side versus revenue side of AI, and I think we're likely to see some more bouts of volatility, including some periods of calm.
Yeah, so second quarter earnings, it feels like they were good enough that we could basically ignore them.
They were great.
They were okay.
12 or 13%?
They were pretty
The end of an earnings recession for the rest of the S&P?
Yeah, but as we were talking about with Linda Dissel, maybe the inflection point there, you think about third quarter estimates, and that's where I want to go, Lizanne. They're starting to come down, even though we're really focused on the economy right now. If we did start to see a deterioration in the earnings picture, I mean, would that take over as being the zeitgeist?
Yeah, probably. We did through the corrective phase, which didn't quite get there on the S&P. We did on the NASDAQ, and up the cap spectrum into areas like the Magnificent Seven. You were more in the 15% drawdown during the recent pullback phase. That didn't do a heck of a lot to ease some of the valuation concerns. And the hope, of course, has been, especially in light of stronger than expected second quarter earnings, that you would see earnings play catch up to what has happened to valuations. Now, valuations have come down a nudge, but now we have that rolling over and a bit of deterioration, not into negative territory for the third quarter. But that narrative has changed a little bit because we're not going to see earnings catch up to some of that valuation expansion as quickly as many would have hoped.
Before last week, we were so focused on the presidential election as it relates to markets. It seems like the idea of a Trump trade or the importance of that has flown out the window. How focused are you? How focused are your clients on, November?
They're focused on it just in terms of the amount of uncertainty. What we're hearing a lot is concerns about a close and/or contested election and what that would mean for volatility in the post-election period of time. One of the things that we always cautious investors around is not to try to trade the market based on potential election outcomes. It certainly happens. There's a lot of trading that gets done in terms of sectors that might be seen as beneficiaries or get hurt by policy, but there's not yet been a lot of policy discussion. So I'm not sure that's such a big driver at this point, but I think it is a sort of a fool's errand to try to play the trading game leading into an election, especially in advance of knowing whether we're likely to have a divided Congress, what the majorities will be, because what gets discussed on the campaign trail and what can actually be implemented, there can be a yawning gap between those two, obviously.
Yeah, and of course, it's anyone's guess to see what actually happens in November if you take a look at the polling. I do want to talk to you a little bit about the carry trade before we let you go. We've been debating how much it actually matters. And from your standpoint, where you're sitting now, what's your view, whether or not we're done with the bulk of the unwind? And even if we aren't, what are the long-term implications of that?
So, it's hard to assess what portion of the carry trade has been unwound. I suppose JP Morgan is as good a source as any, and it was, I believe, last Thursday when they came out and said it was probably 3/4 of the way unwound, and that provided significant support for the market. And you saw that, ripper of a rally. My colleague Jeff Kleintop, who is our international strategist, thinks that, that's probably around in line, meaning essentially the majority of it has been unwound. But you could see carry trades get put on again, and then you've had the ripple effects, because when you look at correlations and you look at the last week's unwind of the carry trade and the commensurate hit to areas like the Magnificent Seven, it's easy to infer that a lot of that money via the carry trade went into some of those high beta, mega cap, tech, AI kind of areas. We just think that any additional volatility associated with the carry trade might not be as disruptive as like what we saw last Monday, where you had, a lot of people don't realize that in terms of the VIX, you had the largest ever intraday surge in the VIX, that same day you had the largest ever intraday decline in the VIX, all in one day. By the end of the week, it was sort of ho-hum. If you were only looking on a weekly basis, it was sort of a nothing to see here, but the intraday swings were wild. We don't think that kind of action is likely in the near term.
Yeah, a lot of fun, but pretty wild, I guess, if you're actually trading it. Charles Schwab, Chief Investment Strategist, Liz Ann Saunders, great to speak with you. Meanwhile, I take a look at these markets right now. The S&P 500 back to flat. Their small caps up about 0.5%. Let's take a look at what's moving underneath the surface right now with Abigail Doolittle.
And quite a bit is moving beneath the surface. Let's start off with some analyst moves, starting off with the shares of 21st Century Fox, up 1.8%. This, as Wells Fargo has double upgraded the stock from underperform to outperform, basically on sports streaming, saying that this is really a big opportunity, that even potentially it could just move right into
According to sources, China's central bank issues gold import quotas to several banks after the pause.
Williams Trading upgraded the shares to a buy from a sell, so a pretty strong call there as well. They like the recent rehire, I should say, of Tom Petty as head of U.S. wholesale. In the last quarter, there was a lot of negative information about inventory basically stuck in the channels. So apparently Williams Trading believes that Tom Petty will be able to take care of that issue, and that stock has been under pressure on the year. Last time I looked, down more than 20%, but today it is higher. As for what's helping out from the big point standpoint, Tesla up 2.4%, back above its 50-day moving average. I would say some technical buying there. It's not clear if it'll stay above there. Alphabet trying to move above, I think it is, or bounce off of its 100-day moving average, so more technical trading. And Netflix up a healthy 1.3%. On the downside, however, we do have Microsoft trading lower, and in some of those 13Fs that did come out, that Leon Cooperman has slashed his Microsoft holding. The stock right now down about 0.6%. Meta Platforms down more, down 1.5%. And then, of course, on earnings, we have Applied Materials, the semi-cap equipment company, so the machinery that makes chips. This stock is down. Interestingly, Matt, the quarter was fine, the guidance was fine, but the guidance underwhelmed because it was
Egypt
only
says the
in line.
Gaza
Investors
truce
wanted
talks were
more
serious
on
and
AI
constructive.
Demand. They didn't get it, and the stock is down by nearly 3%.
Tom Petty. I miss that guy. You like Tom Petty?
I don't think it's that Tom Petty. It's Tom Petty, P-E-D-D-I.
No, I know it's a different one, but the other one is the one I know. I'm sure this Tom Petty is also
great guy.
A fantastic operator.
Probably.
Probably not as good a musician, a songwriter.
Few are.
Yeah. All right, coming up, Kamala Harris makes her economic policy pitch to voters today, including subsidies for first-time home buyers as much as $25,000, parents as much as $6,000 for a newborn, and low-income Americans. This is Bloomberg.
From our world headquarters in New York, I'm Menace Credit.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything. The names that move markets are on Bloomberg.
Don't expect we're going back to zero, because zero was the product of huge global shocks. I think to get to there, something really bad has to happen that we're not currently expecting. So it'll be somewhere, somewhere obviously in between. I think we've made a big point of saying policy is currently restrictive, so you can deduce from that it'll be lower than where we are today, but I think it's very clear that we're not going back to zero.
Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Let's get now to high interest, look at what's making headlines around the world. JetBlue's third biggest shareholder isn't an institutional investor or an activist or even a famous meme trader. He's just a regular guy trying to make a buck. One man's expensive side hobby is quietly building a stake in the money-losing airline. His 8.1% of the company is worth $132 million, roughly on par with Carl Icahn's stake. It's a great story on the Bloomberg terminal.
Taking a look at the Fear and Greed Index, 35 out of 100 equaling fear, and the Crypto Fear and Greed Index, 27 out of 100 also equaling fear. Looking at the VIX, currently down 0.59% at 15.15.
As far as the personal attacks, I'm very angry at her that she'd weaponized the justice system against me and other people. Very angry at her. I think I'm entitled to personal attacks. I don't have a lot of respect for her.
Staying on the Trump campaign, in addition to the return of Corey Lewandowski and Dan Murtaugh, the former president has picked the leaders of his transition. Linda McMahon of World Wrestling Federation fame and Howard Lutnick of Cantor Fitzgerald will co-chair Trump's transition team should he win his bid to return to the White House. Here's what Lutnick said about Trump's campaign on our show last month.
He needs money, right? It's a race now. It's a hot race now, and you know, Donald Trump needs the fundraising, and I'm trying to help every way I can.
And on the campaign trail today, Kamala Harris will lay out her economic agenda in North Carolina. It includes federal subsidies for parents, home buyers, low-income Americans, as well as new programs to curb increases in rent and grocery prices. Let's discuss all of it with Bloomberg's chief political correspondent, Anne-Marie Hordern. And we've been asking for details on what her policies might actually look like, what that portfolio could be. And less than 3 months ago, we're starting to get it.
Right, but we're just getting the top line. So I think what you're not going to see from this campaign just yet is actually the details on how some of this would actually come to fruition, especially when you talk about big subsidies that would require going into the tax code and editing the tax code. You need congressional approval. You cannot just do this unilaterally from the White House. But what it does say, and it's a clear message, is that she has the high cost of living in mind. This campaign, before they even go into the DNC, a really big, important political message they are sending is, we actually hear you. We understand high cost of living is a huge problem for you, and you're unhappy with the current economic status. So basically what they're doing is they have this idea about price gouging, which a lot of economists have basically rolled their eyes about, but it's getting a message to the American voter that we understand your grocery bills may be too high. We understand that you can't get on the property ladder with this $25,000 subsidy for first-time buyers, and then of course the expense of having children, the child tax credit. That's something that actually may have bipartisan support, though, because we also heard Ohio Senator and VP pick for Donald Trump, J.D. Vance, talk about.
Yeah, she wants to raise it to $3,600 per child, $6,000 if it's a newborn. I think Vance wants to raise it even higher. $5,000. The interesting thing is, so on the one hand, she's taking a lot of platforms from Donald Trump's, planks from Donald Trump's platform, right?
It's a populist message on both sides.
Exactly. But Trump isn't taking advantage of, you know, Biden's failure, if you will, on the economy. He would rather just insult Kamala Harris, as we just heard in that SOT. Why isn't he listening to what his advisors must be telling him?
Well, his advisors are trying to tell him this, and I think yesterday you saw this clearly. They even placed groceries that consumers buy, Folgers coffee, cereals, all behind him, and he struggled to stay on message and on script, and instead he took some moments to go after Kamala Harris, when what the campaign wants him to do is, look, Americans are still feeling inflation. Yes, the rate of inflation is coming down, but they've struggled to explain that even though the rate is coming down, what Americans are feeling is that prices haven't come down, just they're not accelerating as fast. And what the Trump campaign wants him to do is attach Kamala Harris to that feeling that people are feeling right now, because it's not just Biden. She was the vice president for the past 4 years.
Yeah, and it's also, it's not just a feeling. Prices are very high. Like when we got the inflation numbers, even though they were better than expected, the message should be, hey, prices are still rising.
The level matters here. I mean, that's what people feel at the grocery store. We only have 30 seconds left with you, but of course you're headed to the DNC next week. There's some story on the terminals about cops vowing to really fend off havoc should there be protesters.
The protests are going to be amazing.
Yeah, what are you expecting on the ground?
Well, this is what a lot of people in the Democratic Party were fearing. Is this going to be a repeat of 1968? there are going to be protests. Protests have followed Kamala Harris and Biden across the country during their rallies, so you can expect them at the DNC.
They're fearing that it could be a repeat of 1968, and so they picked Chicago for the convention.
I think Chicago was picked before this.
All right, Anne-Marie Horton, we'll look forward to your coverage next week. She will be heading out there to the Democratic National Convention, and you can catch her every morning co-anchoring Bloomberg Surveillance as well. Still ahead, Rivian tapping the brakes on its Amazon delivery vans. We'll tell you why in today's Social Climbers. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. The top names in tech are on Bloomberg.
AI tools can help democratize storytelling and turn everybody into a creator. Our vision of the future is individual creators will look like Disney. They'll be able to go from an idea to a final story. They'll be able to publish that. They'll be able to merchandise it. They'll be able to do it across the franchises and stories they create.
Nobody covers technology like Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, BioNTech falling after the vaccine maker announced that its vaccine candidate for the flu and COVID-19 that it was, of course, jointly developing with Pfizer, it missed on one of its two main goals in a late-stage study. Next up, another roadblock for Rivian. The EV maker is pausing production of the electric commercial vans it makes for Amazon thanks to a parts shortage at its factory in Illinois. Rivian said it expects to recover all missed production, but provided no timeline. And finally, Bryant Riley, the co-founder and largest shareholder of B. Riley Financial, is informally offering to buy the shares of the embattled investment firm that he doesn't already own. Riley is willing to buy the stock at $7 a share, according to a regulatory filing. And of course, you can follow all the latest company buzz on TREN Go on your Bloomberg Terminal, Matt.
All right, let's get a check at what's going on in the markets right now. We are about an hour into the trade, and the S&P 500 is flat. The NASDAQ down about 0.1%, but also moving closer and closer to unchanged. Coming up, online invitations innovator Evite is enjoying a 50% revenue jump year over year, but they have stiff competition, and will they ever go public? We'll talk to the CEO, president, I should say, and a foe next. This is Bloomberg.
thoughts on fast fashion? It's been transformative. It gives the masses access to fashion, but
Short-term US Treasury yields turn higher on the day.
My first notice is too much waste. I think this is also how I grew up, making your own clothes and making something that's very special and very unique. It's like timeless. And now you see that everybody is looking the same, like wear sweatshirts and wear t-shirts. And for me, it's just like when they wear something very special, they feel empowered.
Is there a need for fashion to be more mindful of the impact it's having socially, environmentally?
Definitely.
Is it happening enough?
I think it's happening. It's gradually happening. All the designers are doing, everybody is thinking about this subject at this moment, thinking how to be more sustainable, how to be more environmental friendly.
Do you think the fashion industry is doing enough to ensure that it is sustainable? There's so many targets out there. Are they even realistic in wanting to achieve them?
I think some of them are just like they're using sustainable ideas as a marketing concept only. They're actually not really doing it. I think as a designer, it's really important to really make it happen. Every collection, I think about how to do it and how to tell the customers. I think that is our responsibility to educate our customers.
There is this real momentum from Wall Street. We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
Since joining Evite 2 years ago, Anda Foe has been on a mission to modernize the world's first online invitation platform. She's since taken over as the company's first female president, and business is booming. Evite has seen a 50% year-over-year revenue jump as it looks to stay ahead of its competition. And Anda Foe joins us now to talk about this growth story. Thanks so much for your time. Is the industry in general just picking up? Do we no longer send paper invites?
There's definitely been a definitive shift where a lot of people are switching over to digital. It's a new way to actually invite people to your party. And even beyond that, since the pandemic, what we've really seen is there's a shift in how America feels about get-togethers overall. People now value in-person events. They value community more than ever before. And a good sign is, this past graduation season, we've seen the highest number of graduation events in our history. People want to celebrate these milestones. Another trend that we're seeing across America, millennials and Gen Zs, they're turning these low-key get-togethers into thematic events. Some trending themes are Taylor Swift, no surprise. Summerween is another trending theme. But what this is telling us is that people not only want to celebrate milestones, but they want to make these casual get-togethers even more special, which means great business for Evite.
And I mean, you think about the competitive landscape, there's Evite, there's paperless posts. Those are the two big ones that come to mind. I mean, how do you compete? What do you offer, for example, at Evite that paperless post doesn't? How do you differentiate?
I think that's a very good question. Evite, we started with invitations. A lot of these competitors are in our invitation space, but we're thinking beyond that. It's the reason why we actually built a brand new tool. And this brand new tool is live on our site right now. It's called Evite Sign-Up Sheets. If you had an event that's catered around, say, potlucks, and you need people to sign up and bring an item, this is the tool for you. Right now, school is starting all across America, and a lot of teachers need parents to volunteer for their classrooms. This is the tool built for them. It's live on our site. It's the fastest tool on the market to actually get your sign-up sheet done. You could get it done in seconds, and it's absolutely free. And this is the way that we're starting to differentiate ourselves from our competitors, because we're building multiple products to actually help the community get together. We're building an ecosystem, a one-stop shop for all your planning needs. That's our biggest differentiator.
A company like yours, I would have said a few years ago, prime candidate for an IPO. Is that on the books? Is that not a great way to raise money anymore?
You know, we never say never. I think that's a great question. But right now, we are heads down focused, and we're doing so well on serving our audience and our hosts and our community needs. America is partying right now, and, we're just trying to help America party. So as long as we stay focused and build a really durable business, I think we let this journey take us where we need to go.
And I mean, how do you scale up here? I know that Matt doesn't think that mergers exist. He likes to focus on acquisitions. Would you ever consider one of those, for example, either being bought or buying another company to kind of scale up here and grow even further?
Yeah, I think that's a good question. We consider all options. At the moment, we never say no to anything. However, I think we just have so much opportunity to help our hosts and build this ecosystem that we are heads down focused to help our users. And, one motto that we have around our company, how can we always be helpful to hosts? And if we keep that in mind, I think all the right things and the right answers will follow.
Paperless Post, I guess, is your biggest, I think the only competitor that I can think of. Is this essentially a duopoly? Do the two of you fight it out for total supremacy?
Good question. But I think Paperless Post is in I think, slightly different strategic position than we are. We are still by far the largest online digital invitation. We are America's digital invitation company. We watch all of our competitors, Paperless Post, including other competitors out there that are emerging. Of course we do, and we take interest in it. But we are by far the most dominant player out there, and we're building our own strategy like this ecosystem to solve host needs. So we feel very strongly where we're headed and where we're going, and with that, we will remain the leader in this space.
When you're raising money, and I just wonder what it's like to be a woman in this business. I know the company was very happy to get you in there, and startups just have trouble attracting VC cash. I think less than 2% of VC money goes to female-founded companies. What's it like, in this growing tech business on the West Coast that has a kind of bro-y reputation?
I mean, of course, I can't say it's completely easy. It's definitely tougher for women out there. But I think in more recent years, there's definitely been more support overall. And I think what's really, really helpful in this particular space too, our core demographics are moms. I'm a mom myself, so I think I have a competitive advantage in particular for this particular company. But overall, it's tough, but you weather through it and then you prove what you're capable of doing. And I think I have proven by leading this company to where it is and the growth that we've seen that, we could hold our ground.
All right, Anda, really appreciate you taking the time on this Friday morning. That, of course, is Anda Foe of Evite. Let's get a check on these markets. Of course, a little bit over an hour into the cash trading session. We're going to do that with Abigail Doolittle.
And stocks on the day, or at least the S&P 500, sort of wobbling between gains and losses. On the week, though, we have a really healthy gain for the S&P 500, up more than 3.6%, heading to its best week since November of 2023. What's interesting, though, if we take a look at this one-week board, these different asset classes, it's a mixed picture because we have oil. That's a risk asset, a signal on the economy. It's down 0.8%, so not confirming the gains that we're seeing in stocks. The 20-year yield down, that tells us bonds are rallying, at least the 10-year out is rallying. And that also speaks to a bit of a haven bid. So again, not really supporting the move higher for stocks if you think about things in an upside, or excuse me, a right side world, not upside down as it is in terms of thinking about it around the Fed. And then interestingly, the dollar yen, after all of that big movement, this is one reason that we do have stocks higher, because that carry trade unwind, if there's more to it, there is reason to think that could be the case, certainly on pause. Now, if we bring Bitcoin into the picture, this is really very interesting. Bitcoin over the last 3 weeks down. This, of course, is a show more focused on stocks. So let's take a look at a proxy for it. Coinbase Global, over the last 15 days, down 16.3%. If you think about Bitcoin and the crypto space as the new VIX in terms of a risk-on, risk-off signal, this is risk-off. So when you put all of this together, I would say that there's probably more volatility ahead. Volatility breeds volatility. Last hour is promising an NVIDIA chart, an update there. Let's take a look at NVIDIA, and I actually even forget what I put together. Well, these are the sectors on the week, and you can see the big outperformance for tech. Now let's take a look at that NVIDIA chart. You can see all sectors are higher, but NVIDIA right now, even though we've had this massive recovery to the upside, this is a daily chart, and what we're looking at is these trend lines, as I was mentioning. It's not to see the trend, it's to see the reversal. So the primary uptrend out of the 2023 lows has started to reverse. The secondary uptrend, it is being caught right now in between. The RSI is
so the VIX set to ease for the fourth straight session, last down at 15.08 points.
3 trends. So we see the shares weakening, even despite the massive rally this week into earnings on, I think, August 28th. Stay tuned. There could be some more volatility ahead for NVIDIA, where maybe for one quarter out of the last, I don't know, 4 or 5, it's not the absolute blowout. Even very good from them could be disappointing. That may be what this chart is pointing to.
You know, back in July, Abigail, you were looking at the technicals. You told us NVIDIA shares were likely to go below 100, and I note they did actually close below 100 on Wednesday. I mean, intraday they dropped on a couple of different sessions. But what's the price action look like to you going forward?
Well, so that speaks to this reversal. So that primary uptrend reverse onto that low all the way down to 90. Now you have sort of Newton's third law, that equal and opposite reaction, back higher, some of the dip buying. However, we're hitting the resistance of that primary uptrend. Unless the buyers can really take it back above, let's call it, I don't know, 130 or so in a very convincing way, it suggests we're going to go back down toward the secondary uptrend, which is also below 100. There is a chance you could go higher and then below, but the bottom line is once you start to see an uptrend reverse like this, and again, it typically happens in 3 waves, it points to more selling ahead, which will be well below 100 at some point. That might not be on this earnings report, maybe later this year or early next year, but this uptrend is certainly starting to weaken.
Well, you're right in that NVIDIA does report on August 28th after the bell, so obviously a crucial one if you take a look at the charts as well. Bloomberg's Abigail Doolittle, thank you so much. Now, coming up, traditional media struggles to keep up with the big tech players. Former CNN President John Klein tells us why it's an industry-wide problem next. This is Bloomberg.
Names in global leadership are on Bloomberg.
We are 40 million. We're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the US. So I would like to understand, what would it mean to finish war fast? If Trump knows how to end this war, he should tell us today. Because if there are risks to Ukraine's independence, if there are risks that we will lose the statehood, we want to be prepared for this. We want to understand whether in November we will have the powerful support of the US or we'll be all alone. Only our lives are at stake here, and nobody can just trade our lives.
Nobody covers the top global leaders like Bloomberg Television and Radio. Day These CFOs focus on much more than just revenues and margins. Their impact goes far beyond the balance sheet.
The world is coming at us faster than it ever has. Our first job is to intimately understand and anticipate the consumer's needs.
You need to identify opportunities.
It's an incredibly fun job.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. New episode September 11th, only on Bloomberg. Brought to you by Workday.
For our Wall Street Week conversation, and it's been a tough time for media companies. Paramount started the week announcing a fresh round of layoffs and ended the week as the possible target of a bidding war. David Weston asked John Klein, the former CNN president, about the recent drama in the media space.
It's a problem with the industry that they find themselves in, is what it is. And this goes way beyond just Warner Brothers Discovery. So, in their case, they've got to swim in the same waters as every legacy media company. They've got a lot of brands. They've got a lot of assets. The main driver of their profit has been the cable TV networks, TNT, TBS, CNN, et cetera. And just the raw amount of revenue available to cable TV-driven businesses has shrunk considerably. The other component of their business, the studio business, same thing. Just the pool of money available for them and all of their competitors to make has shrunk. Subscriber fees that the cable distributors are paying have shrunk because viewers have left. So your monthly income on a per subscriber basis has plummeted. And as a result, also, advertising revenues have plummeted. And so, of course, you've got to retrench. You've got to make cuts. They're all doing it. You mentioned Paramount just began their wave of layoffs, their latest wave of layoffs today. And even Axios, which is a digital-only business, they've been through their biggest layoff in the past couple of weeks. So, in general, media is really coming to terms with the reality that it's more than ever an industry dominated by the tech giants, the Apples and the Amazons, and certainly Google, which owns YouTube, which is a monster. The industry is dominated by those players, and there's just less opportunity for content creators.
So what do you do in that environment if you're running one of these big media companies? I mean, I think both of our experiences, it's awfully hard to cut yourself to success. You may have to cut, but it's hard to get to success by cutting. Often you then start to think about deals, and John Malone, after all, is the force behind the throne there at Warner Brothers Discovery. Are there deals that could be done, consolidation deals, that might make things better?
Well, you're going to probably look to your left and your right to see who's in the same boat. I think that was their original strategy at Discovery when they did the acquisition of Warner Media, was to get big enough that they can maybe be the biggest kid on the block and dictate the terms of other acquisitions and start doing roll-ups of other players. Now they're not the biggest kid on the block. Now their market cap has taken such a severe hit that the deal numbers themselves are going to be much smaller, but that's what's going to happen is consolidation for all of these guys. You have a new team coming into Paramount, David Ellison and Jeff Shell, who's so sharp. They at least have the benefit of beginner's mind. That is, they can look at that Paramount portfolio of companies in a fresh way, and they also don't have the legacy relationships inside the company, and they can maybe make some tougher decisions. But it's tricky moving forward. Warner Brothers Discovery is going to have to find consolidation partners, merger partners, and just last month in Sun Valley at the big media conference, David Zaslav was bemoaning the excessive government regulation in his mind, that prevents them from making mergers too easily.
So it's one thing to get bigger. People like to get bigger. What about also getting smaller in this respect? Netflix has done pretty well for itself with basically, if I can put it this way, a movie studio hooked onto a streaming service without all those pesky linear channels that you and I have worked with through the year. Is that a strategy? You say, let's double down on the production and the streaming, and let's get rid of the businesses or do something about the businesses that aren't going anywhere. They're not growing.
Netflix has had the advantage always of being a tech-first company that applied that technology to media content and distribution. At first, just distribution, and now they're in the content business as well. And their market cap is, what, 20 times that of Warner Brothers Discovery at this point? And so they've got that inherent advantage. The problem is that everything we're seeing today is the result of the impact of technology on content distribution.
That was former CNN President John Klein. Wall Street Week's David Weston joins us now at the desk. And, of course, you are also the president of ABC News. You have some experience in this sector. I thought it was interesting that he mentioned David Ellison and Paramount. They have a job ahead of them because now we have learned that Edgar Bronfman Jr. may put in a bid for those Paramount assets as well. What do we know about this business?
Well, what I know about that specifically is that there's a go shop provision. Actually, they had to go ahead and take other offers for Paramount, and the special committee is taking a look at those offers right now. And now, as you say, Edgar Bronfman has come in. He's been in this business before. So obviously the board has to go through carefully and review this as a fiduciary about what the best deal is. So we'll see where it all ends up. As I say, Edgar Bronfman has been in this business before, but also David Ellison has a pretty good reputation, at least as a movie producer.
I mean, this is just the deal that won't end. How long have we been tracking every sort of turn here? And at this point, what are they fighting over? When you think about the fundamentals of the business, I mean, Paramount began this week announcing it would cut 2,000 U.S. jobs. It reported a second quarter loss after writing down the value of its TV networks by $6 billion. I mean, this is a really struggling business and a struggling, difficult industry.
Yeah, by the way, Warner Brothers Discovery also wrote down the value of their linear channels because they're recognizing what John Klein was just talking about, which is they just are not worth what they were paid for originally. You've seen this in the media business before, maybe not this dramatically, where there's a cost structure built up for a certain revenue stream. The revenue stream shifts, and all of a sudden you got to cut the cost structure. I mean, broadcast had this with cable because they'd built up a really big cost structure, and cable came along, started competing away some of the advertising revenue, as well as adding subscription revenues. They had to cut the heck out of the cost structure. And by the way, I had to do some of that myself.
I'm sure it was unpleasant, as it must be for Zaslav as well. Who are, the takeover prospects? Who's going to get together with these companies?
I think there are two questions there. One is, do they get together? I mean, I wouldn't be surprised to see a John Malone, for example, try to do something with Paramount and try to put together the streaming services of now called Max, giving up the HBO. I'm not sure about that, but giving up that and making it a Max.
Giving up the most important brand in media.
Yeah, certainly one of the most valuable. That's exactly right. But anyway, you could put some consolidation, but you have to think carefully. How often in history have you taken two weak businesses and put them together and made a strong business? That's usually not the way it works. I think the bigger question that John Klein was pointing out that I find very interesting is it really all up to the tech giants at this point? Is it all up to Googles and the Amazons? Because they have all the data. They also have other ways to make money. And so you leave the legacy media companies really going almost hat in hand to say, please help us out here some. And so, listen, the most successful media brand right now probably is YouTube.
Yeah, there you have it.
Right.
David, we have to leave it there. It is great to see you. That, of course, is David Weston. Of course, tune into Wall Street Week tonight at 6 p.m. New York time. This is Bloomberg.
covers earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Morning from our world headquarters in New York. I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
Well, leveraged single stock ETFs have boomed in popularity this year, and Defiance, a $1.4 billion asset manager, may have launched the most volatile fund yet in the U.S. Joining us now is James Seyffert of Bloomberg Intelligence. And of course, we're talking about 1.75 leverage of MicroStrategy, which is already kind of a leverage bet on Bitcoin. And I know that the Bloomberg Intelligence view is that these are trading tools. They aren't supposed to be held long term. But how much confidence do you have that people actually are treating them as they're supposed to be treated?
Yeah, so the benefit is we can see how much these things are trading, and they're trading a ton. So there's no way to know if there's some people out there that are just holding this long term. But for the most part, these single stock ETFs, they're being largely used as they're supposed to. But it's over a $30 billion industry right now, and these things charge a lot of money. So it's good for these issuers.
Where are you seeing the flow? What are the flows been telling us this week, James? I've always found that's one of the most interesting and important functions of ETF Go on the Bloomberg.
Yeah, I mean, right now, the money is, well, specifically with these single stock ETFs, the flows are going to these really high volatile names like MicroStrategy, names like NVIDIA. There's one NVIDIA fund, NVDL, it's over $5 billion, and that is the number one leveraged single stock ETF out there. But essentially, it's anything that has a lot of trading, a lot of controversy, Tesla, you name it, things like that. Those are the names that are going to get a lot of the flows.
All right, James Seyffert, really appreciate your time. That, of course, James Seyffert of Bloomberg Intelligence. And because of special coverage of the DNC next week, ETF IQ taking a break, but you can catch me the Monday after, the 26th, 12 p.m. Eastern. It's a great show, Matt. I don't know if you've ever watched ETF IQ.
In fact, I have co-anchored that show for quite a long time,
Yeah.
but I'm happy to leave that duty now to you, Scarlett Fu and Eric Balchunas, and I watch it every Monday.
As you should. Best 30 minutes of Bloomberg TV. Let's take a check of markets right now. Of course, the end to the week. You can see the S&P 500 down about 0.2%. The NASDAQ 100 down 0.3%. The bond market just about flat. Of course, whipsawing today as we get that back and forth data, Matt.
All right, coming up next week on Open Interest, join us in the C-suite where we will be joined by the Lifetime Fitness CEO on Monday as they announce the perfect new pickleball. Then Edbridge CEO Greg Abel on Tuesday. This is Bloomberg.
Arch has laid plenty of groundwork for future revenue. But for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York and San Francisco, this is Bloomberg Technology. Coming up, chips in focus as equipment maker Applied Materials, it disappoints on its forecast, while Texas Instruments scores cash from the CHIPS Act.
Plus, Epic Games launches a new mobile storefront after years of legal wrangling with Apple and Google.
And Seagram Air, Edgar Brundtman Jr. is close to making a rival offer for Paramount. Is a bidding war brewing? But first, let's check in on these markets because it is a good week. Ed, if you are long these markets, the NASDAQ 100 having its best week in the year. Since November, we're up almost 5%. That is a cool $1.3 trillion being added to the overall benchmark. And it is a significant, sigh of relief post-volatility of the last couple of weeks. Once again, we got some consumer data just showing sentiment is on the up-to-date. It counteracts some of that weakness in the housing data on the day. Look, we're just down a little bit on the day, but it is a strong week. What were you looking at on the micro, Ed?
I'm going to go straight to Applied Materials, and a company that makes the machines that make the chips. It's down 3%, beat in the quarter gone, but there were really high expectations in its forecast for the current period, where the market wants to see that all this investment around AI in particular is translating into more equipment or chip manufacturing equipment investment. We'll get to that in just a moment. The other top story in the semiconductor space, Texas Instruments, set to receive $1.6 billion in CHIP Act grants and $3 billion in loans, the Biden administration announced today. It marks the latest major award from the program that's designed to boost American semiconductor manufacturing. We're joined by Bloomberg's Ian King here on set in San Francisco. A lot of the money's been allocated. Texas Instruments makes all kinds of more basic chips. Just the terms that they've agreed with the administration here.
Yeah, I mean, the way to look at this is nothing is set. A lot of money has been promised. But from a taxpayer's perspective, it's like, okay, you have to do this, you have to go into production, you have to build this, and then we'll give you the money. So that's the way to look at it from a general perspective. The flip side of it, Wall Street is like, this is how many dollars, how many cents on the EPS that they'll be gaining, how much less CapEx they'll be spending.
Still, they are spending a lot. And it is all about the focus on chips at the moment and the focus on AI. Just take us back to Applied Materials for a moment, Ian, because, look, the numbers were good, but the forecast perhaps just not living up to the AI euphoria.
Yeah, I mean, there are two things going on here. Anything that's to do with high-end logic, which is for data centers and by extension AI, is doing really well. There's a lot of demand for that. On the flip side, some of the types of chips that, say, are for automakers or for industrial equipment, there's not a lot of strong demand growth there at the moment, so perhaps machinery orders for that particular sector were a little bit weaker. There's kind of a balance of factors going on there.
That automotive part's kind of consistent with NXP, that we've heard it on an ongoing basis. Just real quick, what's the difference between Applied Materials and ASML? You know, if you think about what those machines are actually used for.
Yeah, I mean, think about Applied Materials as much more generalist. They make a whole range of different pieces of equipment. ASML is very specific. It's making lithography. They're essentially the lasers that are burning the holes to make the pattern on the chips. Applied Materials is putting materials on those silicon wafers.
Bloomberg's Ian King, thank you very much. Let's take a closer look at chips globally. Japan is applying foreign trade regulations to chip-making equipment as part of its effort to secure stable supply chains, the Ministry of Finance said earlier today. Foreign investors are now required to give prior notice when conducting direct investment in equipment tied to chip-making. This is in an effort to address the risk of key technology leaks. An interesting global story, Karen.
And so much going on with chips. In fact, overall, they are weighing on the overall benchmarks today because of that Applied Materials number. Just get a broader look at the tech market right now. Janet Muir is with us, RBC Bruin, Head of Market Analysis. And Janet, we've had an extraordinary few weeks, to put it bluntly. What are you making of AI euphoria reality and what it means for the tech benchmarks right now?
Hi, good morning, Caroline. Thanks for having me. I think one thing is that the valuations of some of these mega cap stocks and AI exposed stocks have come down. I think that is good news for investors who are not invested yet. They can actually get in with a better valuation into companies that still have great long-term prospects. And I also think that the rebound, the very quick rebound that we've seen, suggests that, if the data is okay, continues to suggest that the US economy is still growing, there's still a lot of demand for these high quality stocks. And I would say our position would be to keep being focused on high quality growth companies, which a lot of these AI exposed stocks are. And I think some of the observations from companies' guidance, from the big tech companies, for example, is that they prefer to actually spend more on AI instead of being left behind. So I think that this is still very much a very important trade.
Why then was everyone suddenly so nervous around it, Janet? Why do you think that, we're still 12% off of our highs on the SOX index, but why haven't we managed to rebound to the extent that has your level of conviction?
Yes, I think, so generally speaking, a lot of focus is still placed on the economic data. We got some relief, I think, in the past week or so with solid economic data and slowing inflation, but I think there's still uncertainty surrounding that. I think particularly for chip companies, I think the politics of that still play a pretty important part. I remember when ASML report, and then there is this suggestion that Donald Trump is going to make it stricter for US companies to export high-tech equipment and things like that. And also, of course, the Biden administration tightening the stance. I think these are still ongoing concerns. So I think that is the reason why the chip makers are not bouncing back as much as the other wider stocks.
Janet, hi, it's Ed in San Francisco. I've been reading your research and you've been thinking about REITs, real estate investment trusts. So have I. And I've been writing about how you can look at their pipeline in the context of data center investments. I didn't realize it was such a focus of opportunity for some of the REITs out there. Is that an area that you look for data sets to kind of work out how long this investment cycle has to run?
Yes, I think in terms of REITs, I think data center is one of the more resilient areas actually throughout the previous sell-off. I think that is still a very valid investment point. But what we're looking at in terms of REITs is basically broadening out of the other REITs area because simply the valuation has gone much more attractive. And I think particularly right now we're at the stage where the Fed is going to cut interest rates, and expectation is building that there will be further cuts well into 2025 and beyond. So I think, Greece being a very interest rate sensitive sector is likely to benefit from this monetary policy development. And I think the valuation is just, adding to that attractive thesis.
Earlier in the show, Caroline was looking at the NASDAQ 100 on the weekly basis. We've had a lot of conflicting economic data. What has the data all told by Friday afternoon told you about the state of the global economy?
Well, I think everything is still fine. I think the labor market is obviously slowing down, but it is actually as expected. And in fact, it is a trend that the Federal Reserve would like to see. If you look at the job openings per unemployed person, it is going down, but it is basically what I would describe as a normalization back to where it is pre-COVID. So I think this is all positive development. I think we're seeing a slowdown in consumer because the savings are being depleted. But I think the key thing is that real wage growth is very much positive. I think that is a very fundamental supportive factor out there. So overall speaking, the economy is still fine, slowing, but as expected, and we're not seeing the economy falling off a cliff. And soft landing is still very much in play here.
Janet, what is then the most important piece of data in the next few weeks? Is it Fed macro? Is it August 28th NVIDIA results?
Yeah, NVIDIA is definitely a very important corporate earnings. I think, that would be a very important point for us to watch. Basically, we know the volatility around that event and the ability to actually spill over to the rest of the mega cap industry. And also, investors will be seeking validation on whether that AI orders is still very strong. And of course, I think any data that relates to the labor market will be a big focus. I think inflation side of things, we got more confirmation that is okay and unlikely to see volatility around inflation. So I think labor market data for sure.
Such a good question by Caroline, though. August 28th, NVIDIA, a macro level event, maybe. Janet Mui, RBC Bruin, Head of Market Analysis. Great to have you back on the show. Thank you very much. Now, coming up, we're going to be joined by Josh Chapman, who is a managing partner at Convoy, a firm focused on the video games industry. And we're going to discuss Epic Games' new mobile storefront, which is out today. By the way, heading to break, we're looking at shares of Rivian. I broke this story overnight with Kyle Porter that they've had to pause the line that makes the delivery vans for Amazon due to a part shortage. The stock declines have really accelerated in the session, almost 3%. It won't affect long-term their production targets. They'll make that up. They're not changing guidance and all the workers we've paid, etc. But it's interesting that this continues to be an issue in the supply chain for Rivian, such a closely watched EV name. Keep tuned, stay tuned. This is Bloomberg Technology.
Is the Vivian Tom clientele?
Yeah, power women, like the dragon women. They're lawyers, they're CEOs, they're all important decision makers, women in the world.
Why do you position your products for this group of women?
When I started, designing, I always want to do something that is empower women.
When you take a look at your store, there is something for everyone. Take a look at the T-shirt, for example.
My customer growing, like 30 years already, so they become more powerful. I also want to grow my Gen Z audience too, they're like in the 20s, so it's a more affordable price for them. And then, my powerful women's daughter wearing their mom's dresses, and they feel that the power, the energy. So now they come back to the store and they buy more.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
Epic debut for Epic Games. The Fortnite maker is launching a new mobile storefront after 4 years of legal wrangling with Apple and Google over their App Store practices. Now, the Epic CEO is saying it may have lost up to $1 billion in revenue after Fortnite was removed from Apple's App Store when Epic tried to circumvent that fee with its own storefront back in 2020. Joining us now, Josh Chapman, managing partner of Convoy. And look, it's returning to iPhones in Europe, to Android devices worldwide. Can people get it, access it? What's the pickup?
Right now, you can only access the Epic Games Store in the EU if you're on the iOS and globally on Android, as you mentioned. It is an absolute pain to download on both stores. So Apple and Google are fighting this tooth and nail. I just watched some videos that came out this morning. We're going to be trying it all day today. This is requiring anywhere from 10 to 20 steps. There's lots of flags and alerts on both phone devices saying, hey, are you sure? Are you sure you want to download this? So these stores are going to fight this tooth and nail.
An Apple spokesperson clarified to Bloomberg that it is a 5-step process in Europe at least, not 15. I'm glad to have you on the show, right? You're a firm that invests in video game startups that want to disrupt the industry. That's what Tim Sweeney's trying to do. The argument that if you have more stores, you have a more competitive market, $180 billion video games market, half of which is mobile. Is he right about that argument?
He is right that it is better for the games industry if there are more stores, more options, and more competitive pricing. That said, I think what he's fighting for is fantastic and will be positive. And this development today is positive for the games industry. That said, Apple is well within their right, having the platform they've built, to defend it as much as they can. And so the courts of the U.S. have decided that, yes, they're not a monopoly, but they have to allow for third-party payments to be processed. Essentially, the way I read that and the way we read that as a firm here at Convoy is that that's kind of a meet in the middle, right? Let's let them do off-platform payments, but you're not a monopoly and you got to let Epic Games launch a store on your App Store.
I mean, the reason that this is happening for iOS in Europe and not here is because of the Digital Markets Act and the fact that Europe's decided that Apple is acting as a gatekeeper in some way, Google too, with these app stores, and they've got to change. But quite often what happens in Europe ends up happening here in the US. So if you're saying they're pushing and fighting tooth and nail, will we ever see it occurring here in the US unless there's our own antitrust issues that are set to bear here?
So it took about 4 years to get to this point just in the EU. So I think that we're looking at another, just a prediction, 3 to 5 years before we see this really happen in the United States, unless a huge ruling comes down from the Supreme Court in the United States if they decide to take this court and take the appeal, which they rejected, I believe, earlier this year or last year. And so I think we're looking at a very long, drawn-out battle. And in the meantime, Apple is making billions and billions a week off of the App Store. And about 60 to 70% of all revenue on Google's App Store and on Apple's App Store comes from the video gaming space alone. And so the reason why they're fighting,
Well, let me just jump in, and Kara, I'm sorry about this. We're talking about that Apple side of the story. Let's be under no illusions. Epic want to make money from this arrangement, right? They have the target of 100 million downloads by a certain period of time. Ambitious. Will they be successful is the question.
I think Epic Games is going to make a lot of money off of this move today. I think they'll make it primarily through Android globally. And then I think they'll secondarily make it on iOS. I think it'll be in that order of magnitude. But Epic Games, as a private company that owns Fortnite and Rocket League and Fall Guys, they have now recently launched UEFN, which is basically their Roblox competitor. They watched Roblox have success, so they're launching their own sort of user-generated content platform. This is a continued effort for Epic Games to increase their margin profile. Mobile is a perfect way to do that. And whether that's an acquisition or an IPO in the future, Epic Games is playing their hand very well, and this will work out in their favor for sure.
I think the data showed that some 35 million people played Fortnite for more than 600 million hours in July on Xbox and PlayStation. Just give us the context of how popular Fortnite is compared to the rest of the gaming landscape.
Before Fortnite was kicked off the App Store, we as a firm did an estimate that Fortnite was responsible alone for almost 1% of all revenue on the Apple App Store before it was kicked off. That was sort of an estimate that we kind of did internally. The significance that Fortnite is as a title on console, which you just mentioned, is absolutely massive. And on mobile, which is more accessible globally around the emerging market countries, especially, which is why Android's important, Fortnite is one of the top 5 forever titles. We call them forever titles in the gaming industry in the world, right? Alongside that is things like Call of Duty and Grand Theft Auto and many others.
Josh Chapman, managing partner at Convoy, a particularly great voice to have on a day like today. Thank you very much. There's another big story in the world of entertainment. We're looking at Paramount. Seagram heir Edgar Bronfman Jr. is close to making an offer for Paramount Global, setting off a potential bidding war for the film and TV company that owns CBS and MTV. Let's get to Bloomberg's Hannah Miller. And Hannah, I'll say the same thing to you I said several weeks ago. I'm confused and I have deja vu. So there's a new bidder and then another bidding war. Good morning.
Yes, good morning. We know Bronfman has been interested in Paramount for a while, and things have shifted since then. Obviously, there's the Skydance deal that has been agreed to, and that there's this 45-day go-shop period. So it looks like Bronfman is going to put in a bid. But unlike his earlier interests, he is no longer working with Bain Capital on this and has been in discussions with a couple of different entities, including Roku, Fortress, and the film producer Stephen Paul.
So I'm sat here as a B-class shareholder, not voting, trying to work out what ultimately is going to be better for me. How does he push away from what David Ellison is going to offer in terms of technology, in terms of studios? How is he going to make a different kind of appeal?
Yeah, so, Bronfman is coming in with years of experience in the media industry. He's arguing that this is a better deal for shareholders. He is saying that he can take this company to the next level and putting this potential bid together. But it'll be interesting to see what happens. Ultimately, it's up to Sherry Redstone. Her holding company, National Amusements Inc., is the biggest shareholder in Paramount. And what she says goes. If she prefers Skydance, that's what it's going to be.
Hannah Miller, telling it straight, we thank you so much. When we're coming up, we're going to talk influencers influence the selection cycle with LTK co-founder Amma Vensbox. Stick with us. This is Bloomberg Technology.
I think most investors are intoxicated by the opportunity in artificial intelligence. $160 billion being spent this year. That's just one data point. Another data point is a $3 trillion market cap for NVIDIA against $80 billion of sales on a trailing 12-month basis. Obviously, a lot of growth is expected for NVIDIA and for other businesses in the space, but that is yet to materialize, and it's impossible to know what the scale will be of an NVIDIA or other players in the artificial intelligence ecosystem. I think investors are just so focused on the opportunity set, on what it can be, and it's a self-fulfilling prophecy. If you bought NVIDIA a year ago or 2 years ago, you're pretty excited about where it is today, and you think that it could go to the moon. As a result, you don't really focus on the risks. You're sort of just too excited about the opportunity.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching The Close.
Welcome to Balance of Power.
This is Bloomberg.
Let's talk politics and creators, because as the election campaign picks up, the creator economy has been, well, on the administration's mind. 200 content creators will be credentialed to cover the 2024 DNC in Chicago next week. This follows, actually, the White House itself hosting the Creator Economy Conference, where it convened a group of digital creators and professionals to discuss the industry's most pressing issues. Let's talk about it with LTK co-founder, President Amber Vens-Box, who you weren't there yourself, but a lot of the influencers that you represent, that you help monetize, were there. Why is it important? Why are we seeing such political interest in the influencer economy right now?
Well, our LTK team was on the ground. They were there. And, you know, when I think about creators and politics, I don't know of any better marketing machine than the RNC and the DNC. And what we're seeing is that even government is realizing that in order to reach people, you need to be where they are. They're spending 6.5 hours a day on their phones. They're in these aggregated content channels. The content that they're viewing is created by creators themselves. The new media has arrived. It's here. And it was hugely validating for the Creator Economy Conference to be held at the White House. This is an industry that we started 13 years ago. The word influencer was only added to the dictionary 5 years ago, so we've come a long way. This was a really big moment for our entire industry.
Amber, can I get political with you for a moment? I don't want anyone to take sides, but just from a perspective of a creator, an influencer, who's doing it better at the moment? Who's managing to reach the US voter base via influencers most efficiently? Is it DNC, Democrats? Is it RNC, Republicans?
You know, both are using these tactics, and they've both used them for the last several elections, and we've seen it across all of the different platforms. That said, I think really this is important for the entire industry, whether you are someone who, as a creator that is following politics, who is reporting on politics. It's a validating moment, and for some creators, they don't want to touch the elections at all.
Okay.
But I think what this points to in this moment is that they're looking to see that this industry is important and that they need to be thinking about the things they're thinking about. And there are definitely a handful of things that are top of mind that we showed up in Washington to talk about.
What are the protections here for voters that creators, as we are calling them, get it right, that it's accurate, that it's not false or fake information?
Well, you know, for our creators, Joe Biden stood up and he said, you know, you are the new media. You're the new way that people are being reached. We know that people are not just listening and thinking about sentiment, that they're actually acting on the things that their influencers that they follow are telling them. We're seeing that, you know, consumers are buying $5 billion worth of products from these creators every year. So they're voting with their wallet and not just with their mind. So there's a huge responsibility that comes from being a creator, and the acknowledgement that this is the new media is one of the most important things. As a creator, there are really three key things that are top of mind when it comes to politics. I'd love to share that if you guys are interested.
Just 15 seconds, just go.
Wonderful. Well, we're thinking about the content that's taken and monetized directly and indirectly and without a license, without permission or benefit to that creator. We're thinking about the implications of creator content being taken to train AI, again, without the license, permission or benefit to the creator. And then I think finally, it's really important that this industry was built on innovation. How are we protecting the innovators who are creating it? And that's really in the court system, through legislation. Thank you so much.
Okay. LTK co-founder and President Amber Vens-Box. Sorry we ran out of time, but thank you for coming on the show. Coming up, we're going to take a deep dive into software company Autodesk's somewhat controversial sales strategy. That's next. This is Bloomberg Technology.
So a number of people, I think from Homeland Security and or the CIA or NSA, have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements, and TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money. If I had invested with you, which I wish I had, what kind of rate of return would I have had over that 10-year period of time?
Over 100% a year on average. On average.
100% a year, that's pretty unusual.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco. I want to go back to the chart you showed at the top of the show, the NASDAQ 100, but on a 5-day basis. We're actually on track for a second consecutive week of weekly gains. But 5% over 5 days is actually the biggest weekly gain on that index since November of 2023, and it's amazing how the narrative changes. It was just 2 weeks ago that we'd had 4 straight weeks of declines, and we were perilously close to a 5th straight week of declines, going back the worst run since 2022. Economic data is really whipsawing us about, and as you pointed out, August 28th and NVIDIA earnings is this macro level event. There's a really big story out there in a specific mover. Autodesk continued to use a controversial sales strategy after promising investors it would stop and then ignored internal warnings about the risks of doing so, according to previously unreported internal documents. The reporter with those documents, Bloomberg's Brody Ford, this is so interesting. So basically, management had been told, don't use this, there are risks. They carried on using it, and you found out about it. Take us from there.
Yeah, taking a step back, in April, Autodesk said, yo, we cannot file our financial disclosures. We'll come back to you. And the whole market said, oh my God, what's going on here? This is unheard of for this size of a, publicly traded company. Eventually, they said that, yeah, we had some problems with these deals, but it was still somewhat vague. And so what we found out through these documents is that Autodesk pledged to stop doing a specific kind of deal that essentially front loads the cash flow. I'm not going to bore with the details, but they kept doing it quietly. And the reason they kept doing it is because they were reliant on these deals to meet free cash flow targets, right? We see in these documents that employees warned executives, hey, this might hurt our long-term revenue. This increases the chances of us making a serious mistake, maybe like the one we saw earlier this year, but they pledged on because, you got to meet those financial targets.
But this had big ramifications. The accounting probe finished in May. The board decided to remove the Clifford as CFO. I mean, what more could they do to make everyone take this seriously?
Correct. Yeah, they removed the CFO. The board decided that a little bit earlier this year. And since then, activist investor Starboard has entered the stock, saying in part the handling of this probe was not good enough, that investors didn't get enough accountability. They didn't really know what happened. How wide was the pool of knowledge here? And again, what these documents show is that the pool of knowledge was quite wide. I mean, we see executives signing off on these deals saying that, hey, we got to meet these targets, let's pursue them. In terms of ramifications, Starboard is requesting things like considering whether the current CEO is still the right guy for the job, as well as the kind of traditional activist stuff like let's raise margins and, all that kind of thing.
Brody, real quick, and forgive me this one, just the basics of what Autodesk is and does and why people might or might not know it.
Totally. Autodesk is like Adobe for the physical world. That bridge behind you, probably Autodesk was used in some capacity to design it, right? Most buildings you see, their software was designed for. They have a very interesting vertical that they really own. It's one of those kind of large software markets you almost don't think about because they are so entrenched in their market. It's a very interesting set of products they offer.
Bloomberg's Brody Ford with another top piece of reporting, Caro.
Yeah, absolutely on it. Meanwhile, just switch gears, Ed. We're going to look at fintech for a moment because Revolut said that a secondary share sale that allowed it basically to give employees some liquidity for their stakes valued the company at, get this, $45 billion. The new valuation for the UK unicorn is up from $33 billion price tag that it received back in 2021. And actually, that's the interesting point here. Unlike many of its rivals in fintech, Revolut hasn't had to raise money since then in recent years. And it's allowed it to basically avoid those sharp declines in valuation that many peers have suffered. But at the same time, let's go to another peer. Let's go to a European fintech that's seeking liquidity, and it's Klarna, and it is inching ever closer to its US IPO next year, with sources saying that the company is seeking a valuation of around $20 billion. Now, the Klarna CEO joined Bloomberg Daybreak Europe earlier today to discuss those plans and his outlook for the company. Just take a listen.
People really appreciate mostly about Klarna is that 2 years ago, this business was, very much attractive, growing fast in the US, but also loss-making. And in just 2 years, we have increased revenue by 50%. We have increased gross profit by 100%, and we reduced cost in 30%, which means that now we are, profitable. And I think those kind of financial performance obviously do raise the eyebrows a little bit with investors. Also, as we have, due to AI, committed to continue shrinking the company. We've already gone from 4,500 to 3,500 in the last year, and we are committed to continuing on that path, not by layoffs, but simply by natural attrition rates.
You've been an early mover on Gen AI, and you reached out to Sam Altman of ChatGPT, OpenAI, pretty early on in all of this. What's been one of the most surprising things that stood out to you as you've embedded some of this Gen AI across the business?
Yeah, I think that it is, to me, in a way, I would actually partially say that, like, I was even, kind of pulled into the hype a year ago, where a little bit like, again, self-driving cars, we used to read about them in the press every day, and then you would look out the window and like, where are they? Where are they? It's not happening. And now it's actually happening. And I think that, like, to some degree, I was almost like drawn into the hype a year ago as well. It's like, okay, in a year, the whole thing will already have like totally dramatically changed everything. And now you almost have the opposite. You hear people like, oh, we tried it, didn't give us the results and so forth. But internally, what I'm seeing at Klarna is that it is working. It's just, it will take a little bit further time before it will have the full implications. To us, we've already delivered some fantastic results, but we're super excited what's coming in the next 12 months.
Before we let you go, Sebastian, look, what do we win you back? You're going to list in the US. That's the suggestion. That's the expectation. What does Europe and the UK need to do? Is there anything they could do to win this listing?
Well, one thing that I have said to regulators in the EU, because there's been so much discussion in Brussels as well, how do we create a competitive market? And I have suggested, and I actually got some positive from some of the foreign ministers. I was invited by all the finance ministers of EU, is that I think that if Europe will never agree on like where should the big stock market be? Is it Paris? Is it Frankfurt? Is it whatever European country? So the only way to actually get this to work is if you would mandate all the stock exchanges in Europe so that any stock that gets listed in one is automatically traded in another. I think that could reach the critical mass to create an investor base that is of similar size than one we see in the US, because that's really one of the biggest challenges when you make those comparisons. If a company like ours is already mostly US business from revenue size, it will have to be a similar size of investment base and stock market size to make it a relevant listing point.
That was Klarna CEO Sebastian Szymiatkowski. Coming up on the program, we're going to be joined by Hiba Anwar from the Ericsson Immigration Group to discuss the impact of the election on H-1B visas and, in turn, the world of technology. Caro.
I just want to go back to that question of dual listings and what certain nations and territories have to do to woo over other companies. Because get this, AvePoint is a New Jersey-based company, software company. It's considering actually a second listing outside of the US in Singapore. People with knowledge of the matter have been saying it would be a deal that basically would bring US infrastructure software firm a step closer to some of its big backers. Remember, they had a big chunk of change from Temasek. This is Bloomberg Technology.
How can you have dinner with friends without hinting what you're thinking about? And do you ever get suggestions from your friends at dinner, this is what you should do? And how do you respond when they kind of say, maybe you should lower interest rates? You just keep eating or what?
You might define the word friend to mean doesn't ask you about interest rates. So, no, people don't do that generally. You know, people I don't know will always say, hey, cut rates. Somebody said that in the elevator this morning.
Did that influence you or no?
I said, thank you, sir. You know, and no, but I mean, you know, people say things, but you know, it's fine.
So in some parts of the society these days, people are making decisions based on something called artificial intelligence, AI. Have you thought about, you know, calling up ChatGPT and saying, you know, here's all the data we have. What do you think about it would be a good idea? Have you ever thought about that, or they're not going to likely do that?
We haven't done that. I mean, we have done little things like we've asked ChatGPT to generate questions for the press conference. And I'm happy to report for any journalists who are here that the questions were not as good as the ones we get from real journalists. So,
what about my questions? How do they compare to my questions? Okay.
No comment.
Right, so they weren't that great. Okay.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. Billionaire Gautam Adani founded one of India's biggest and most controversial business groups. After being rocked by accusations from short seller Hindenburg Research last year, Adani is now preparing for the company's future in a real-life succession story. Meet the family members he's handpicked to take over the business as we deep dive into the facts and rumors surrounding the Adani Group. Inside Adani, a Bloomberg exclusive, replays all weekend only on Bloomberg.
The H-1B visa policy is really critical for the tech industry, and Trump does not have a positive track record there. So I think having a president who understands the importance of immigration in this country is really critical.
Venture capitalist Shruti Shah, one of the signatories of VCs for Kamala Group, supporting the campaign of Kamala Harris. And as we look ahead to the DNC, that starts next week, H-1B visas, are they going to be a topic that's top of mind? They certainly are for the tech industry. Let's bring in our next guest to discuss. Hiba Anwar, partner with the Ericsson Immigration Group. And I ask you there, Hiba, will we get much clarity? Do you need more clarity from the position of the immigration from the Democratic ticket?
So I think that the companies that operate in the tech industry, as well as the AI industry, semiconductor, basically any industry in which the United States wants to be a global leader and continue to dominate, they're definitely looking for a lot more clarity when it comes to what the next president's policy is going to be with respect to high-skilled immigration. And the reason that this is so important for companies, particularly in the tech sector, is because there is a heavy reliance on visas like the H-1B visa, because when it comes to employees who have the necessary STEM skills that these companies are looking for, demand still very much outweighs supply. And so whoever the next president is going to be, it's really, really important to point out that what we really need for the success of the tech industry and other industries is an immigration policy that actually reflects a 21st century economy.
Hiba, former President Trump actually gave some detail on how he'd approach visas, particularly those originating from students of US universities, on the All In podcast, and then he discussed it with Bloomberg in July as well. Have you had any detail or sense from the Harris ticket on a specific approach to technology-relevant visas?
So what we know about Vice President Harris is that she definitely has close ties to the tech industry. There were 200 tech leaders who came out and endorsed her publicly. Now, as you mentioned, the DNC is right around the corner, so we're definitely going to learn a lot more here in the next few days. But, you know, what most people are expecting of Vice President Harris is that she's going to continue President Biden's approach to high-skilled immigration. And President Biden's approach has been, in large part, walking back Trump-era policy.
I wondered if we could sort of take a bipartisan look at the mechanics of getting a visa and the federal administration of visas. I got my first visa in 2018 under the Trump administration and had to renew it in the chaos of COVID. But how easy procedurally is it now in this state right this moment to get an H-1B?
So it's not necessarily as difficult as it was during the Trump administration. The experience that a lot of immigration practitioners had during the Trump administration was that the process was a lot longer and it felt somewhat inefficient. I think that that's why it's really important to watch what the results of this election are going to be, because some of the concerns that the companies have experienced is whether or not policy pertaining to H-1B visas and other policies surrounding high-skilled immigration are actually going to act as a deterrent and discourage high-skilled talent from coming to the United States and making the United States their home. And if that happens, then companies are going to run into issues in terms of whether they can remain competitive, because they may not necessarily be able to hire the best and brightest from around the world.
And perhaps we see what occurred back in previous administration, where Canada suddenly got a lot of high skill, perhaps, versus the United States. What about other types of visas? We all focus in so much on an H-1B, but I came in 2018 on an L-1. I mean, how many other routes are there to be and contribute to the U.S. economy?
I think that there are several other routes, but the eligibility standards are a little bit more controlled and restricted, and that's why the H-1B visa is so important. It's the type of visa that a lot more people could potentially be eligible for, and as a result, it's the most frequently leveraged employer-sponsored visa by several industries, including the tech industry. And so with respect to policy when it comes to high-skilled immigration, you know, rules, policy surrounding H-1B visas is definitely going to be top of mind. It's really important to continue to have immigration policy that actually encourages talent to come to the United States and innovate, because the next time somebody, you know, founds the next Google or the next Tesla, we still want that to be an American company.
Hiba Anwar of Ericsson Immigration Group, thank you very much. There are other news headlines out there in the world of tech, Caro.
Yeah, it's time for Talking Tech. First up, we're going to discuss SpaceX announcing it will launch a methane satellite to track superpolluters. Now, Carbon Mapper is the nonprofit behind the satellite, and it will be the second methane-detecting satellite launched in the past 6 months. This reflects basically growing scrutiny around the greenhouse gas and the satellite's low cost to atmospheric monitoring. Meanwhile, EU tariffs, they're slowing the influx of Chinese-made EVs in July. Now, according to research from Dataforce, the number of new electric vehicles from Chinese manufacturers registered in the EU fell 45% in June. Look, that's as car makers actually rushed to get their products to dealers before the tariffs took effect on July 5th. And Jack Ma, well, he's backing, of course, Ant Group, and it's said to be in discussions to acquire Chinese healthcare platform howdf.com. That's according to sources. Now, Ant Group is seeing and looking to integrate its tech within the website in an effort to basically beef up its AI services in healthcare. Ed.
Coming up on the show, we're going to dig into the WorldCoin project and its mission to tell the difference between man and machine. Co-founder Alex Blania joins us next. This is Bloomberg.
In global leadership are on Bloomberg.
We are 40 millions. We're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the US. So I would like to understand, what would it mean to finish war fast? If Trump knows how to end this war, he should tell us today. Because if there are risks to Ukraine's independence, if there are risks that we will lose the statehood, we want to be prepared for this. We want to understand whether in November we will have the powerful support of the US or we'll be all alone. Only our lives are at stake here, and nobody can just trade our lives.
Nobody covers the top global leaders like Bloomberg Television and Radio. The names that move markets are on Bloomberg.
Don't expect we're going back to zero, because zero was the product of huge global shocks. I think to get to there, something really bad has to happen that we're not currently expecting. So it'll be somewhere, somewhere obviously in between. I think we've made a big point of saying policy is currently restrictive, so you can deduce from that we'll be lower than where we are today, but I think it's very clear that we're not going back to zero.
Bloomberg. Context changes everything.
The orb before you is made by a startup called Tools for Humanity. If it looks all too dramatic, that's sort of the point. The backers of the company, which include Sam Altman, the CEO of OpenAI, have put $250 million into this venture and want folks to take notice of their orb. This is because they want to use it to scan the irises of as many people around the world as possible, all as part of their main project, known as WorldCoin. If you allow WorldCoin to scan your iris, two things happen. You get a small chunk of the WorldCoin cryptocurrency, and you're certified as a real living human, which the company hopes will lead to a reduction in fraud on the internet and provide better access to banking and social services. Critics, however, are wary about the ethics of biometric collection and the possible exploitation of users from developing countries.
You can check out the full episode of that Bloomberg Originals piece on Bloomberg.com. And joining us now is the co-founder of WorldCoin himself, Alex Blania. Alex, welcome to Bloomberg Technology. In Ashley Vance's very detailed Business Week story, he talks about how when you describe WorldCoin to someone, the project, it can sound nuts. And you were cited as saying that you think there's just a 5% probability, that you'll succeed. How do you arrive at that number?
I think it's just a very ambitious project, and Ashley and I talked about massive success, so like a large percentage of the kind of people in the world actually signing up and verifying with our services. I think that's just a low probability. I think we will increase the probability over time and do our best to succeed. But I think with every kind of very ambitious technology company, that's probably what you're looking at. And I just try to be realistic about that.
Give us the elevator pitch of what success.
We will need such technology, and I hope we can contribute with that.
Alex Blania, come back on as you continue to build the amount of people using it. Of course, co-founder of WorldCoin and Tools for Humanity. We appreciate it. Meanwhile, that does it for this edition of Bloomberg Technology, Ed.
Another week of earnings, economic data, and innovation. Recap it on the podcast. You know where to find it on the terminal, Apple, Spotify, and iHeart. Big thanks to the team in New York City with Caro and out with the crew here in San Francisco. This is Bloomberg Technology.
the Vivian Tom clientele.
Yeah, power women, like the dragon. Dragon women. They're lawyers, they're CEOs, they're all important decision makers, women in the world.
Why do you position your products for this group of women?
When I started, designing, I always want to do something that is empower women.
When you take a look at your store, there is something for everyone. Take a look at the T-shirt, for example.
My customer growing, like 30 years already, so they become more powerful. I also want to grow my Gen Z audience too, they are like in the 20s, so it's a more affordable price for them. And then, my powerful woman's daughter wearing their mom's dresses, and they feel that the power, the energy. So now they come back to the store and they buy more.
The top names in tech are on Bloomberg.
AI tools can help democratize storytelling and turn everybody into a creator. Our vision of the future is individual creators will look like Disney. They'll be able to go from an idea to a final story. They'll be able to publish that. They'll be able to merchandise it. They'll be able to do it across the franchises and stories they create.
Nobody covers technology like Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Today's CFOs focus on much more than just revenues and margins. Their impact goes far beyond the balance sheet.
The world is coming at us faster than it ever has. Our first job is to intimately understand and anticipate the consumer's needs.
You need to identify opportunities.
It's an incredibly fun job.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. New episode September 11th, only on Bloomberg. Brought to you by Workday.
From New York City for our viewers worldwide, I'm Bonnie Quinn. Bloomberg Real Yield starts right now. Coming up, conflicting economic data. As consumer sentiment rises, housing starts fall. The data come 1 week from Powell's Jackson Hole comments, setting the stage for an expected September rate cut. And U.S. junk yields hit the 2024 low as that Fed easing looms. We begin with the big issue, reading this week's economic data tea leaves.
We're moving in the right direction.
I think it's pretty good news. For now, we're in good news is good news land.
So long as we have signs that economic growth stays above zero, we're in that soft landing zip code.
So I think this is definitely the inflation report that the Fed is looking for.
They want to cut rates. They're probably going to cut rates in September because they've opened the door wide enough to, bring a Mack truck through.
Either way you want to put it, that's going to be bullish for bonds over time. But we don't think that right now the economy is screaming for the rate cuts.
We think 25 is the right first step towards easing policy.
So our base case remains for a 25 basis point rate cut in September.
I think they're in a fine place at this point in time, and Chair Powell at Jackson Hole can help guide us on how they're thinking.
It seems to be so difficult to read this economy right now, as evidenced by the two-year yield. Let's look at the two-year yield over the past 11 days. That's right, 11 days. As John Authors of Bloomberg Opinion says, what a strange route it's been. As you can see, that was the jobs report. We were down about 20 basis points. We're already up to practically where we were before that jobs data, very close to 4.15 on the two-year yield. And that's in spite of very mixed economic data. And then the market is having difficulty pricing in how many Fed rate cuts we're going to have by the end of the year again, right? So remember, after the economic data, we had the likes of Michael Feroli from JP Morgan Chase even saying that we might get an inter-meeting cut, and we definitely get 2 cuts in September and in November, and then more after that. Well, this is how markets have been reacting. As you can see, markets are pricing in fewer than 100 basis points of cuts between now and year end. And just in the last few days alone, we've had this change in market pricing. And I'm sure it's not over for the year after all. We're supposed to be in the quiet months and in the quiet weeks of August. Well, this week we caught up with former Chicago Fed President Charles Evans about what the Fed should do next.
is in an okay place right now. I think that they have spent a lot of their time indicating that they need confidence that inflation is going to be on a sustainable path to get to 2% inflation. And I think that's a stiff performance bar. I think it is time for them to, really start talking more about how they're going to act and actually act.
Joining us now is George Borey from Allspring Global Investments and Robert Tipp from PGIM Fixed Income. Thanks to both of you for joining. George, let me start with you, because earlier in the summer, you were looking for just one rate cut by the end of the year. It's so difficult right now to predict how many rate cuts we will get. What is your current position?
Yeah, hi. Thanks for having me on the show. The current position is that we will likely get one rate cut, and we're likely to get it in September. And now the probability for further rate cuts has gone up, as as many people have pointed to. The data has softened, but it's still a far cry from kind of recession-like outcomes. So the Fed has a lot of latitude to basically go kind of with the pace of the economy. It's very clear that the bias is to cut rates, and that the data is sufficient to justify that rate cut. The vol shock we saw a couple weeks ago, clearly got people very excited to expect big rate cuts very soon, very fast, and perhaps pretty aggressively. We haven't moved away. We haven't moved in that direction. If anything, the Fed still, we think, is going to be fairly patient, and they can be, because, as you pointed out, the data's mixed. It shows some degree of a slowdown, but still not any imminent collapse. We saw retail sales look pretty good. Inflation data is still a little stickier than perhaps the Fed would like, and confidence is looking good. So it's a little premature from our perspective to suggest that the economy is going to suddenly roll over and that the Fed is going to have to cut fast and furious to protect against that downside.
Yeah, that MOVE index still just a little bit elevated at 103. It had been just above 80 back in May, but it's definitely far off its highs. Robert, let me come to you and ask you about where you think the preponderance of data is falling, because even today we had very mixed data with a consumer that seems to be quite confident about the future, but still anticipates that inflation will be a problem.
Right. Well, consumers have been scarred by the high rate of inflation. But what we're seeing in the inflation data that gives us confidence that the Fed will be cutting is, number one, the fact that there is some moderation in economic growth, and the Fed believes they are restrictive. So that creates an a priori for them, that if they have the latitude to cut, they should do so in order to extend the life of the expansion and to maximize employment. On the inflation side, things are really cooperating there. The numbers at a headline level year over year are not at target, but there's a good breadth of, say, the consumer price index away from food, energy, shelter. That core, or even if you just take shelter out from the headline, that is very well behaved at target, suggesting that the only thing holding up the rate of inflation as far as the CPI is concerned is really housing. And with more multifamily supply coming on, we're seeing variability in rent rates, and all of that points towards inflation getting to target. So I think that creates the backdrop for the Fed to cut in order to extend the expansion. And inside the employment numbers, they're seeing some alarming signs there that their restrictive stance may create more of a slowdown than they want. So I think everything's really come together for that rate cut path.
Sure, but Robert, remember back after the July jobs report, which came obviously in early August, people were basically fainting at the idea that the Fed had made a mistake, that it was too late now, that employment is a lagging indicator and now we've gone and done it. Is this repricing that we've seen the market saying to the Fed, okay, you did get a passing grade, you haven't quite made a mistake just yet?
Yeah, I think the Fed has done a really good job. Chairman Powell's on his way to achieving a second soft landing. That's been the a priori, is that as soon as they had the latitude to cut, they would move towards doing so. They're moving towards doing so. And the payroll growth is strong. The thing that's pushing up the unemployment rate is the growth in the labor force. So this economy has the potential to grow faster. They want to tap into that, extend the expansion, cut rates. The pace of cuts priced into the market is aggressive, though. And at every soft data print, every low inflation print, the market has moved towards a kind of the better part of 2% of rate cuts in the next year. And I think the reason for that is really investor positioning. You know, investors have had a big increase in their wealth through home prices, through equity values. Money market balances are incredibly high. The only thing investors have not really locked in is a stream of income. And that's why we're seeing this asset allocation trade, and it's keeping the Fed pricing on the aggressive side.
Well, George, you guys at Allspring have been on this for a while. You have been diversifying duration and where you actually invest. And I'm curious as to where you stand now that we've had so much repricing and repricing and repricing. Earlier today, for example, Noel Dixon from State Street said he wouldn't be comfortable recommending the 10-year duration until the 10-year yield is back above 5%. Where do you stand on what's the best duration for somebody to go into right now?
Yeah, a central message from us has been diversify duration. That can be viewed as simply as just extend, adding duration, as Robert mentioned. Sort of those coupons, those income streams. Had been fairly attractive earlier this year. Yields have come down quite a bit, but are still fairly attractive. In real terms, we still have fairly strong positive real yields. And so we still would be willing to extend a little bit of incremental duration. Our view is that the 10-year yield between, say, 3.5 and 4 is going to be closer to fair value. So, I mean, hoping that yields get up to 5 might be a bit of a stretch. But we think if with 10-year yields in and around 4%, we still think that's a pretty good value area, especially for an economy that is decelerating. And as Robert mentioned, with rate cuts likely to come, the sort of the overbought part of the market, I think you had a chart of it earlier, was the 2-year part of the curve, which rallied very aggressively, and we were willing to pare back some exposure around the 2-year as it rallied to its lows. But now it's coming back up and more in line with a more measured pace at the front end. So there is lots to do as it relates to duration. Our bias is to position simply for steeper yield curves, which we think are coming. You can do that at the very front end of the curve. You can do that at the longer end of the curve. But steeper yield curves, by and large, are a nice way to play an environment where we still have good economic growth, albeit decelerating, and a Fed that's biased to cut rates. And so from that perspective, you can really set up a nice portfolio structure that both captures those current yields and incomes and is well positioned for the current economic environment.
Yeah, Robert, I mean, the steepener trade had been the all-in trade, right? And it just seems in the last few days that it's more the short end of the curve that's now attracting money. Is George right? Is it a mistake to maybe be attracted by that when you could lock in your money for 10 years, even now at 390?
Well, I think there's elements of truth in both of those. I mean, we're past the peak for interest rates for this cycle. So being in the market, having a full market duration or even a long duration over the long term may work very well here. Problem is the curve is negative carry. It is an inverted curve relative to the Fed funds rate. And if you are extending duration, you need to be right, that the forwards will be realized and the Fed will cut at least as fast as what's priced into this market. So I think there are opportunities to place, the exposure of the portfolio along the yield curve to avoid that roll up, to maximize the yield. Another way to do that is through spread product. Those curves have different shapes than the Treasury curve, than the SOFR curve, than the Fed funds rate swap curve. And I think it is very important to avoid the roll up on the yield curve to maximize yield so that you can lock in the income stream for the long term, but avoid the negative carry and negative roll-up aspects of the steep inversion that George mentioned at the front end of the curve.
All right, thanks to you both for such wonderful advice today. That is just now Robert Tipp of PGIM Fixed Income and, of course, George Bory from Allspring Global Investments joining us as well. Up next, the auction block. JetBlue raises billions of dollars worth of bonds a day after getting downgraded by the ratings agencies. We dig into credit next. This is Real Yield on Bloomberg.
most investors are intoxicated by the opportunity in artificial intelligence. $160 billion being spent this year. That's just one data point. Another data point is a $3 trillion market cap for NVIDIA against $80 billion of sales on a trailing 12-month basis. Obviously, a lot of growth is expected for NVIDIA and for other businesses in the space, but that is yet to materialize, and it's impossible to know what the scale will be of an NVIDIA or other players in the artificial intelligence ecosystem. I think investors are just so focused on the opportunity set, on what it can be, and it's a self-fulfilling prophecy. If you bought NVIDIA a year ago or 2 years ago, you're pretty excited about where it is today, and you think that it could go to the moon. As a result, you don't really focus on the risks. You're sort of just too excited about the opportunity.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
I'm Bonnie Quinn. This is Bloomberg Real Yield. Time now for the auction block, where credit issuance volume withstood the wave of U.S. economic data this week. High-grade sales were $29 billion, hitting the high end of the forecasted range. The big highlights included Eli Lilly, Bank of America, and Caterpillar. Historically, end of August is sparse pretty much for sales, but this year, well, it could be different with about $20 billion of new sales expected next week, mostly Monday and Tuesday. Over in high yield, August has seen $17 billion worth of sales, up more than 40% compared to the full month of August in 2023. This comes as the cost of capital drops, with yield to worst falling to a new year low. In particular, looking at JetBlue, it sold $2.77 billion of bonds and loans, and that was just one day after being downgraded by both Moody's and S&P. The transaction is backed by JetBlue's loyalty program, a move several peers have done in recent years. And sticking with credit, Invesco's Matt Brill says there is still investor appetite.
High yield will come back if you get a little more stability in the market. I think just given the shock that you saw, it's sort of hard to jump right into the high yield market. But overall, once you stabilize and you look at high yield, where it's trading from a yield standpoint, it's going to look pretty good if you believe that we're not heading into recession, which we still need to see a few data points, I think, to get people to believe that. But again, go back to investment grade. It's mainly been an institutional buying spree for the last several months or really several years. But within the last week or two, we're starting to see the retail market pick up.
And JP Morgan now saying investors buying high-grade U.S. corporate bonds when spreads are widening have made a profit within 3 months, about 70% of the time. So that sounds fairly attractive. Let's get to our panel. Stephen O joins us of Pine Bridge, and Megan Robson is also here with me in studio. She's from BNP Paribas. So Megan, let me start with you in studio. What is the appetite when it seems like there's risk out there? We're not even quite sure what the risks are yet if you look at the economic data, and spreads are not particularly wide.
Great question. Thanks for having me, Vonnie. So we did see the biggest sell-off in credit in the last 2 weeks as we saw some of that volatility. A lot of that has recovered, but spreads are still sitting wider than the tightest levels that they were for several months. So in our view, there is still a bit of spread upside to capture over the next couple weeks as we head into August. I think there's a few supportive factors. You mentioned supply. We still do have $20 billion to get through next week, but it's actually a lot less than earlier this month when it was 40 billion per week in investment grade. And then secondly, investor positioning was very extended in the U.S., and that happened to come down with the sell-off in credit. So I think those two factors, along with some stability and growth, are going to be positive for credit.
Stephen, on that perceived investment risk in the corporate bond market, we're at something like 52 basis points. I mean, it's basically no risk whatsoever. Would you agree with that market assessment?
I think the market is pricing in both a economic soft landing to a glide path scenario with accommodation coming from the Fed that will be supportive of credit going forward despite the slowdown. And furthermore, and probably more importantly, the fundamentals of the credit backdrop is really fairly constructive going into this. And so when you take a combination of those factors, valuations are still tight despite the widening that's taken place. But we believe that the tight valuations are fair to both the credit outlook as well as the macro outlook, because we too do not believe that there will be a recession forthcoming in the future. And then for much of this year, the credit spreads have really traded an inverse relationship to where the Treasury component has been. And if you look at the price levels, that's been more steady. And in fact, credit has been a much more stable part of the market than Treasury markets for this year.
Okay, so quite a sanguine outlook from the markets and from those market participants that we have in studio. But at 7.5%, Megan, is that pricing risk correctly in the high yield market? And would you be buying at those levels?
So I think high yield, there definitely is a story of bifurcation. So we do think that in a soft landing, our base case, double B, single B credit can hold up very well and still offer attractive risk reward to investors. However, rates are still high. We have seen a pickup in idiosyncratic issues. And so we're much more cautious on the more highly levered companies, things like triple Cs, where you have seen larger drops in certain names, and we still do think that you're more vulnerable to an earnings slowdown as growth decelerates into the second half.
Yeah, Stephen, you must be keeping your eye out for some kind of dislocation in some of the markets somewhere, right? You don't want to put all your cash to work right now. I presume you have some fire that you're holding back. Tell us where and where you look first thing in the morning in case something has changed.
Well, I think we've been operating in an environment where nothing has been particularly cheap across the spectrum of, credit and fixed income markets. Going back to where we did see value, even though high yield represented very attractive yield, we really saw no opportunity for price appreciation, and the best outcome was something resembling a, coupon yield type rate of return. So in that regard, one of the places that we did see value earlier this year in the below investment grade arena was in Asia high yield, and we were overweighted toward Asia from a geographic standpoint. And to be clear, the Asia exposure was not about a China recovery, but really the strength of Asia corporates in high yield outside of China in particular. And a lot of that spread opportunity has played it out. But where we sit today, we think that yields are fair within the high yield marketplace, but not cheap to continue to add to exposure. And I think in a market like today, it's prudent to maintain some level of small dry powder. And one of the places that we're doing that is in high quality investment grade CLO tranches, where if you look at AA tranches right now, the yields that you're getting are equivalent to double B high yield with much lower risk profile. And so it's a good place to sit when you don't think there's going to be price appreciation, but it's about carrying the short term while having the dry powder.
Fascinating. And Stephen, can I just push you a little bit on your ex-China Asia trade? Would that have been Japan or in India, for example? And how did the movement in the yen and the perceived expected movement in the yen for the next few weeks, how would that change your outlook on those kinds of bonds?
Well, first of all, when we take exposure outside of the U.S., we don't take currency risk. We're taking hard currency exposure because anything in currency will overwhelm what you do on the credit component. And it's been fairly broad across the spectrum, but it has been in markets like India, where we like the India's renewable sector, parts of the Indonesian commodity component. So a fair amount of it is in the higher growth South Asia economies, but there's also been some targeted broad Asia Pacific as well, including Australia and Japan.
Megan, I want to ask you about opportunities outside the United States, if you're taking advantage of them now or waiting, or how you've been doing that.
We have had an overweight earlier this year to Europe over the U.S. A lot of that has transpired in Europe catching up to the U.S. So we still see value now between U.S. and Europe as more neutral. I would say, though, that there are slightly larger risks in the U.S. So we have the election coming up. We do expect that the Fed will start cutting rates in September, but over in Europe, you've already started the monetary easing cycle, so that's another advantage. And then positioning in Europe is much more neutral, a neutral level following the recent volatility and sell-off, whereas U.S. is a bit longer. So I think on the margins, still risk-reward looks slightly more favorable in Europe, but not a high conviction view for us.
It does seem like everyone's expecting the Fed to go by 25 basis points. You have to wonder what would happen if there was suddenly a 50 basis point move. But we're not there yet, so we'll wait and see. Our thanks to both of you. That here beside me is Megan Robson of BNP Paribas, and Stephen O joined us from Pinebridge as well. Thanks to you both. Still ahead, the final spread. The week ahead features the DNC, of course, more earnings, and Fed Chair Jerome Powell at Jackson Hole. This is Real Yield on Bloomberg.
So a number of people, I think from Homeland Security and or the CIA or NSA, have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements. And TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
I'm Bonnie Quinn. This is Bloomberg Real Yield, and it's time now for the final spread. The week ahead, coming up Monday, of course, we have the Democratic National Convention beginning in Chicago. Not only that, but we also have some earnings. Estee Lauder and Palo Alto, for example, both reporting. A read there on the consumer as well as on the chip industry. And then continuing consumer reads with Lowe's and Toll Brothers on Tuesday. Wednesday, we'll get the FOMC minutes and Target and Macy's earnings. So a lot to digest on Wednesday. And that's all before Thursday's acceptance from Kamala Harris at the Democratic National Convention of the nomination. We'll also, of course, get U.S. jobless claims on Thursday and existing home sales. And then Jackson Hole, Fed Chair Jerome Powell will deliver remarks, and we will be able to bring you all of those. And of course, there's always the possibility that geopolitics upends everything this week. Just saying. This has been Real Yield on Bloomberg.
Liquidity is the lifeblood of an airline. We make very conservative decision making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well, because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
Good morning from our world headquarters in New York. I'm Menace Crenny.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Welcome to Bloomberg Markets. I'm Scarlett Fu. The S&P 500 higher on the day and on pace for its best week since November. So here's a snapshot of the market action with about 3.5 hours of trading left to go in the day and in the week. Stocks erasing their early losses, now building on their gains for this week. And with this rally, you can see the VIX coming down to below 15, lower than before the thick of the market sell-off at the end of July. Little change right now across the Treasury curve. The two-year yield, which is, of course, very sensitive to Fed policy, down just barely 4.08%. And we should mention, of course, that traders have been repricing the need for supersized rate cuts, but that took place earlier in the week. Gold climbed to above $2,500 for the first time ever. We'll continue to monitor that move for you. But in the meantime, let's highlight some individual equity movers. Global packaging giant Amcor dropping as much as 7% for the worst performance in the S&P 500 after its quarterly sales declined more than expected. Amcor cited soft volumes in the healthcare and beverages categories. You look at Cisco, it is now up for a fourth day at the highest since April. HSBC upgraded the stock to a buy. Cisco gave a bullish revenue forecast, also embarking on a strategy shift that involves job cuts and freeing up resources to shift more into cybersecurity, cloud systems, and of course, AI-related products. But for this week, it really is about the recovery that we've seen from the global market freakout that we had at the start of August. That feels like it's in the rearview mirror. And as part of that, it looks like investors are once again rotating into risky corners of the stock market, which includes small caps, as well as cryptos. For more on this, let's bring in Abigail Doolittle. Abigail.
Well, it's really interesting what you just said, Scarlett, in terms of it feeling like that sell-off was in the rearview mirror, because when volatility happens, it breeds more volatility. So it's basically Newton's third law, where what goes down must come up. So we're seeing this counter bounce higher. But I wouldn't say that that selling is over, and it really starts with that yen carry trade. Now, what's interesting is, yes, small caps are up on the week, up about 2.7%, but it's really big tech and large cap that's outperforming. That NASDAQ 100 up more than 5%, the best week since 2023, and the S&P 500 up the better half of 4%, also the best week since 2023. In terms of the yen, this is where it's at. This is one of the scarier charts that I've seen out there. It's basically just kind of hanging, dangling there, waiting for the sellers to come back in. And what happens is when the yen was going lower, it was borrowed as cheap currency to then go into risk assets. In the beginning of July, the yen started to strengthen, which meant that that trade unwound, and there was no longer the fuel for too far, too fast. And if we take a look at this chart in the terminal, it's very interesting. It really shows it, Scarlett, relative to the small caps, that when the dollar-yen strengthens, which means the yen is going down, after that, the small caps go higher as we actually see a reversal. So it really points out that relationship. So I would say all week, all eyes on the yen. Next week could really be make or break crucial.
Yeah, so small caps are a beneficiary, among other asset classes, of the borrowing of cheap yen for higher yielding assets. And by the way, I made a mistake. I thought crypto was higher for the week. It's not.
It's not. It's really interesting. This is one area where we don't have risk on. And there's other areas also, like the Bloomberg Commodity Index. It's up ever so slightly. Oil earlier had been lower. So I would say that there's enough mixed signals out there. It's very easy to think that all of that is behind us, but volatility breeds volatility. I think more could be ahead.
And one reason I think a lot of people think the worst is behind us is because people are putting on that yen carry trade once again.
Yes.
Even though,
interesting point.
Even though it's the unwinding of that has been very painful. Right, they're going back to it because it still works at the moment.
It still works at the moment, but the question is, will it continue to? If you take a pure look at the chart of the yen or dollar yen or even straight yen, the futures, or if you take a look at the Nikkei, these charts, Scarlett, there's no stability there. It suggests the sellers are really on pause. And what's interesting, when we really think about why is the yen strengthening, I would say one, uncertainty, geopolitics, also election 2024, but then another one is some folks are saying that when the Nikkei sold off more than 12%, the worst day since 1987, 2 Mondays ago, at that time, the banks underperformed. They were down 20%. Some people are saying there's bad collateral in those banks and that they're lending out this yen on bad collateral, and at some point, it's not going to be so pretty.
Actually, next week will be key because, of course, Jerome Powell speaks, but also you have the BOJ governor speaking on Friday, too.
Good point.
And he's going to be addressing Parliament, talking a lot about that sell-off that they got on Monday and what their policy is going forward. So everyone's going to be paying attention to that. Lots of yen carry trades in the balance there. Abigail Doolittle, thank you so much. We're also closing out what's been a week of critical economic data with a look at housing. New home construction in the U.S. declined last month to the slowest pace since spring of 2020. You look at total housing starts, they dropped almost 7% to a 1.2 million annualized rate. That missed all the estimates in a Bloomberg survey. Michael Sasso covers housing for Bloomberg News, and he joins us now from Atlanta. Michael, I'm guessing this is clearly a reflection of elevated borrowing costs, isn't it?
Yeah, that's partly it. Certainly, borrowing costs are hurting affordability. Affordability has been challenged really around the country. Part of it also is just elevated inventories. We're at the highest inventory of new homes since 2008. And so builders are kind of taking a little bit of a pause. So it's kind of a mix of affordability challenges and kind of elevated inventories.
And I want to get to inventories, but I'm curious whether any one-off items might have affected these numbers. Hurricane Beryl, for instance, impacting construction in the South. Are these things that later get made up in subsequent months?
I don't know the answer to that. Beryl was seen as, you're right, Beryl was seen as a bit of a lag or a drag on southern housing. I don't know that, I think builders are going to be hesitant to really ramp up construction at this point. I don't think they're going to really try to make up the difference of it until mortgage rates fall and until inventories come down a bit.
Okay, fair enough. And I'm glad you brought up inventory earlier because we all became acutely aware of the housing shortage during and after the pandemic. That was a legacy of home builders moving very cautiously after the global financial crisis in 2008. But you mentioned how inventory has now swelled back up to the highest since 2008. Was a lot of that made up just in the last couple of years? Can you give us a sense of the trajectory of that inventory buildup?
Yeah, well, what happened was there's been this extraordinarily tight market for existing homes. And so what happened was builders saw an opportunity. They needed to make up the difference, and they kind of went on really a fast upswing over the last couple of years. And that built up inventories to the level the highest since 2008. Now, the industry's not that worried because, as I said, existing home sales and inventories are so low that really the builders were just making up the difference. And so they're okay with some elevated inventories. It's kind of offsetting some of the really low inventories in the existing market.
Okay, thank you for clarifying that. The other thing that we got today was, of course, building permits, which is kind of a leading indicator for construction. That also declined in the month. Beyond lower rates, what are people saying we need to see for building permits to turn around?
Well, as I said again, I think some of it goes back to inventories. You'll see builders ramp things up again when they start selling off some of these. But yeah, rates I think are still at about 6.5%. That's almost double what they were a couple years ago. So I think the whole industry, existing homes sellers, new home sellers, everybody's waiting on rates, frankly.
Everybody's waiting on rates, as are traders and investors. Bloomberg economy reporter Michael Sasso, really appreciate your joining us today. Michael joining us from Atlanta. Now coming up, chips are in focus as Applied Materials disappoints with its forecast, while Texas Instruments set to receive billions of dollars from the CHIPS Act. We've got more in that group next. This is Bloomberg.
In global leadership are on Bloomberg.
We are 40 millions. We're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the US. So I would like to understand, what would it mean to finish war fast? If Trump knows how to end this war, he should tell us today. Because if there are risks to Ukraine's independence, if there are risks that we will lose the statehood, we want to be prepared for this. We want to understand whether in November we will have the powerful support of the US or we'll be all alone. Only our lives are at stake here, and nobody can just trade our lives.
Nobody covers the top global leaders like Bloomberg Television and Radio.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money. If I had invested with you, which I wish I had, what kind of rate of return would I have had over that 10-year period of time?
Over 100% a year on average. On average.
100% a year, that's pretty unusual.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Billionaire Gautam Adani founded one of India's biggest and most controversial business groups. After being rocked by accusations from short seller Hindenburg Research last year, Adani is now preparing for the company's future in a real-life succession story. Meet the family members he's handpicked to take over the business as we deep dive into the facts and rumors surrounding the Adani Group. Inside Adani, a Bloomberg exclusive replays all weekend, only on Bloomberg.
This is Bloomberg Markets. I'm Scarlett Fu. It's time now for the stock of the hour, and we're going to focus now on chip companies. Applied Materials, which makes chip equipment, is falling after giving a fourth quarter forecast that was in line with expectations, disappointing bullish investors who are looking for a bigger payoff from all that AI spending. Meantime, you have chipmaker Texas Instruments also lower. Even after the announcement, it is set to receive billions of dollars in grants and loans from the White House push to boost domestic manufacturing. So let's bring in Bloomberg News' Ian King. He joins us from San Francisco now with his decades of experience covering the global semiconductor industry, first in Asia and now in the U.S. Ian, we pay attention to Applied Materials because it's a key supplier to Intel, to TSMC, TSMC to Samsung Electronics, which you're all familiar with. It's giving a forecast that didn't disappoint, but also didn't impress anyone. So I guess my question is, how high was the bar here?
Yeah, I mean, there are puts and takes here, and that obviously everybody is very focused on the data center spend, you know, the demand for all of these extremely high-end chips made by companies like NVIDIA. So there was an expectation sort of built in that this would create a flood of demand even for the equipment and for the future build out of the industry. But what is kind of missing from that equation are a couple of things, which is demand for the types of chips that, say, go into cars and industrial equipment, and that isn't as strong, or what's going on in the China market in general, where, as you know, a lot of U.S. companies are finding themselves restricted by the U.S. government's rules.
Okay, so the demand for chip equipment for other chips, not AI chips, may not be living up to those very elevated expectations. The U.S. government rejected Applied Materials grant request under the CHIPS Act for a $4 billion R&D project. How big a blow are these kinds of decisions, or do they not matter as much? Because I look at Texas Instruments, and it won $4.6 billion in grants and loans, but the stock is falling today.
Yeah, I mean, it's important to sort of view it through the lens. I think that our audience would see this as, like, on a high level, you know, there's a lot of government money that's being allocated to these companies, but none of it has actually been sent to these companies yet, and they've got to actually do what they've agreed to do before they get anything. So it's improving their costs of capital, but, you know, think about it, a high-end fab costs $20 billion. $2-3 billion here and there helps, but it's not paying for it, right?
Yes.
It's improving your cost of capital.
Right, that's a really good point. I mean, do companies request grants for projects that are already underway, for commitments they've already made, or are they, I guess this is a dumb question, are they making plans based on the availability of federal funds?
I mean, Texas Instruments is a very good example that will answer your question. They were doing this anyway. And what they've told investors all along is, if we get the money we think we deserve from the government, this will improve our costs. It won't pay for it, but it'll help facilitate this, it'll help improve our costs, and it'll help us go faster and bigger with these projects. So it's a nuanced kind of argument there that they're making to investors for why this matters.
Right. How quickly does the federal money actually come through? Because you said they have to actually go through with it and then get the money. Is this something that comes in years after the fact?
It absolutely can do, yes. I mean, it's all based upon sort of achievements, basically. As we know from the history, you build a plant, you build what's called the shell, which is the actual building, and then when you're sure you've got demand, you go and pay for the really expensive part, which is the kind of equipment that Applied Materials makes. So what the government wants to see is, great, you built a factory, but that doesn't really mean anything. What we want to see is you actually installing that equipment and making the chips in the kind of volume that you said you were going to do, and then you'll get the bulk of the money. So that could be, as you point out, years.
Okay, got it. Thank you so much for explaining all that. Bloomberg's Ian King, again, an expert on all things semiconductor, especially in Asia and the U.S. Coming up, Kamala Harris set to unveil her economic plan in a campaign speech this afternoon, but we've got some of the details already, so we'll dig into all of that next. This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. The names that move markets are on Bloomberg.
Don't expect we're going back to zero, because zero was the product of huge global shocks. I think to get to there, something really bad has to happen that we're not currently expecting. So it'll be somewhere obviously in between. I think we've made a big point of saying policy is currently restrictive, so you can deduce from that it will be lower than where we are today, but I think it's very clear that we're not going back to zero.
Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg Markets. I'm Scarlett Fu. In about 2 hours from now, Vice President Kamala Harris will unveil her economic plan at a speech in North Carolina. She's expected to call for a federal ban on food and grocery price gouging, along with a broader set of proposals. Food inflation, especially meat prices, continue to be a concern for voters. The Harris campaign also says it'll scrutinize food-related M&A, like the deal underway by grocers Kroger's and Albertsons. Bloomberg Politics editor Laura Davison is here now with more. Laura, so the proposals that she's going to lay out here, is this something that she's continuing from the Biden administration, or are these fresh proposals?
This is really a fresh proposal. This is sort of her first foray into distinguishing herself and putting out new ideas beyond what she and Biden have proposed as a joint administration. So this is really a recognition that inflation and food prices in particular are one of the top issues for voters. Even though inflation, those monthly inflation numbers have cooled, consumers are still thinking about what things used to cost 2, 3, 4 years ago. And when you look back, food prices have increased about 20% over the course of the Biden administration. And so that's what they're hearing in the polls, that is a main issue as voters are thinking about whether to maybe decide to vote for Harris or to stick with Trump.
Yeah, I still mourn the loss of sub-$10 lunches here in New York, so I'm sure that is a familiar thought for a lot of people. We know that Harris is promising to target price gouging and price fixing within her initial first 100 days of office if she gets there. But there's also talk of price controls as well. Price controls don't have a great track record in the U.S.
Yes, this is a little bit more
In 10
controversial.
minutes time now at the top of the hour. See the release of the weekly US Baker Hughes rig count numbers. Oil rigs, the prior was 485, total rigs prior 588.
So a lot of these proposals are, kind of remain to be seen how they would work if actually enacted. But really right now we're sort of in the poetry phase of the campaign where candidates are putting ideas that kind of hit at issues people want. We're not in the, kind of sort of legislating nuts and bolts phase, which we know.
Right, it's kind of like a wish list, right?
Exactly.
Okay.
So you see in her broader, speech, she's talking about, housing and a bunch of different issues that are really top of mind for people.
Yes, absolutely. It's more like, I hear you guys. I hear you on the pain that you're feeling. The other thing that we had mentioned as well was that she's looking to direct government agencies like the FTC, for instance, to look into big M&A deals that may make it more difficult for people to get lower pricing down the road. So we're talking about things like, Mars buying Kellanova and being able to have a lot of pricing power. What does that sound like to you in terms of keeping someone like Lina Khan at the FTC?
This really suggests that, the road that the administration has been on in big tech is something that they're now looking to do for big food as well. Specifically in this announcement about price gouging, Harris and her team have talked about the Kroger Albertsons deal. So they really have their eye on that. This is an issue that, at the executive level, meaning they don't need Congress to do it, that they can start targeting some of these deals that are having a lot of pressure on people's pocketbooks.
Interesting. Okay, through executive action. And I believe she singled out or really looked at the meat industry in particular as one area that they could target.
Yes, meat has been, one of the key drivers of prices, and has been a big problem since the pandemic. And so you really look at kind of this holistic look of what can we do, realistically, knowing that energy prices probably aren't going down, knowing that prices aren't going to fall from where they've been, but we can slow the growth. And these are the different tools in their toolbox that they're looking at.
All right, Laura, thank you so much for giving us a preview here of what we might be hearing from Kamala Harris when she starts speaking in just under 2 hours from now. Let's continue the conversation on what Vice President Kamala Harris is likely to say with Terry Haynes. He is founder of Pangea Policy. So, Terry, how are you thinking about what we're going to hear from Kamala Harris? You heard Laura give us kind of the broad brushstrokes of some of the policy ideas embedded in her plan, but how much detail is she really going to be able to say?
Well, she's not going to be big on details, Scarlett. Let's put it that way. Anybody in markets looking for policy detail on this speech it's going to be a lot like grabbing Jell-O. You know, there's not going to be a lot there. What she really needs to be doing, and you hit it exactly right a minute ago. She needs to be going into the convention all about empathy. Empathy is going to be the key in her mind to getting the maximum amount of independent voters, people who aren't quite convinced of her yet, as she goes into the November election. And so I think what you'll see in this economic speech is largely that. But when you get down to the details on these sorts of things like price gouging, for example, there's absolutely nothing there. The idea is we're going to go to Congress. We're going to work with Congress to get more power for the Federal Trade Commission, and I'll try to work with the state's attorneys general to do something. That is a recipe in Washington, a very long recipe for saying, I'm not going to be really able to do anything, but I just want you to know I feel your pain.
Right, but it doesn't serve anyone's purpose on the campaign trail to talk about, the nuts and bolts of policymaking and legislating. When you mention empathy, does that mean listening or solving?
Well, I think it means listening. I think it means demonstrating understanding, and she will quote unquote call for solutions as the campaign's press release says that she will. I only point out that for markets that the vast majority of this is next to impossible to accomplish for any president that's looking for a very likely split political Congress in 2025.
Okay, fair enough. Well, not so long ago, we had the Trump trade, and a lot of it is premised on what had happened during the first Trump administration. But after the debate and right before the RNC and during the RNC, the Trump trade was very much in effect. Is there something like a Harris trade? Can you make an argument for one?
Well, I can make an argument that one exists. It's going to be largely status quo. She will differentiate herself from Biden, and she's already doing so in a number of different ways, some of which have to do with the economy. But by and large, what markets forget in presidential election years, but then
So in 5 minutes time now at the top of the hour, see the release of the weekly US Baker Hughes rig count numbers. Oil rigs, the prior is 485. Total rigs, the prior 588.
Crossed with Congress. And in this situation, what you've got is a very likely Congress that continues to be politically split, but this time a tiny majority Democratic House, a tiny Republican majority Senate. In that scenario, Harris is not going to be able to achieve a whole lot. What you've got for markets, though, is really kind of a mixed message from Harris already. On the one hand, she's very much for Fed independence, but on the other hand, these proposals are all bad for fiscal. They push back on M&A, as you point out, which is a driver of the economy. And finally, in the housing proposals, there's a hint of directed economy here, which markets also aren't going to like.
Yeah, absolutely. But when it comes to housing as well, it's something that the White House has very little control over because it's very much dependent on interest rates and on supply, which again is in the hands of builders. Terry, really appreciate your joining us. Terry Haynes is founder of Pangea Policy. And as we were just showing you, that was Kamala Harris, who has arrived in Raleigh, North Carolina. She will be due to give a policy speech, really outlining her economic plan at about 2:45 Eastern time. Of course, when she does begin speaking, we will bring you there on Bloomberg Television to give you full coverage of that event. In the meantime, you are looking at the S&P 500 and other equity markets and indexes holding on to their gains at the moment. We're talking about gains of 0.25%, little movement in yields, with the 2-year at 4.07% and the 10-year at 3.89%.
times in tech are on Bloomberg.
AI tools can help democratize storytelling and turn everybody into a creator. Our vision of the future is individual creators will look like Disney. They'll be able to go from an idea to a final story. They'll be able to publish that. They'll be able to merchandise it. They'll be able to do it across the franchises and stories they create.
Nobody covers technology like Bloomberg. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Today's CFOs focus on much more than just revenues and margins. Their impact goes far beyond the balance sheet.
The world is coming at us faster than it ever has.
Our first job is to intimately understand and anticipate the consumer's needs.
You need to identify opportunities.
It's an incredibly fun job.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. New episode September 11th.
Shortly expecting the numbers from the weekly US Baker Hughes rig count.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. From the world of politics to the world of business, this is Balance of Power. Washington, D.C.
It's still the economy, stupid, and today Kamala Harris gets her turn. Welcome to the fastest show in politics as the vice president outlines her economic policy proposals today, as Donald Trump did earlier this week. And we're going to talk about her plan with the campaign's senior economic advisor, Gene Sperling, fresh from the Biden White House, now on the trail. Consumer sentiment rising for the first time in 5 years, as we learned today. And another economic indicator hits an all-time high. Volume at the Port of L.A. And the port's executive director, Gene Soroka, is going to be with us this hour with analysis from our signature panel. Rick Davis, Jeannie Shanzano, with us for the hour. And it's all after a look at Wall Street. Let's start on the markets right now with Charlie Pellet in New York. Hey, Charlie.
Hi, thank you very much, Joe Matthews. Stocks best level of the day right now. The S&P up almost 18 points, a gain of 0.3%. The S&P on track for its best week in 2020.
See US Baker Hughes total rig count coming in at 586, 586.
Up 0.3%. NASDAQ up 74, a gain of 0.4%. 10-year at 3.89% with a 2-year that's yielding 4.07%.
Baker Hughes oil rig count 483, 483.
1.5%. Spot gold up 1.6%, 24.95 the ounce. Was trading briefly above 2,500. GLD, that is the gold ETF, the Spider ETF. It is up now by 1.7%. Again, recapping, S&P up 0.3%. Stocks higher across the board. Back we go to Washington. Balance of Power continues. And once again, your host, here he is, Joe Matthew.
Charlie Pellet, thank you so much, and thank you for being with us here on the Friday edition of Balance of Power on Bloomberg TV and radio. We're live from Washington. You can also find us on YouTube. Search Bloomberg Business News Live, and we'll meet you here in the studio with an important address roughly 2 hours away now. Kamala Harris holding forth in Raleigh, North Carolina with her economic policy proposals today. And as we've told you, she's painting out of 3 buckets, largely housing assistance. We're going to be talking about expanding tax credits and some other issues that we may not have heard about so far yet, but controlling prices, which has been a big theme of the week, will be a big part of this with a proposal to create a federal ban on price gouging. That's 2:45 technically Eastern time if all things start on time. And we're going to talk in a moment with Gene Sperling about what to expect as we set the baseline with my colleague Eric Wasson. And one of the most important pieces of journalism that you can read today, must win Michigan's angst over inflation in EVs shapes the 2024 race. Great on the ground reporting by way of Tony M's restaurant in Lansing. Eric, it's great to have you. Thank you for joining us as always here on Bloomberg. There's a particular line that jumps off the page in your piece today as we consider these candidates going out of their way to try to pitch economic policy proposals. You write, neither Trump nor Harris have offered many specifics on their plans to cut the high costs which have this woman you interviewed here at the restaurant, contemplating layoffs. This is the week where the campaigns fill in the blanks. What are people in Michigan looking to hear?
Yeah, and I drove around Michigan for a week. I was very impressed by how sophisticated voters are, especially about the auto industry out there. There's a real lively debate among the populace over the wisdom of pushing electric vehicles, of sort of having pollution laws that would basically push the car companies into making more of them, of incentivizing them. A lot of auto workers are afraid that there's fewer parts, that will mean fewer jobs, and this is risky for GM, which was in bankruptcy a decade and a half ago. So that was very interesting. This restaurant that I went and talked to, they're big supporters of the union. The union pickets out front whenever there's a strike.
Yep.
But she might vote for Trump because times were better, prices were lower. She got 25 employees, and with the cost of food and new minimum wage law in Michigan going into effect, she might have to lay some of them off. And we heard that throughout. I heard that throughout the state. And Democrats are really, they're not playing defense. They're not talking about Bidenomics.
Yeah.
In fact, they're saying we hear some concrete proposals to move forward, and that's what voters are saying they want to hear. They don't want to hear a personality campaign. They're sick of the mudslinging, but they're very worried about prices. And what we heard from the Republicans is more energy production, go back. Really pushing fossil fuel vehicles and what Motown is famous for producing as far as motors, and like Slotkin on down, saying we have an industrial policy. The EVs are the way of the future. They'll either be built in China or built here. And as far as costs, we can address housing. We can address prescription drugs, which he's already started to tackle. We can address student loans, while acknowledging, I think the lower ballot candidates acknowledge that maybe price gouging legislation won't be a cure-all. And certainly, I think voters are going to be disappointed that we may slow inflation, but we're not going to go back to 2019 prices. That's just not really how the economy works. So I thought it was very interesting. I think, these are swing districts, a swing state. The 8th and 7th district in Michigan could flip the House. That's where Dan Kildee's retiring and Slotkin's trying to move on to the Senate. And these voters are really on the fence.
Well, it's real life stuff here. You talk about Tony M's restaurant. They had to actually cut their hours, Eric, because GM got rid of the third shift. This is That's the stuff that we don't always talk about in Washington. And to that end, Alyssa Slotkin, you mentioned the Congresswoman here a moment ago with a quote in your story. If I hear one more Washington-based, Harvard-educated person tell me, no, it's really better and the economy is actually very good, I'm going to have to maybe depart that meeting. How does Kamala Harris get to that today?
I think that she's doing, what Slotkin would want her to do and probably asked her to do when they met in Detroit earlier this month is to talk about concrete policy proposals. I don't know if Slotkin's going to endorse everything. She's probably running a little bit to the right of Harris, as she must. But they want to see meaty proposals, and that's what voters want to see. And I saw very few, I saw some retirees who already own their house, said the economy was doing well, but young people, millennials, Gen Z, all very angsty about starting a family. When can they ever afford a house? When can they save up? And as Slotkin said, there's no point going and trying to sell people that, hey, things are actually good because these stats say they are. People know their pocketbook.
Eric, thank you so much. Great to see you and great reporting. Find that piece on the terminal and online. Eric Wasson, Bloomberg congressional reporter, getting into the field. This is on-the-ground reporting, and it's something that Gene Sperling knows a lot about because now he's back on the trail from the White House, joining the Harris campaign as senior economic advisor. The last time we spoke, he was an economic advisor to President Biden, and he joins us in a new capacity today. Gene, it's great to have you back on Bloomberg with the speech less than 2 hours away from Kamala Harris. What should her message, what will her message be to the people eating at Tony M's restaurant in Lansing, Michigan, who are bemoaning the fact that GM got rid of a third shift? How does she win their trust to handle the economy over Donald Trump?
Well, what they're going to hear from Vice President Harris is a presidential candidate who is focused like a laser on taking on powerful interests to lower costs that are affecting them right now, and doing so in her first 100 days. So she's going to be laying out a plan that, first of all, is going to make clear that we're going to have the first federal law ever that allows banning price gouging by grocery chains, by the meat industry. That because I think that a lot of average people are thinking, agree with her that they saw a lot of big companies, grocery companies, food companies, keep their profit margins high as opposed to passing on savings at a time when people still think, rightly so, that food prices are still high. Even with food inflation coming down, they still look at where things were 3 years ago and they feel like it's too high, and they want to make sure that the person in the White House is doing everything they can to hold big corporations' feet to the fire, understanding prices go up and down, people use market power, but not allowing bad behavior that keeps prices high. And I will say that as Attorney General of California, Kamala Harris was very effective in taking on big oil, big pharma, the big banks on housing, where they acted in an improper or illegal way to keep prices high. Secondly, and I think this goes to what was just being reported, she is going to have the most significant plan to end the shortage of affordable housing that we've seen from any candidate. Number one, she is going to expand the efforts to increase the supply of affordable housing, both rental and those first starter homes. She's going to do the first ever tax cut for industry if they build affordable starter homes and if they sell them to first-time home buyers. She's going to have a challenge fund that's going to require state, local governments to do innovative things to increase supply. Secondly, she's going to crack down on the price fixing that we are seeing through algorithmic use of algorithms that are illegally increasing prices of renters, and going to stop the hoarding of single-family homes by big Wall Street private equity firms, and instead give incentives to sell those to individual families and to get those back in the community. And third, which I think is really important, is why are those people that were being talked to worried about owning a home? Most of them are working hard, getting a paycheck, and then paying a rent. They're paying a rent that is often as high as a mortgage payment. Why are they paying a landlord instead of building wealth? Because they can't put together a down payment. She's going to say, if you have paid your rent on time for 2 years, people will be eligible for a $25,000 down payment assistance. This shows what kind of a candidate she is. She's not just for helping you get by, which is important.
Okay, Gene, I was kind of hoping to have a conversation with you today.
Have a nest egg.
Okay. Well, so God, we just went through the whole thing here. I was kind of hoping to have a little back and forth, Gene. To what extent is Kamala Harris going to have to draw a distinction between her approach and Joe Biden's, or is there none?
Well, I think she is building on a lot of things, but I think housing is an area where you see her going broader. She is doing more on the supply side. This is a brand new tax cut that not only encourages building affordable rentals, but building starter homes. That's never happened before. That is an expansion. The down payment assistance, which was $10,000 under Biden, she's going to $25,000. We know what the cost of a house is. That is going to open the door to home ownership to millions more people. So those are ways she's expanding. She's also proposing something in the child tax credit that is new, which she's saying that in the first year of life, let's give families actually $6,000, because so many people don't have paid leave, and yet they have to deal with the price of diapers, car seats, all of the things that make the first year of life more expensive. So she's helping families deal with cost in these areas. These are expansions that she's doing. And I'll be honest, she is announcing more things that go after price gouging and price fixing among corporate landlords and in the food area than President Biden has. He's taken steps, but I think you see that she is not really swerving away, but she is putting her own stamp, and often it means going further and a little tougher, particularly on issues that affect the price. The prices that you just heard in the previous segment are really at front of mind for so many working families who are still feeling a squeeze, even with low unemployment, even with record job creation.
We saw the University of Michigan Consumer Sentiment Index today, Gene, up for the first time in 5 months, and noteworthy, as we saw from the report, the rise in sentiment partially driven by Joe Biden's decision to drop out of the race. Is there an inherent optimism by changing the top of the ticket that Kamala Harris brings into this speech today?
I don't think there's any question that as much as President Biden and Vice President Harris have an extraordinary record of accomplishment, particularly legislative accomplishment. Nobody doubts that about the infrastructure bill, the American Rescue Plan, the CHIPS bill. I mean, you can see with your own eyes, she has created a new energy. The excitement with her and with Tim Walz, you can feel it everywhere. Now, you know, it's hard for me to put that in economic words, but I think, you know, going to what you were saying earlier, what you are hearing from her right now is going after the prices that affect families. She's going to also talk later about the things we could do legislatively in a Harris-Walz administration. I mean, child care costs are one of the main taxes on people going to work. You know, helping people with family caregiving. You know, these are things that are more legislative. But right now, what she's doing is going right at, like a laser beam, at what is really troubling people now. And I will tell you that I would say food prices and the price, a lot of them know they're still working. A lot of them know they're now getting a raise, but they don't want to give back some of that raise for higher meat prices that might be due not to supply chain shortages.
Shortly expecting the results of the Fed reverse repo operation.
Margins. We just saw a study based on census data that earlier in the year that suggested profit margins in many of the grocery retail was at the highest 20 years. I think people want to see a president who's focused on that, focused on rent, and also focused on lowering prescription drugs. And one of the things she calls for is saying that $35 in insulin, that $2,000 out-of-pocket limit, that shouldn't just be seniors. That should be for all American families.
Gene Sperling, Senior Economic Advisor to the Harris-Walz campaign. Thank you, Gene, for the time today. We're going to be hearing from Kamala Harris, although I guess Gene just gave us a good sense of what we're going to hear starting at 2:45 Eastern Time. Again, Raleigh, North Carolina.
63 counterparties take 330, spot $317 billion at the Fed reverse repo operation.
When she begins speaking. We're going to talk to Gene Soroka, the Executive Director of the Port of L.A., coming up here. But first, I want to compare notes with our panel. Rick Davis and Jeannie Shanzano are with us now, Bloomberg Politics contributors, after quite a dive there with Gene Sperling. Jeannie, is that the best way to speak to people about the economy, to talk them off a cliff?
Yes. I mean, what she really needs to do is people are sour about the economy. I mean, of course, we've had some good numbers in the last couple of weeks on inflation and sentiment that you've been talking about, but people are sour on it. So her major message has got to be, and I feel your pain. I am understanding where you've come from, because this is my middle class background. As Gene Sperling was just talking about, this is what I did as Attorney General, and this is what I plan to do going forward. But she's really got to show that she's prepared to take on the costs that people are frustrated with. And so it's a start. I wouldn't say it's an end, but certainly it's a start.
Gene just spent some time with us here speaking on behalf of the campaign, Rick. Is that the tone that the Harris campaign should be taking? It was almost like he was reading out of a phone book to us.
Well, I think you got a good set of talking points from the guy who wrote them. And I'm sure there's a lot of pride and authorship there. So I think setting aside the style, I think there's some red flags. I mean, one, she's at least laying out a relatively detailed plan on what she thinks can help spur economic growth, but also, you know, lower prices. The problem is the genesis of the inflation curve was government spending. Nothing in there about reining in the growth of government spending. Nothing in there about sensitivity to deficits. Nothing in there about how you're going to balance a budget. So, I mean, at the end of the day, you can promise anything, anybody, but, how do you pay for it?
Well, let's put a finer point on this with Rick Davis and Jeannie Shanzano coming up here. We'll spend more time with our panel and the news on the trail today, coinciding with important data on the economy. It's straight ahead. This is Bloomberg.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money. If I had invested with you, which I wish I had, what kind of rate of return would I have had over that 10-year period of time?
Over 100% a year on average. On average.
100% a year, that's pretty unusual.
At 1:25 p.m. Eastern Time, we expect comments from Fed Goolsbee, who participates in a fireside chat at the Angeles Investors Q3 Summit and Awards event.
Founded one of India's biggest and most controversial business groups. After being rocked by accusations from short seller Hindenburg Research last year, Adani is now preparing for the company's future in a real-life succession story. Meet the family members he's handpicked to take over the business as we deep dive into the facts and rumors surrounding the Adani Group. Inside Adani, a Bloomberg exclusive, replays all weekend, only on Bloomberg. The names that move markets are on Bloomberg.
Don't expect we're going back to zero, because zero was the product of huge global shocks. I think to get to there, something really bad has to happen that we're not currently expecting. So it'll be somewhere obviously in between. I think we've made a big point of saying policy is currently restrictive, so you can deduce from that it'll be lower than where we are today, but I think it's very clear that we're not going back to zero.
Bloomberg. Context changes everything.
It's 121 on Wall Street. We do check markets all day long here at Bloomberg. Stocks continue to push higher. Best level of the day right now, once again on the S&P at 55.58, up 14 points now. That is a gain of 0.3%. The Dow also up 0.3%, up 116 points. NASDAQ up 63, a gain of 0.4%. Stocks are on track for the best week of 2024. 10-year yield right now, 3.88%. The 2-year, 4.06%. We've got spot gold advancing $41 the ounce to $24.97, up 1.7%. And a retreat for West Texas Intermediate crude oil today, down 2 2%, $76.54 a barrel. Texas Instruments shares, they are down today, dropping 1.1%. TI is set to receive $1.6 billion in CHIPS Act grants and $3 billion in loans. That word from the Biden administration. It marks the latest major award from a program that is designed to boost American semiconductor manufacturing. Again, recapping, U.S. stocks are advancing. Best level of the day on the S&P, up 15 right now, up by about 0.3%. Balance of Power continues. Back we go to Washington. Once again, your host, Joe Matthew.
All right, Charlie Pellet, thank you, and good to have you with us here on the Friday edition of Balance of Power. You made it to the threshold of the weekend. A lot of people in Washington are headed for the airport on the way to Chicago because 1 week from right now, we'll be reviewing the big nomination acceptance speech from the night earlier from Kamala Harris. A lot's going to happen between now and then, right? We've got Joe Biden starting things off on Monday night. Tim Walz is Wednesday, the big one Thursday, and a lot of fascinating conversations in between here on Bloomberg. We will be on the ground with all of our political shows. And by that, I mean this one, Balance of Power. 12 to 2 p.m. Eastern time, 5 to 6 p.m. Eastern. We're going to have it all for you, including special coverage on Thursday night when Kamala Harris accepts the nomination, just like we did for the Republicans in Milwaukee. And you don't just show up for this kind of stuff. You need an advance team. And that is led by Bloomberg's Tyler Kendall. She's in Chicago right now and is going to be reporting along with us next week. But as the preparations get underway, this is a fascinating time to be in Chicago, right? The barriers are going up. Cops are arriving from all over the country. And Tyler, you tell us what you're seeing. How's it going in Chicago?
Yeah, hey, Joe, you can actually see the United Center right over my shoulder. Of course, that is where the Democratic National Convention will kick off on Monday. We headed over to the arena earlier today to start to see some of those security precautions that you're mentioning going into place. We saw hundreds of law enforcement officers and Secret Service agents doing a walkthrough of the arena and some of those big security barricades starting to go up over the perimeters because, Joe, the DNC says that they're expecting 50,000 people to flock to Chicago next week to attend the convention. And for the Chicago Police Department's part, they say that they're allocating 2,500 law enforcement officers specifically to patrol the arena and its
Shortly
perimeter.
expecting comments from Fed Schoolsby.
One of the themes that we're going to be watching for next week, as you've been covering on Balance of Power, is the energy behind potential protests that we're expecting to descend on the DNC. I will point out that earlier this week, a federal judge actually ruled against protesters, saying that they wanted a different route. Right now, their route goes about 2 blocks away from the United Center. They're arguing that that violates their First Amendment rights because it doesn't get them close enough, and the route's also not as long as they wanted. However, that judge ruled that the current route is what prioritizes safety, and that's what the city has put into place for everybody involved, from protesters to delegates to all of us on the ground. But Joe, quickly, I just want to point out that while we have been talking about this expected enthusiasm when it does come to protesters, we're also watching for enthusiasm for the Harris-Walz ticket. I would point you to our latest Bloomberg News Morning Console polling, particularly when it comes to young voters. It found that in some key battleground states, now 54% of young voters ages 18 to 34 say that they're more likely to vote now that President Biden is out of the race. It's interesting to think that just weeks ago we had thought that this was going to be his convention.
Yeah, fascinating stuff. This is a really interesting moment that we're in, Tyler, and I'm glad to hear the cicadas have made it in time. I think they beat the delegates to Chicago. We're learning a little bit more about the lineup here. Wednesday night is starting to come together. Looks like Nancy Pelosi will speak 2 nights after the man she helped to push out of the race does the same. Tom Suozzi is going to be speaking as well on the matter of immigration. Of course, the New York congressman who won back his old seat on largely that issue of immigration, the way he handled that in New York following the George Santos saga. Tyler, what's the rest of the week looking like? What are the highlights here on the 4 days that we'll be covering?
Right, so besides the names that you mentioned and that we know that President Biden's going to be headlining on Monday night, we know that the Clintons are also going to speak, as well as former President Barack Obama. But Joe, I want to point out that while we are watching for who will be here at the DNC, I'm also watching for who isn't going to be here. We have new reporting now that Senator Sherrod Brown and also Senator John Tester, 2 key senators in some critical Senate races in Ohio and Montana, respectively, say that they will not be here. There's also a reporting coming out that Senator Jackie Rosen, a Democrat in Nevada, will also not attend. I know that our team's working to confirm that. So it's really interesting to watch how some of these vulnerable Democrats are opting not to come to the DNC, saying instead that they are needed back home to campaign because we are really in the thick of it as we count down to November.
Well, we sure are. Tyler Kendall, great reporting with the L going by behind her, the cicadas singing in the trees, a true vision of Chicago. Tyler, thank you. We'll meet you there this weekend. And again, we have a lot of special coverage planned throughout next week, and Rick Davis and Jeannie Shanzano are going to be a major part of it. Of course, Bloomberg Politics contributors back with us here on our signature panel. Before we get to Kamala Harris's economic plan, Jeannie, that idea that some members feel a need to boycott, this is going to happen both parties, right, every 4 years for some frontliners who don't want to necessarily be associated with the incumbent. But in this case, it's not really the incumbent. What's up with the protest?
Yeah, it is fascinating to hear that. And of course, Jackie Rosen is the one that surprises me. But I think it's a reflection of the fact how vulnerable Brown and Tester are, and Jackie Rosen, and how much they realize that they do not want to be associated with the DNC at this point in these states where the DNC, particularly on its economic record, is not particularly popular, even though with the switch to Kamala Harris, it has become more popular, you could say. It still isn't enough to get these folks there. They're just not willing to take a chance. But just fascinating that they are going to be boycotting, or let's say they're going to be spending their time in their states where they're needed.
Well, I guess that's right. Rick, you've dealt with this. You've actually run a convention. Is that just part of the game? You know that there are going to be certain members of the conference who can't be associated with the program you're putting together, and that's okay with you because you also want them to win.
Yeah, for sure. Look, I mean, if you're not on the podium during the course of the week and you're a member of Congress or Senate or whatnot, and you got a race to run, you really got to, wonder, what am I going to do for 4 days? You can't fundraise there because it's in competition with the ticket. You can come to Bloomberg and talk to us. We'll take you. But outside of that, you're twiddling your thumbs and, saying hi to people and drinking and eating too much. So the reality is there's a lot of other things to do in the Democratic Party and Republican Party than going to their conventions. And by the way, no one's ever going to say, gee, we missed you. There's plenty to keep people busy doing. So it's really much to do about nothing.
Mm-hmm. I want to get into the plan here because we're going to not only get a speech today on the economy by Kamala Harris, but it's going to resonate next week. It'll surely be part of her acceptance speech on Thursday night. We'll hear her surrogates putting this forward. Jeannie, Rick took an initial swing at some of these ideas. We've got three big buckets, as I mentioned, we're going to hear about today. Tax credits, and that's specifically the child tax credit, of course, but some other new credit for childless low-wage workers, increasing subsidies for those who purchase insurance on federal health exchanges. Then you've got homeowner assistance incentives here, also a plan to boost home construction, as we learned today that construction fell to the lowest level since May of 2020. That's where the market is, stuck in the mud. And then price controls, the matter of inflation, grocery prices, the ban, as she will propose, on price gouging. Rick asked a pretty important question, though, here, Jeannie. Where is the language? Where is the proposal to cut government spending?
I think what we will hear, and I don't know if we'll hear it today on this point, but certainly going forward, is that she would like to raise taxes on the ultra wealthy. They also would like to ensure that the IRS is collecting taxes, and that is something the Biden administration put forward that Republicans balked at. So I think they are going to have information on how they will pay for this. But, if you look across Democrats and Republicans, quite frankly, the pay-fors on any of this is a huge shortcoming. Look at yesterday with Donald Trump talking. He's talking about lowering taxes, but he never talks about how he is going to pay for what is coming down the pike. And one thing I think that we can all agree on is that even if Donald Trump wins, even if Kamala Harris wins, we are going to see a growth in federal spending that is almost certain. And nobody is going to say how to pay for it in any way that makes economists feel good about these plans. So I think it's a deficit on both sides. I do think she'll talk about raising taxes on the wealthy, but it's not going to cover the spending that they're talking about for sure. And it's a problem.
So pay-fors, I guess, wouldn't be necessarily part of an economic policy address. Rick, does she need to identify at some point, if not today, how indeed you would pay for these? Or nobody cares about this anymore? We'll get religion on debt and deficits some other time.
Yeah, in presidential campaigns in the past, you had to show your pay-fors, right? I mean, like the press would kill you if you said, "Oh, I'm going to cut taxes for middle class," and but you didn't say how you were going to actually fill that budget gap, or I need to reduce spending in some way. Where's it going to come out of, right? What programs are going to get cut? We add to the fabric of overspending because we don't hold these politicians' feet to the fire. I mean, both Trump and Harris and frankly Biden too. I mean, like these are back-to-back administrations that spent over $6 to $7 to $8 trillion a year, massive increases in spending. We are now in the post-COVID era. It's time to pay back the dividend, and nothing will bring inflation down. Nothing will squeeze the prices for consumers more than if the government tightens their belt first. And so before we start going after corporations, before we start giving away freebies, $25,000, anybody who wants to buy a house, where's that coming from? Is that my $25,000 as a taxpayer? I'd like to know.
Right. But that's no different than making the Trump tax cuts permanent, right? Nobody seems to care on either campaign how to pay for any of these things.
Same exact thing. Neither one of these candidates are asked the question after their press conference, where's the money coming from?
Mm-hmm. My Twitter notifications ought to be roughly equally balanced, I think, today. Jeannie, I know I'm striking it right when I get hate from both sides of the aisle here. Is it not deserved, this criticism, for both candidates?
It absolutely is. And, and by the way, Joe Matthew, nobody could hate you. So I reject that proposition. But it's
haven't gotten to know me yet.
It's absolutely true that this is both sides. And the reality is it's the American voter, all of us, who are to blame for this because these politicians are doing what they think will get us to support them. And it is not a popular thing to stand up and say, we have Social Security is going to be insolvent, so we're going to take that on. So, we have to look at
I wish I had a chance to ask Gene Sperling about it. Jeannie Shanzano, Rick Davis, thank you. Great panel. The speech, by the way, a little over an hour away. Kamala Harris, you'll hear it live right here on Bloomberg TV and radio.
Is the Vivian Tom clientele?
Yeah, power women, like the dragon women. They're lawyers, they're CEOs, they're all important decision makers, women in the world.
Why do you position your products for this group of women?
When I started, designing, I always want to do something that is empower women.
When you take a look at your store, there is something for everyone. Take a look at the T-shirt, for example.
My customer growing, like 30 years already, so they become more powerful. I also want to grow my Gen Z audience too, they are like in the 20s, so it's a more affordable price for them. And then, my powerful woman's daughter wearing their mom's dresses, and they feel that the power, the energy. So now they come back to the store and they buy more.
thoughts on fast fashion? It's been transformative. It gives the masses access to fashion, but there's a cost to it, downside to it.
My first notice is too much waste. I think it's also how I grow up, making your own clothes and making something as well special, as well unique. It's like timeless. And now you see that everybody is looking the same, like wear sweatshirts and wear t-shirts. And for me, it's just like when they wear something that's special, they feel empowered.
Is there a need for fashion to be more mindful of the impact it's having socially, environmentally?
Definitely.
Is it happening enough?
I think it's happening. It's gradually happening. All the designers are doing, everybody is thinking about this subject at this moment, thinking how to be more sustainable, how to be more environmental friendly.
Do you think the fashion industry is doing enough, to ensure that it is sustainable? There's so many targets out there. Are they even realistic in wanting to achieve them?
I think some of them are just like they're using sustainable ideas as a marketing concept only. They're actually not really doing it. I think as a designer, it's really important to really make it happen. Every collection, I'm thinking about how to do it and how to tell the customers. I think that is our responsibility to educate our customers.
The top names in tech are on Bloomberg.
AI tools can help democratize storytelling and turn everybody into a creator. Our vision of the future is individual creators will look like Disney. They'll be able to go from an idea to a final story. They'll be able to publish that. They'll be able to merchandise it. They'll be able to do it across the franchises and stories they create.
Nobody covers technology like Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world.
Fed Scoresby says there are some things that are flashing yellow.
Only on Bloomberg. Context changes everything. Today's CFOs focus on much more than just revenues and margins. Their impact goes far beyond the balance sheet.
The world is coming at us faster than it ever has. Our first job is to intimately understand and anticipate the consumer's needs.
You need to identify opportunities. It's an incredibly fun job.
Fed Scoresby notes that small businesses' defaults are up. Now it's getting a little cautionary.
New episode September 11th, only on Bloomberg. Brought to you by Workday.
Goolsby says unemployment is up, and that's a cautious sign.
It's 1:40 on Wall Street. We do check markets all day long. Here at Bloomberg, we have got the Dow, the S&P, NASDAQ all advancing. S&P is on track to close out its best week of 2024. If we do advance today, it will be the 7th day of gains for the S&P 500 index. Here's where we stand. The S&P now at 55.59, up 16, a gain of 0.3%. Dow Industrials up 113 points, also up 0.3%, while the NASDAQ Composite Index is up 71. That is a gain of 0.4%. 10-year yield at 3.88% with a 2-year that's yielding 4.06%. Spot gold up $40 the ounce to $24.97, a gain of 1.6%, while West Texas Intermediate crude oil now slumping 2%, WTI 76.58 a barrel. MasterCard is cutting 3% of staff worldwide, according to a spokesperson for the payments network. MasterCard shares up now by 0.2%. That will work out to about 1,000 people based on MasterCard's reported employee count at the end of last year. Again, recapping, S&P pushing higher by 16, now up 0.3%. Balance of Power continues, the Friday edition. Back we go to Washington once again. Your host, Joe Matthew.
Thank you, Charlie Pellet. Welcome to the Friday edition, indeed, of Balance of Power. You're almost there, the threshold of the weekend, with some important economic data to digest. Before you get on that plane to Chicago, I'll meet you there. But housing is in the air today, and so is consumer sentiment, Rick Davis's favorite political poll. They both tell a slightly different story here. Housing is just as stubborn as can be, with construction falling to the lowest level since May of 2020. Remember what you were doing in May of 2020? Not a good time for the housing market. And Kamala Harris is going to be talking about ways to potentially unlock some opportunity there when she speaks later today. But this is a very difficult scenario we're looking at ahead of potential interest rate cuts next month. The other, as I mentioned, though, a bit rosier, consumer sentiment rising for the first time in 5 months. And it's partly due to the fact, as researchers found, that Joe Biden dropped out of the presidential race and consumers are feeling a little more optimistic about things. Just 2 weeks after we were hearing the R word again in Washington and on Wall Street. The markets have done a wild round trip since then. And we wanted to compare notes with our friend David Weston to get a sense of just where we are. Of course, the host of Bloomberg Wall Street Week is with us live at World Headquarters in New York. David, remarkable here to see consumer sentiment jumping with this political evolution happening as the backdrop. We saw immediate changes in moods when Joe Biden decided.
How about it, Joe? Exactly right. I mean, the markets are all breathing a very big sigh of relief. They had kind of topsy-turvy time. You have to wonder whether the Kamala Harris campaign isn't as well, because as you say, it wasn't that long ago all the banks were taking back out their recession estimates, right, and revising them again. We were talking about it again.
Yeah.
But right now, it doesn't look like it's going that way, which they've got to be pretty happy about. And on the housing front, it did strike me that we have Kamala Harris trying to outdo Oprah Winfrey. Instead of you got a car, you get a house. Anybody, you got a house. You get a house. You get a house. It's pretty. That's
reach under your seat, David.
Yeah, exactly. It's that time of the season, isn't it, that we've seen in elections, Joe, where basically the candidates, from both sides, are just telling us, "Boy, we're going to have everything with them." Chicken in every pot. Wasn't that what they used to say?
Yes, sure. Now I think it's a pot in every chicken, depending on the state you're talking about. So to your point, she's going to offer as much as $25,000 for first-time home buyers. More than 1 million first-time home buyers.
And Goolsbee says if we move to less restrictiveness, it will ease some of these credit conditions.
Support. But how do you pay for that?
Yeah, well, that's the big question. Although I must say, Joe, I haven't heard either parties particularly concerned about how to pay for anything lately, right? I mean, we can do almost anything. We can borrow more money. Even as the economists tell us at some point there's going to be a piper to pay here. But thus far, nobody seems too concerned about it. And it'll be curious, actually, I'll be curious after the election to see whether there are economic strategists and policymakers on one side or the other, whoever gets to be president, who actually starts to deal with some of this stuff. And whether the bond market makes them deal with some of it, which is entirely possible.
You're right. Look, these two campaigns have a lot in common when it comes to not showing how to pay for things. You consider extending or making permanent the Trump tax cuts, for instance. Never mind no tips on or taxes on tips.
Yeah.
Maya McGinnis would tell you that costs $200 billion right off the top there, but nobody wants to talk about numbers.
And no
I guess
tax
between now and
no tax on Social Security. And by the way, let's up the child tax credit to $5,000. It all sounds very good. At the same time, we did talk to an economist, a prominent economist. He's Jan Hatzius. He's the chief economist for Goldman Sachs today for Wall Street Week. And we asked him about that chance of recession, and he tied it right back, actually, the uncertainty coming out of the presidential elections. This is part of why he said he has a somewhat, not highly, but a somewhat elevated chance of recession because of that election.
The way I think about it is that 15% is the long-term average. We've had one recession every 7 years in the post-war period. And conceivably, there can be points in the business cycle where you might want to say the 12-month forward probability is less than 15% because inflation has been beaten and aggregate demand still seems to be growing at a decent pace. The Fed is lowering interest rates. I'd be reluctant, though, given the political uncertainty and the uncertainty around economic policy, to go significantly below 15%, even if everything else sort of looks on track. Just because there are significant uncertainties around tariff policy, around tax policy, and just around a number of political issues, geopolitical issues that are also, of course, an important factor and will be affected by what a new administration does.
So, Joe, there you have Jan Hatzius from Goldman Sachs, and it turns out that we up here in New York are paying attention to what you're doing down there in Washington. There's a certain amount of uncertainty around things like trade policy and geopolitics. So it does make a difference to Wall Street, after all.
Paying attention with great trepidation. Look, he made big news, David. This is an important conversation when he increased recession odds to 25% from 15. That was a scary moment 2 weeks ago. We've basically round-tripped since then, so Wall Street doesn't seem to be concerned about it. What is the market telling us?
Well, you know how Wall Street works. They were concerned they got over it right quick. And even that Monday, a week ago Monday, when everybody was so concerned about an emergency Fed rate cut, you remember, there were people really putting pretty good odds of that. The thing that people, I think, were not focused on that now they do talk about is the markets were functioning just fine. They weren't freezing up. And in fact, the bond market was doing just fine. And so it was a puzzle to me why the Fed would step in that circumstance. As far as I know, part of the mandate for the Fed is not to make sure I don't lose money on a stock that I paid too much for. You know, and it seemed like Wall Street was saying, boy, you should bail me out, Jerome Powell. I paid too much for the stock. I might lose some money here. That's not very fun.
Doesn't exactly work that way, but it certainly doesn't look like a recession in the cards when you look at this market. Some of the data might argue with that, but that's also in part why we have David Weston. Aren't you in the perfect spot right now, truly at the intersection of politics and the economy, which is why Bloomberg Wall Street Week is so important and such a great part of the conversation here every day. David, it's good to see you. We'll look forward to the program. 6 p.m. Eastern Time, Wall Street time, here on Bloomberg TV and radio. David, we'll see you back here next week. What we'll have to talk about then with the convention in our rearview mirror, but we want to add another voice on the economy here because this is important what's going on right now. And we're about an hour away from Kamala Harris rolling out her economic policy proposals. Lindsay Owens is with us, the executive director of Groundwork Collaborative, former senior economic advisor to Senator Elizabeth Warren. Lindsay has been calling for interest rate cuts, by the way, since long before July. And she is with us now as we look ahead to September. Lindsay, there's a concern that the Fed has waited too long. I don't know what difference 25 basis points might have made. But when you look at that housing report today, construction falling, I should say, to its lowest level since May of 2020. Are we to believe that Kamala Harris can unfreeze this market with the plan she's going to outline today?
Yeah, so we need a few things working in our favor here. First, we absolutely have to see the Federal Reserve take decisive action in September. 50 basis points, maybe 75 is actually what the doctor ordered at this point, given where the housing market is. But second, we absolutely are going to need to bring incentives online for new construction. And that's exactly what the Vice President is going to lay out this afternoon in her economic agenda, which includes at least 3 million new units. By the way, I am not someone who thinks this is some pie-in-the-sky wish list. As you correctly mentioned, next year we see key provisions of the Trump Tax Cuts and Jobs Act expiring, which means there's going to be a live legislative tax fight next year. The door is open. There's a moving vehicle. Congress is going to act on the tax code. And what better time to start providing real incentives in the tax code for new construction? So I think this is actually a very feasible, very achievable agenda that the Vice President is planning to lay out later today. And I think it could happen as early as next year.
Wow, fascinating. We're going to hear about a lot of things from Kamala Harris today, not just housing, grocery prices, but also tax credits. And this is an area of a bit of overlap between these two campaigns, Lindsay. What do you make of a world in which J.D. Vance is offering a more generous child tax credit than Kamala Harris?
Look, I think the child tax credit has grown in popularity over the last decade that I've been in Washington and has started to have some bipartisan consensus in support of it. Of course, it was Joe Biden, Democratic president, who pursued the largest increase in the child tax credit. And I would expect that the vice president will follow suit. And her campaign has released a few additions and enhancements to the child tax credit that she'll be talking about later today. But both parties, I think, understand that child poverty is a policy choice, one that we can easily solve. And by the way, we have the money to solve this. I don't know if you remember, but the Biden-Harris budget lays out $5 trillion in taxes on the wealthy and corporations. That is plenty of pay-fors, plenty of money to fund a sizable and significant increase in the child tax credit, getting cash in families' hands, getting families back in onto Main Street, shopping, buying things they need, groceries, and the rest.
How do you pay for down payment support of $25,000 for 1 million first-time home buyers?
Yeah, I mean, look, we've got $5 trillion in taxes on the wealthy and corporations in the Biden-Harris budget, and that's sort of a relative consensus position, right? We can move up the corporate tax rate, which Donald Trump lowered to 21%. There are Democrats who want to see it at 25%. There are Democrats who want to see it at 28%. There are Democrats who want to see it at 35%. So we've got a lot of room to run on the corporate tax rate. We can bring individual rates back to where they were in 2017 before Donald Trump lowered them. So I think there's actually huge room to run here on pay-fors. I'm not worried about it at all.
Well, it also comes with a proposal to create a federal ban on price gouging. Does this agenda, specifically the federal ban on price gouging, which would, of course, require congressional approval, does this entire agenda ride on a Democratic sweep in the House and Senate?
Yeah, that's a great question. As I mentioned, I do think the tax pieces are very achievable in most scenarios, given that Republicans in Congress are going to want to see tax cuts extended for the middle class. And so I think that provides a lot of running room to get quite a bit done on tax next year. The child tax credit expanded, tax incentives for home buyers and for development as well. I think, a federal ban on price gouging probably would require a trifecta. However, remember, there are pieces of price fixing that can be taken on now. We've seen price fixing in sugar, in beef, in chicken, in eggs, and the current Department of Justice is pursuing some of these aggressively. They're also pursuing a price fixing case in the housing market. We've had a company, RealPage, an algorithmic price fixing software platform, helping landlords price fix rents at large buildings, multifamily buildings across the country. So there's a lot the department can do on enforcement and on regulatory authority already in the food and agricultural space. I'd love to see the federal price gouging ban move in a legislative trifecta as well.
Boy, that would be quite an accomplishment. Lindsay, I've got less than a minute left here. I don't know if you saw Donald Trump outdoors with all the groceries yesterday. He had cereal, milk, eggs and bacon, sausage all out there in the sun. Will his plan lower grocery prices?
Yeah, I mean, look, we've seen the economic analysis of the Trump plan and of Project 2025, which is really the full Republican agenda headed into a Trump presidency, if that's where we land in November. And I think the scoring on this is pretty clear that we would see across the board price increases due to a number of his policies, including the large tariff proposals.
Well, before I get all the tweets, Donald Trump has separated himself from Project 2025. That's a Heritage Foundation thing. Lindsay Owens, great to see you. And I know there are lots of former Trump administration officials there. Executive Director of Groundwork Collaborative. Great to have you back, Lindsay, and thank you for being part of our conversation today in Washington. As we wrap the early edition of Balance of Power on Bloomberg TV and radio, back with more at 5 p.m. Eastern Time with details on Kamala Harris's economic proposals. We'll see you back here on Bloomberg.
In tech are on Bloomberg.
AI tools can help democratize
loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Morning from our world headquarters in New York. I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
Also coming up this hour, we're going to dig deeper into today's disappointing, weaker housing data, what it all means. We've got an insider on the industry. We're talking about Kate Kaminsky. She is COO of Walton Global. And then, of course, politics front and center here.
Have to straightforward with that. So Vice President Kamala Harris headed to Raleigh, North Carolina to give an economic speech as Michigan consumer sentiment, of course, increased for the first time in 5 months this morning, Carol.
Yeah, so looking forward to the specific details when it comes to her thoughts on the economy and what she wants to do with it. Also, the saga that is Paramount Global. We've got another potential offer or so we're going to get into that. And then we're also going to talk about the rich. Well, they can't sell their art, so it turns out they're borrowing against it. So
it's really fascinating.
It is. It's among our most read. So a lot to come over the next 60 minutes. First up, though, let's get a check on the trading day. Your top business stories. Here is Charlie Pellett.
All right. I thank you very much. And here's what's going. A lot of green on the screen right now with the Dow, the S&P, NASDAQ, all advancing. 2 hours to go until we wrap up potentially what looks like the best trading week of 2024. S&P right now at 55.55, up 12, a gain there of 0.2%. We got the Dow up 117, up 0.3%, while NASDAQ is up 47 for the NASDAQ Composite Index, a gain right now of 0.3%. 10-year yield 3.89% with a 2-year 4.06%. Spot gold up at $24.99 the ounce. Gold up 1.7%. We did have spot gold trading above $2,500 briefly. West Texas Intermediate crude down 1.7%, 76.80 for a barrel of WTI. Applied Materials after earnings down now by 1.7%. It did deliver an inline sales forecast that disappointed investors who've been looking for a bigger payoff from artificial intelligence spending. So again, recapping a Friday rally, just about the best level of the day right now, up 12, 55.55, a gain there of 0.2%. I'm Charlie Pellett, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. All right, well, Friday brought another batch of economic reports. In fact, they were kind of mixed readings on the U.S. economy. We had U.S. consumer sentiment rising in early August for the first time in 5 months on more optimistic expectations about their finances as inflation steadied. The caveat, though, this is interesting. The rise in sentiment was partially driven by political reasons after President Joe Biden's decision not to seek re-election. So we had that going on. We also had new home construction sinking to the lowest since the aftermath of the pandemic. So hence the yin-yang, if you will, of the U.S. economy. Let's get into it and let's get some sense of what it really means about the U.S. economic backdrop. With us is Bloomberg News economics editor Molly Smith, joining us from New York City. Molly, good to see you. Good to be talking with you. Should we be conflicted a little bit over this data?
Well, they're measuring two different things here, Carol. I mean, we've been seeing home construction come down for several months now, particularly for single-family construction, and it's to be expected. Builders had been working really hard to ramp up inventory. Inventory is now, of new homes, is the highest level since 2008. But homes are so unaffordable that people aren't buying them. So it's only natural that you would start to see builders scale that pace back until mortgage rates come down, prices hopefully come down, and people can start buying homes again. The Michigan data, like you said, really reflecting right now just that boost from Democrats and seeing Kamala Harris step into the race in place of Joe Biden. Interestingly, though, from the Michigan report, worst conditions for buying a home ever. And this is in data back to the 1970s, I believe. So that metric has been pretty weak in the Michigan survey for a while, but this hit a record low in early August.
As you know, Molly, on the back of those consumer price as well as producer price readings that we saw earlier this week that still showed that inflation was contained. And then, of course, stronger than expected retail sales data. How do you fit in when it comes to the sentiment data as well as the housing data into the Fed's thinking, especially because we're going to hear from Fed Chair Jerome Powell at Jackson Hole in a week from now?
Right. I think, all of this is still painting the picture of a gradually moderating economy, and especially, in light of the jobs data that really freaked a lot of people out 2 weeks ago, that, we're getting some data now this week that showed, okay, like maybe that was a bit overdone. We've seen people scale back their bets on the 50 basis point cut expectations for September. It's looking more like we're back in the 25 vicinity now. The data right now is just not showing that the economy is falling off a cliff. It's showing that inflation is moderating, that other parts of the economy are moderating, but that consumers are still spending money. And that's, again, what you would want to see if you're going to have a soft landing of the economy. It's, of course, great to see that sentiment has picked up, but the level's still pretty depressed compared to it was before the pandemic. And we've also know that sentiment historically is not necessarily the best predictor of spending. So take that for what you will.
Well, right. This is why I kidded yesterday, Molly, that Jay Powell is like breaking out his 150-year-old cognac, around the fireplace, because he's got to feel pretty good. This wasn't an easy thing to navigate out of. Having said that, right next stop is Jackson Hole. So does he have a delegate thread to a needle to thread rather next week, or is he in a pretty good case in terms of not maybe having to say much next week?
I think it's always, delicate when Jay Powell is speaking. We know that really anything he can say can move a lot of money in not a lot of time. So I think he certainly doesn't take that responsibility lightly. I think that will be really the key thing for everybody to look out for now going forward is going to be what the August data show, particularly for the jobs market. Are we going to see, some of that weakness faded away? And also for inflation, is it still moving kind of sideways, kind of down at the moment? We did, at least on the jobs report, though, get state level data today, and that was helpful in seeing. A lot of people are wondering how much of a role did Hurricane Beryl play in the weakness, and was it really all coming from Texas? And we got state-level data today confirming that it was not the case, like the BLS had initially said 2 weeks ago. So that was good to see that, one, it's not Beryl, but then two, it's like, it kind of showing the rest of the labor market is broadly weakening.
Walk us through the Fed speakers that we did hear from this week, like Austin Goolsbee, also Raphael Bostic, who they had a couple different points there, but they were pointing at different weaknesses that they were seeing within the economy right now.
And I was going to say, Austin Goolsbee specifically, president of the Fed Bank of Chicago, talked about the weakness in the labor market, right? He was pointing to that because it does feel like that narrative, that Fed narrative about their focus on housing and weakness is definitely there.
I mean, I think all Fed speakers right now are rightfully focused on the weakness in the labor market, and that's really what Powell has said as well, is where the committee is turning its attention to. That when you have a dual mandate of, on the one side, ensuring maximum employment, and on the second side, promoting price stability. When prices are looking a lot more stable, you have to turn to employment, and that's what they're all doing right now. And the employment data has definitely been softer, but I think they're all very quick to point out that they don't want to overreact to one piece of data, and that 1 month does not make a trend. So it's really right now, I think, just about, maybe calming down the jitters that the markets have just been very on edge lately, and knowing that I don't think they want to introduce any new thoughts right now that are going to tip the narrative, especially ahead of Jackson Hole.
Hey, kiddo, really quick before we let you go. Next week, Jackson Hole, obviously front and center, what Jay Powell says in his Friday speech, but we also do get another weekly jobless. We get Fed minutes. We also get new home sales, existing home sales, so another read on the housing market. Anything that you think investors should keep an eye on, just quickly?
Yeah, I mean, those are the big ones right there. I think Jackson Hole is going to be by far probably the biggest potential market moving event of the week. But, jobless claims have gotten a lot of attention too now as we're really looking at that labor market mandate.
Right, and more kind of more current data, right?
Totally,
in terms of getting a read on it, which is important.
Yes.
Have a great weekend. So glad we could check in with you. Bloomberg News economics editor Molly Smith. All right, that is today's U.S. economic thinking. Let's stay a little bit with this morning's weaker housing report, and to someone who really understands the housing market so well. Kate Kaminsky is the chief operating officer of the privately owned asset and real estate investment company Walton Global. They've got nearly $4.4 billion of land under management, over 90,000 acres under management across the U.S., also in Canada. She joins us once again from Scottsdale, Arizona. They operate, by the way, in the retail, industrial, and commercial sectors as well. Kate, good to have you back with us. How are you?
Doing great. Always great to be on.
Well, it's great to have you back with us. Your read on the weaker housing data that we got today. Are Molly Smith just breaking it down in terms of home builders? They built, inventory's up, now they're holding back. But what's your read on it? How do you kind of square it with the data point versus what you are seeing specifically?
Yeah, I think we were all anticipating that this was going to occur. We saw 6.8% down month over month. And that was largely driven by the single family sector, which is down about 14%. We're out there working with 14 of your top 20 public builders, and the long-term outlook continues to be strong and bullish with all of them. And so, like with the jobs data and other things that we've seen, I think that the market is really in a wait and see mentality right now. You've got the market, pricing in Fed rate cuts, about 3 of them probably this year. Is it going to be 50 basis points or 25 at the next meeting? That is to be determined.
Fed Scoresby says lately business contacts say they can't pass on higher prices to consumers as before.
To this uncertainty, and why would I get into a mortgage today when there could be reductions in the future? So, we remain very optimistic in terms of the outlook, not just for 2024, but for the next several years in the new home sector.
And I have to bring up, because you're talking about those rate expectations, when you do have swaps traders paring back those expectations, for instance, like in September, they're only expecting about 25 basis point cut there from the Federal Reserve. How measured of a approach? Because if it isn't as aggressive, what does that do for sentiment, and how long does it take for people to wait until they could potentially have better deals in the housing market?
Well, I think that, of course, that's going to have an impact, but we need to take a step back and look at, what is really fueling this sector today. And it's definitely new home building as compared to resale. We've talked about the lock-in effect before that we're seeing for anybody that's in existing homes, not wanting to get out of those low-rate mortgages. But your builders are continuing to really push incentives. It increased in August to 64% of builders are still offering incentives, and 33% of builders offered price cuts month over month. And so they're really working to get these home buyers into homes in order to continue to drive their market share.
You said you're optimistic, home builders are optimistic, and it's not just this year, but next year. Why is that? Is that the expectation that the rate environment eases? What is it? Is it demand? What specifically?
I mean, your underlying market fundamentals are not changing. We saw last year the largest population increase in the U.S. in history. Migration is at all-time highs, and you've got these younger generations, the millennials, a little bit later, but moving into household formation years, the largest population that we've seen, and they too need a place to live. And so, you know, when we say we're bullish, it's because really where everybody seems to be pretty comfortable is around 5.5% for mortgage rates. And when you have your builders out there who are offering these incentives to get them locked in at those rates or lower, I think they're going to see strong performance. And where Walton focuses is in the land space. So we're not developers specifically. Sorry, what was that?
No. And go there, because it's one of the reasons we love talking with you. When we talk about home building, it's first of all, it's land acquisition, right? It's, you know, what you have to deal with in local markets, you know, and getting all, you know, the approvals, if you will. So talk to us about where you've been buying and how much buying and how we last, I think, talked with you back in April, like how that has shifted in the last few months. Or how it compares.
We're still focusing on that southern smile of the United States, but continue to focus on those markets who are pro-growth, pro-development, and as I've talked to you about before, you know, areas where we're confident we're going to be able to get approvals, and where they're going to have funds available to finance infrastructure. Texas, Florida, so many states really have great programs in place, and your builders continue to drive land banking strategies, off-balance sheet financing strategies, so that they're putting their capital to use in the most effective manner. Their amount of contracts that are under option as compared to outright purchases are the exact inverse to where they were a year ago. 60-70% of deals under option, and they're sitting on a lot of cash. Horton has $3 billion in cash. Their investment grade rating just got upgraded to A-.
Says the impact of past hikes may not be fully realized.
Strong internal fiscal policy.
I have to ask, since I am a millennial, and I do have an apartment in Manhattan, but I do not own a home. So you were talking about that southern smile in the South, but what about when it comes to those more expensive corners in the U.S. and what you're seeing there as far as the biggest obstacles, which obviously the obvious ones are the price points there?
Yeah. Well, you know, we actually feel that this cooling that's currently happening is needed, not just so that the Fed actually responds and starts to bring rates down, but also we need home price appreciation to cool off a bit as well. My builder colleagues might not appreciate that comment, but we need to ensure that affordability gets in check. And so this current little pullback, and I do believe it is just a short pullback, is necessary to control that. The Northeast actually saw great numbers, not so much in the single family space, but multifamily is booming there. Townhomes, condos, and so you know that demand, as I said, continues to be there, and we're seeing some tempering, hopefully, in that pricing.
Talk to us, too, about the investor money that comes in. You guys have global investors. Where's it coming from? What kind of money is coming in that, you know, is giving you even more to put to work? Just trying to get an idea of the investor psyche here.
So the United States continues to be a place that I think on a global basis, investors, you know, are very confident in the underlying market fundamentals, and in our policy here, as compared to other places where you know this industry may not be as regulated. You know, we've seen complete shifts from the way things, you know, used to be with lending standards, et cetera, to where they are today, where everyone is quite confident that if we do see a recession in the future, it's certainly not going to be like the one that we all remember still in this industry from back in 2008, which was really focused on the housing market. And so foreign capital continues to be abundant in terms of wanting to place it into U.S. real assets. And so we have a heavy focus on the Middle East, Asia, and as well as right here in our back door, the United States. There's a lot of market volatility. We all saw it last week. Real estate, it tends to be a little bit more slow and steady.
All right, great stuff as always. Kate, so glad we could check in with you. So appropriate on this day when we're focused so much on the home builders and the housing market. Kate, have a great weekend. Kate Kaminsky, she is the Chief Operating Officer of the privately owned asset and real estate investment company Walton Global, joining us there from Scottsdale, Arizona. All right, folks, we are listening and watching Bloomberg Business Week. When we come back, we're going to check into a name that is definitely on our radar, certainly when it comes to the equity universe. We're talking about Paramount Global, also awaiting and watching anytime soon Vice President Kamala Harris on the campaign trail. Of course, the Democratic presidential candidate expected to talk about the economy and her economic policies. We'll take you there live. This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money. If I had invested with you, which I wish I had, what kind of rate of return would I have had over that 10-year period of time?
Over 100% a year on average. On average.
100% a year, that's pretty unusual.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Billionaire Gautam Adani founded one of India's biggest and most controversial business groups. After being rocked by accusations from short seller Hindenburg Research last year, Adani is now preparing for the company's future in a real-life succession story. Meet the family members he's hand-picked to take over the business as we deep dive into the facts and rumors surrounding the Adani Group. Inside Adani, a Bloomberg exclusive replays all weekend, only on Bloomberg. The names that move markets are on Bloomberg.
Don't expect we're going back to zero, because zero was the product of huge global shocks. I think to get to there, something really bad has to happen that we're not currently expecting. So it'll be somewhere obviously in between. I think we've made a big point of saying policy is currently restrictive, so you can deduce from that we'll be lower than where we are today, but I think it's very clear that we're not going back to zero.
Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything. The top names in tech are on Bloomberg.
AI tools can help democratize storytelling and turn everybody into a creator. Our vision of the future is individual creators will look like Disney. They'll be able to go from an idea to a final story. They'll be able to publish that. They'll be able to merchandise it. They'll be able to do it across the franchises and stories they create.
Nobody covers technology like Bloomberg. Context changes everything.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. I'm Charlie Pellet. We have got the Dow, the S&P, NASDAQ all in the green. S&P on track for its best week of 2004, defined as a gain of 4% on the week for the S&P. Here's where we stand off our session highs with the S&P now at 55.53, up 10, a gain right now of 0.2%. Dow Industrials up 100 points, up by about 0.2%. The NASDAQ Composite Index up 35, up by 0.2%. Russell 2000 Index of small cap shares also advancing, up now by 0.2%. 10-year 3.89%, the 2-year 4.06%. Gold is higher by $42 the ounce, $24.99 right now. Was trading above 2,500, up by 1.7%. A retreat for West Texas Intermediate crude oil. Crude down 1.5%, 77 even a barrel. Rivian Automotive has paused production of the electric commercial van it makes for Amazon because of a part shortage and the latest supply chain snafu for the EV maker. We've got Rivian shares lower now by 4.3%. Amazon is down 0.2%. Recapping, S&P right now up 10, a gain of 0.2%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You are listening and watching Bloomberg Radio. I'm Carol Master along with Jess Metton in for Tim Stenovec, who is off today. This, of course, is Bloomberg Business Week, radio, TV, YouTube, Bloomberg Originals. There's been a lot going on in terms of politics, and we have seen the two candidates out on the campaign trail. We are expecting Vice President Kamala Harris. She is in Raleigh, North Carolina. She is expected to deliver an economic speech that could get into some of the things that we've talked about this week, Jess.
That's
whether
right.
It's price gouging in the grocery and food store industries, maybe a tax credit when it comes to families when they first have a child. So we want to know the details. This is something that's so pertinent and important to the Bloomberg audience.
It is. And the plan that they're expecting potentially that she could unveil when it comes to that child tax credit that you were alluding to was basically around $3,600 to $2,000 per dependent, with a supersized $6,000 credit for newborns. So this is something that's been crucial. And during parts of the pandemic, there were different subsidies and different credits there that people really benefited from. So it's going to be interesting to see what she lays out when it moves forward here.
And as we know, when it's the campaign trail, you're in a different city, a different state. You have numerous individuals from that community who get up ahead of the candidate. And right now, as I look, we have Mike De Los Santos. He's the owner of Mike D's Barbecue taking the stage. He is expected to introduce Vice President Kamala Harris. But again, pulling on, again, community members. And you get a good feel of a city, a state, a town, and really the people that make up that community. And also what is front and center for them.
That's right. And especially as we know, we talk so much about inflation, consumer prices, especially with the reports earlier this week that still showed inflation was contained. But still, it's one of those conundrums, as you know, Carol, when you do have prices that appear to be ebbing, but when you're going to the grocery store, there's different dynamics that happen there. And especially when you're thinking about different grocery prices. So she is supposed to speak on different items on that agenda as well.
Yeah, and it's interesting. You know, we did talk with our Josh Wingrove earlier this week, who put out a story about what Kamala Harris would mean for the U.S. economy, what it means for U.S. businesses. And while her economic agenda has been taking shape, you know, we are expecting her to focus on those kitchen table issues and not necessarily some big sweeping changes, not much difference potentially from what we have heard from Joe Biden over the last 3 years. Nothing sweeping in terms of regulatory proposals, but really what matters to individuals when it is to putting food on the table,
That's
you
right.
know, making sure they have a roof over the head of their families. So that is what's really, really interesting.
And we were just talking about the cost of housing in our prior segment here. So something else that she's supposed to talk about is the tens of billions of federal dollars that could be spent to improve the supply of federal housing, Carol.
All right, we're hearing some cheering. And as we said, we've been listening to Mike De Los Santos, owner of Mike D's Barbecue, on the stage, getting ready to introduce the vice president. Some cheering as she is making her way into the area. Again, a big crowd there. But like we said, it's off and running. We're under, 80, 90 days here until voting, although voting can begin for the campaign and for the election in September. Let's take you to Raleigh, North Carolina, folks, as you hear the crowds and Vice President Kamala Harris.
Hello, family and friends. Oh, it's good good to be back in North Carolina. Oh, it's good to see everyone. Thank you. Oh, it's good to see everyone. Good afternoon, everyone. Please have a seat if you have a seat. Please have a seat. Mike D, I have to tell. So Mike D's Barbecue, let me tell you one of the biggest fans of Mike D's Barbecue. My husband, Doug Emhoff. And thank you, Mike, for sharing your story. And I'm just so sorry for what your family has been through. But you have, out of an incredible tragedy, done so much for the community, and you are such a role model. So thank you, Mike, for everything you did. Thank you. And good afternoon to everyone here. Thank you to all of the incredible leaders with us today, including my friend, the Governor, Roy Cooper. Where is he? Here with his daughter. Every time I land in North Carolina, I'm just literally coming down the stairs of Air Force Two, I will shout to Roy Cooper, "What number is it, Roy?" And today he shouted 16, which is the number of times I've been in this beautiful state since I've been vice president. Every time. I want to thank your next governor, Attorney General Josh Stein. He's doing incredible work. He's going to be an extraordinary governor. Representatives Adam, Manning, Foushee, and Nickel, thank you all for your support, for your friendship, for your leadership. Chair Thomas of the Wake County Board of Commissioners, thank you for all that you do. And to all the leaders that are here today, including the students and instructors here at Wake Tech North. So thank you all. So listen, this election, I do strongly believe, is about two very different visions for our nation. One, ours, focused on the future, and the other, focused on the past. We see that contrast clearly in many ways, including when it comes to how we think about the economy. So our country has come a long way since President Biden and I took office. At that time, we sadly remember the millions of Americans that were out of work. We were facing one of the worst economic crises in modern history. And today, by virtually every measure, our economy is the strongest in the world. We have created 16 million new jobs. We've made historic investments in infrastructure, in chips manufacturing, in clean energy. And new numbers this week alone show that inflation is down under 3%. And as President of the United States, it will be my intention to build on the foundation of this progress. Still, we know that many Americans don't yet feel that progress in their daily lives. Costs are still too high. And on a deeper level, for too many people, no matter how much they work, it feels so hard to just be able to get ahead. As president, I will be laser focused on creating opportunities for the middle class that advance their economic security, stability, and dignity.
NYMEX natural gas September futures settle at $2.12 a barrel.
An opportunity economy.
Diesel September futures $2.32, gasoline September futures $2.31, and NYMEX WTI crude September futures settling at $76.65 a barrel, which is down $1.51 or 1.93%.
To succeed. Everyone, regardless of who they are or where they start, has an opportunity to build wealth for themselves and their children. And where we remove the barriers to opportunity so anyone who wants to start a business or advance their career can access the tools and the resources that are necessary to do so. I will focus on cutting needless bureaucracy and unnecessary regulatory red tape and encouraging innovative technologies while protecting consumers and creating a stable business environment with consistent and transparent rules of the road. As president, I will bring together labor with small businesses and major companies to invest in America, to create good jobs, achieve broad-based growth, and ensure that America continues to define the future and lead the world. And key to creating this opportunity economy is building up our middle class. It is essential. The middle class is one of America's greatest strengths. And to protect it, then, we must defend basic principles, such as your salary should be enough to provide you and your family with a good quality of life. Such as no child should have to grow up in poverty. Such as after years of hard work, you should be able to retire with dignity. And you should be able to join a union if you choose. Building up the middle class will be a defining goal of my presidency, because I strongly believe when the middle class is strong, America is strong. So in the weeks to come, I will address in greater detail my plans to build an opportunity economy. And today, I will focus on one element that's on the minds of many Americans as they pay their bills at the kitchen table or walk the aisles of a grocery store. And that is lowering the cost of living. So every day across our nation, families talk about their plans for the future, their ambitions, their aspirations for themselves, for their children. And they talk about how they're going to be able to actually achieve them financially. Because look, the bills add up. Food, rent, gas, back to school clothes, prescription medication. After all that, for many families, there's not much left at the end of the month. I grew up in a middle-class household. For most of my childhood, we were renters. My mother saved for well over a decade to buy a home. I was a teenager when that day finally came, and I can remember so well how excited she was. I kind of understood what it meant, but we called her Mommy. Mommy was so excited, it just made us excited that she was so excited. Later in college, I worked at McDonald's to earn spending money. Well, some of the people I worked with were raising families on that paycheck. They worked second or even third jobs to pay rent and buy food. That only gets harder when the cost of living goes up. When I am elected president, I will make it a top priority to bring down costs and increase economic security for all Americans. As president, I will take on the high costs that matter most to most Americans, like the cost of food. We all know that prices went up during the pandemic when the supply chains shut down and failed. But our supply chains have now improved, and prices are still too high. A loaf of bread costs 50% more today than it did before the pandemic. Ground beef is up almost 50%. Many of the big food companies are seeing their highest profits in 2 decades. And while many grocery chains pass along these savings, others still aren't. Look, I know most businesses are creating jobs, contributing to our economy, and playing by the rules. But some are not. And that's just not right. And we need to take action when that is the case. As Attorney General in California, I went after companies that illegally increased prices, including wholesalers that inflated the price of prescription medication, and companies that conspired with competitors to keep prices of electronics high. I won more than $1 billion for consumers. So believe me, as president, I will go after the bad actors. And I will work to pass the first ever federal ban on price gauging on food. My plan will include new penalties for opportunistic companies that exploit crises and break the rules, and we will support smaller food businesses that are trying to play by the rules and get ahead. We will help the food industry become more competitive, because I believe competition is the lifeblood of our economy. More competition means lower prices for you and your families. Now compare what Donald Trump plans to do. He wants to impose what is, in effect, a national sales tax on everyday products and basic necessities that we import from other countries. That will devastate Americans. It will mean higher prices on just about every one of your daily needs. A Trump tax on gas, a Trump tax on food, a Trump tax on clothing, a Trump tax on over-the-counter medication. And you know, economists have done the math. Donald Trump's plan would cost a typical family $3,900 a year. At this moment, when everyday prices are too high, he will make them even higher. As president, I'll take on the issue of the cost of health care. As Attorney General, I took on insurance companies and Big Pharma and got them to lower their prices. And together with President Biden, we've gone even further. We capped the price of insulin at $35 a month, and the total cost of prescription drugs at $2,000 a year for seniors. We let Medicare negotiate lower drug prices for seniors. And just yesterday, we announced that we are lowering the price by up to 80% for 10 more life-saving drugs. And I pledge to continue this progress. I'll lower the cost of insulin and prescription drugs for everyone with your support, not only our seniors. And demand transparency from the middlemen who operate between Big Pharma and the insurance companies who use opaque practices to raise your drug prices and profit off your need for medicine. 2 months ago, I announced that medical debt will no longer be used against your credit score. And I will work as president with states like here in North Carolina, Roy Cooper, thank you again, to cancel medical debt for more and more, millions more Americans. As for Donald Trump, well, he wants to repeal the Affordable Care Act, which 45 million
Brent crude futures settle at $79.68 a barrel. That's down $1.36 or 1.68%.
That would take us back to a time when insurance companies could deny people with pre-existing conditions. We all remember what that was. And we're not going back. We're not going back. We're not going back. And remember, and this is why we're not going back, because we do remember, he tried to cut Medicare every year he was president, threatening a program that tens of millions of seniors count on. And according to his Project 2025 agenda, he intends to undo our work to bring down prescription drugs, the cost of prescription drugs, and insulin costs. Well, we've come too far to let that happen. So we're not going back on that, and let's talk about the cost of housing. So now, the housing market can be complicated, but look, I'm not new to this issue. As State Attorney General, I drafted and helped pass a homeowner Bill of Rights, one of the first in America. And during the foreclosure crisis, I took on the big banks for predatory lending with many of my colleagues, including Roy Cooper, and won $20 billion for California families when I was Attorney General. So I know how to fight for people who are being exploited in the housing market. And I know what home ownership means. It's more than a financial transaction. It's so much more than that. It's more than a house. Home ownership and what that means, it's a symbol of the pride that comes with hard work. It's financial security. It represents what you will be able to do for your children.
All right, everybody, you are listening to Vice President Kamala Harris. She is there on the campaign trail in Raleigh, North Carolina, really laying out some of her vision when it comes to the U.S. economy and specific initiatives that she will do. Cost of food, health care, home ownership. As expected, widely expected and reported out by our Bloomberg News team, it's these kitchen table issues in terms of reaching out to middle America specifically. That is her focus. And she talked about, creating this opportunity economy. She did point out, though, for weeks to come, I will address in greater deal plans to build out that opportunity economy. As we often say, the devil is in the details. Let's see what our Joe Matthew has to say. He's the co-host of Bloomberg Balance of Power, and we find him in D.C. Joe, come on in on this. I assume you are listening as well. Any surprises, any thoughts in terms of what we've gotten so far? I feel like we want still a little bit more in terms of specifics.
Yeah, well, I think your use of the term vision is appropriate here. We got a few details, but this is pretty broad strokes today, and she went out of her way. You know, they've been billing this as the big economic proposal, a big policy speech here, and she made clear that she's going to be adding more details to this as time goes on for something that she calls the opportunity economy. We did get some details, though, you're right, specific to food. That was really more what this was about, just a day after Donald Trump appeared with half a grocery store worth of groceries surrounding him outside Bedminster yesterday. She's calling for the first federal ban on price gouging on food. If there's any real news that came out of this, that's it. And a lot of the folks that we have talked with have made clear that that would be very difficult for her if she is elected president, very difficult to achieve without a full sweep. You would need the House and the Senate to approve a plan like that. But interesting to see her talking about this, talking about a loaf of bread, ground beef up 50%. You guys remember 1992? You're not old enough to remember George H.W. Bush asked about the price of a gallon of milk, and he didn't know what a scanner was at the grocery store either. So I guess our politicians have come a bit of a way since then.
That's because we're all checking out our own groceries. Of course we know. Come on in, Jeff.
Well, also, she was talking about taking on the cost of health care here. How could she address that in the next few weeks with her agenda that could roll out soon?
Well, I think it's more about the fact that she would preserve and enhance what we all know as Obamacare, the Affordable Care Act. You heard the boos in the room there when she talked about Donald Trump trying to knock it down. There's one thing I want to point out here that might have sounded new or strange to some of our viewers and listeners before I get all the angry tweets on this. She was talking about a national sales tax that Donald Trump is proposing. And of course, he's not in those words. I'm assuming that she is referring to the 10% or 20% across the board tariffs that he has floated, because Joe Biden also referred to that as a national sales tax. There's also this fair tax debate in Washington, replacing the income tax with a sales tax. That's something that Kevin McCarthy proposed. Donald Trump had made some remarks about it, that he was maybe open to the idea a couple of years back. Ron DeSantis used to criticize him for that, but we haven't seen any real proposal from the campaign to that extent. So just trying to cut through the rhetoric a little bit there. I think that's what she was referring to.
Yeah, I think so too. I came across a little odd, but I was thinking the same thing. Hey, Joe, I do wonder in terms of voters, what matters? Do they want the specificity of understanding, okay, this is what a candidate's going to do, or is it smarter for a candidate to be much more broader in terms of its approach?
Yeah. I think there's a lot to be said. I know where you're going here. The more details you add, the more that they could become a liability on the trail. And, you know, that's been the knock on Kamala Harris. I think that details will matter as we get into the debate on the 10th of September when they're actually contrasting their plans. But look, this is celebration time in Chicago. She's going to the convention next week, and I would get ready for a lot more soaring rhetoric than details when it comes to the economy.
You're looking forward to next week?
Our bags are packed. I'll tell you what, it's going to be interesting. These events are always a big deal for anybody. The Super Bowl of politics is into this stuff, but we're also talking about tens of thousands of protesters in Chicago. You guys hear all the references to 1968. We're going to go there in person and find out ourselves, and we'll, of course, let you know how it's going.
And following it all. Joe, as always, so appreciate it. Safe trip, and looking forward to your coverage next week. That is, of course, the co-host of Balance of Power, Joe Matthew, with Kelly Lyons. Catch them at 6 p.m. Wall Street time, 5 p.m. Wall Street time, forgive me, right here on Bloomberg Radio and Bloomberg TV. All right, Joe, there in D.C. We're going to continue to track Kamala Harris on the campaign trail, bring you any headlines that are certainly pertinent to the Bloomberg audience. Having said that, as we head to a break, you've got stocks rallying, folks. We are looking for perhaps the best week of 2024 when it comes to U.S. equities. Right now, the S&P 500 just up about 10 points, up 0.2%. Little changes. NASDAQ 100 just up about 19 points, and the Dow Jones Industrial Average up more than 100, but again, small on a fraction basis.
Liquidity is the lifeblood of an airline. We make very conservative decision making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well, because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. MasterCard is cutting 3% of staff worldwide. This according to a spokesperson for the payments network. That would work out to about 1,000 people based on its reported employee count at the end of last year. MasterCard shares little change right now, up less than 0.1%. Maravai Life Sciences Holdings shares soaring after a report that the company received a takeover offer from Repligen Corp. Maravai shares, they're up 21% after Reuters first reported the approach. Maravai does research, development, and manufacturing for drug makers. Repligen focuses on manufacturing biological drugs. Rivian Automotive has paused production of the electric commercial van that it makes for Amazon. The reason? A parts shortage in the latest supply chain snafu for the EV maker. Rivian said the temporary stoppage began earlier this month at its factory in Normal, Illinois. The EV maker declined to specify which components are in short supply, but said it expects to recover all missed production, although it did not provide a timeline. Rivian shares down by 4.4%. After earnings, Applied Materials down 1.9%. It did deliver an inline sales forecast that disappointed investors who've been looking for a bigger payoff from artificial intelligence spending. Texas Instruments is set to receive $1.6 billion in CHIPS Act grants and $3 billion in loans. That word from the Biden administration. It marks the latest major award from a program that is designed to boost American semiconductor manufacturing. Shares of Texas Instruments today, TI is moving lower, down now by 1%. And those are our top company stories at this hour. I'm Charlie Pellet, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio and Television.
All right, everybody, this is Bloomberg Business Week. Go figure, the stock market on track for its best week in 2024. Great backdrop for today's Options Insight with Bloomberg News Chief Markets Correspondent Abigail Doolittle and her special guest. Abigail, all yours.
Thanks so much, Carol. And joining me today for Options Insight, I'm very pleased to say, is Spencer Hakimian, the Principal Officer, Investment Officer, CEO of Tulu Capital Management. Great to have you with us, as always, Spencer. The last time you joined us, you had a very prescient call on gold, and I know that you did well with your options trade. And now you're taking a look more at rates. You know, I was just pulling up a chart of the 2-year yield. Really of interest to me right now is the yen and the unwind of the carry trade. I think that there could be more to go looking at this chart. But what stands out is that 2-year yield basically went from 5% to 4% over just the last couple of months. And we did actually see for the better half of that, or a good portion of that, the yen strengthen. How are you thinking about rates first? And then we can talk about the yen.
So I may actually be a little bit contrarian on this, but at the beginning of August, we had that soft payrolls report, and then we had the unwinding of the yen carry trade. A lot of people were stopped out of trades, and it led to just a global flight of safety. And at our peak last week, we were pricing in 8 rate cuts over the next 7 FOMC meetings. And just to put that number into a little bit of context, even at the depths of 2008, we never priced in 8 rate cuts over 7 meetings. And I just think, given the deficit spending that we are seeing, tech CapEx guidance was pretty strong for 2025. And even this week alone, mortgage refinance activity picked up pretty strongly on that drop in bond yields. I just don't think we're going to end up getting 8 rate cuts materialize over the next 7 meetings. I don't think it'll be necessary. And in light of all of that, we bought a put option against June 2025 SOFR, which again is pricing in 8 rate cuts. Now, if we even just get 4 or 5 or even 6 rate cuts, given how cheap that put option was to buy last week, and given how far out the duration is on the option, it's a pretty material payout if it was to just be a little bit less than what the market is expecting.
Well, based on what you did with the gold option that you bought, it seems as though you have an opportunity perhaps to make money here too. It's interesting what you're bringing up about that Haven play though, because in terms of that 2-year yield making its move, just to return to that benchmark yield, from the beginning of July, it had been closer to 480, then all the way down below 4. That of course means bonds are rallying, a flight to safety as you're talking about. And then that's when the yen started rallying. So even earlier, basically from July on, but especially that August part that you were talking about, this flight to safety, technically, just from a chart perspective, it looks like it's going to continue. Are you seeing any other signs of that the yen carry trade, that unwind, that there is more to go?
Well, there should be a little bit more to go. I don't think it is fully done because, look, the yen is in the mid 140s, and a few years back it was in the 110s. I think what could cause it to weaken further is if you get a comment from a deputy governor like you got last week, or even if the governor of the BOJ were to say something. If they don't want to raise rates, people are going to continue shorting the yen. It doesn't cost anything to short it. Virtually costs nothing. And you can go and buy things like the Aussie, you can buy the Mexican peso, you could go buy US 2-year yields. So unless the BOJ is going to be forceful in a way not allowing people to short it, it will continue to be shorted. And I think we've seen that since the comment was made a few days ago. The yen weakened and everything else started rallying again. Risk assets like Bitcoin, tech, anything. Anything involving risk just seemed to went up.
Yeah, it's going to be interesting to see whether or not that continues. I know the BOJ will be speaking next week. Spencer Haikimian of Toulouse Capital Management, thanks so much for joining.
The countdown is on. Everything you need to get the edge at the end of the market day. This is the close.
Sell-off? What sell-off? Stocks edging this rally out for its 7th straight day. From Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. I really wish I would have taken a week off because you know what? Nothing would have changed.
Yeah, it's like the whole Rip Van Winkle. If you were asleep for 5 days, well, nothing really changed.
Exactly.
Yeah.
And this just kind of shows where we are. This is a 5-day dip of the S&P, a 5-day chart. It's really unremarkable, except the fact that it is remarkable. So it didn't really go anywhere. We're up by about 4%, but it is the best weekly gain that we've seen since November. Same thing for NASDAQ 100 and the same thing for the NASDAQ. Just a stark cry from where we started just 5 days ago.
And I think it's even better than that, Alex, because really for all the drama that we saw this week, get this, stocks here in the U.S. and globally are ending it unbowed, heading for what will be their strongest weekly performance since at least November of 2023. The S&P 500 now sitting just about 100 points away from its record high, recouping all of its losses from that massive 6% drawdown that rattled folks to start the month. Now, the economic data was a big spark for that turnaround, but there is still that push-pull here between the bad data and the good. Those forces on display with yesterday's strong retail sales report, counterpointed today by an absolutely awful plunge in new home construction to the lowest level since 2020.
as we've seen on a day like today, where you've got weaker housing data versus yesterday, where we had stronger retail sales data, is we are still dealing with cross currents in the economy. This is not a straight line in either direction. And when we start to cheer that, okay, the news is Goldilocks, like, you kind of get hit with something in the opposite direction.
Well, if we want to go back to the good news, one big upside today is that U.S. consumer sentiment is up, rising in early August for the first time in 5 months. Optimism about finances, and get this, more optimism about the state of politics, because Joe Biden dropped out of the presidential race. His replacement, Vice President Kamala Harris, out on the campaign trail today, making a detailed pitch on how she would shepherd this economy, a pitch that includes sweeping new federal subsidies for parents, price controls for rental homes, as well as pharmacy drugs. Alex.
Yep, we will get to that throughout the next 2 hours as well. So here's another way of looking at this really solid week that we've had. Now, we mentioned it, right? The S&P up the most since November of 2023. There's another way to look at it, too, that here is where we had the soft landing Goldilocks scenario, right? Stocks didn't really do that much, just kept hitting record high after record high. This was the hard landing debacle, the hard landing fear that everything was going to be taken out, data, jobs were going to drop, and the Fed was really going to have to step in with that emergency. And now we've just kind of repriced, no longer pricing for disaster. And if we're back to Goldilocks, then how do you play that when there is so much uncertainty over the next couple months remain?
Absolutely. We're going to get to that and talk a lot about the markets today, but we do want to kick off the show with politics. Vice President Kamala Harris out in North Carolina today, pitching to the public her economic policies should she be elected president. Joe Matthew joining us right now, the co-host of Balance of Power. And I know a lot of details, Joe, about this plan, but not because I heard it from her mouth. It's mainly because of the reporting that our reporters here at Bloomberg have done. When she got on the stage a little bit earlier today, did she actually detail what she was going to do?
We got to some of it. You might think of it as kind of an appetizer here, Romaine, because one of the first things Kamala Harris said is that she would have more details on her so-called opportunity economy over the coming weeks. So this is the first salvo, and it comes ahead of the convention next week. Some of it we had told you about, including her attempt here to create the first national ban, a federal ban on price gouging. Today had a lot more to do with cost of living, the price of groceries, coming just a day after Donald Trump was out there with the big grocery store on display in Bedminster. She is offering a couple of specifics on housing, though, Romaine. I'm guessing there was a big family dinner for the campaign staff, because that sausage was thawing out in the sun all day. Imagine this. Down payment support for up to 1 million, maybe even more first-time homebuyers of $25,000 each. She did detail that today. We expected her to say it. And on this day, as you just pointed out, we find out home construction is at its COVID lows right now. You wonder if this would do anything to unlock the market. The problem with a lot of these, though, pay-fors, how do we pay for it? And will you need a Democratic House and Senate to get them passed? That will be the case for a federal ban on gouging.
I mean, before we even get to that, let's talk about the deficit. It's going to be hard for institutions to have already scored this, but we did get some leaks as to what it would look like. What kind of deficit expansion will we be looking at under these policies?
I'm not sure what numbers you're looking at here, but I don't think we have enough details for a real CBO score on this. You can take them one by one, though, and I'll point out removing taxes on tips. This is something that Kamala Harris echoed from the Trump campaign that he's proposing. The group, Taxpayers for Common Sense here, the Committee for a Responsible Federal Budget, rather, said that would create almost $200 billion in deficit spending. Neither campaign has talked again about how they're going to pay for it, other than, in the case of Kamala Harris, a tax on the wealthy. In the case of Donald Trump, he says we'll simply grow out of that. Both of these could be inflationary if they're not paid for, and there's a lot more where these came from.
All right, Joe Matthew, co-host of Balance of Power, all over all things politics here. In the politics today, of course, firmly focused on economics, and the market is too. Sinead Colton-Grant, Chief Investment Officer at BNY Wealth, joining us right now here as we kick you off to the close here. And Sinead, this was kind of that week where I think the macro really did dominate for a lot of folks, but I'm not sure exactly what it told us, because you had reports today, like on construction spending, showing that awful. You had a retail sales number that I thought was good. And then you had some CPI and inflation data that seemed to suggest that we are still on a disinflationary trend. Is this a good place that we're in right now?
It's certainly a better place than we were in 2 weeks ago. So here's what I think we need to focus on. Absolutely macro matters. The key question is, how much does the Fed cut in September? We know that the economy is not behaving in a completely uniform way. There are pockets of weakness. But here's what we do know now. The consumer is still in a pretty good spot, and it's looking as though that payroll number that we saw a very strong reaction to 2 weeks ago may be more of an aberration given what we've seen since.
What's the investment thesis now, knowing what we know?
Well, look, we're going to get rate cuts. We think we see between 75 and 100 basis points from the Fed by the end of the year. They're obviously not the first central bank to start cutting rates. But the big question is, do they do 50 in September? The stronger data we see, the more likely that it's 25. They're absolutely going to start cutting rates because given what's happened with inflation since rates have peaked, we've got much tighter monetary policy. Our concern is that a 50 basis point move in September could signal to market participants that maybe there's more going on here than they're seeing, that the underlying economy the Fed is viewing as weaker.
We were talking to Seth Carpenter yesterday over at Morgan Stanley that we were pricing out disaster. Like, that's what we've done in this week. If we priced out disaster, should we price back in Goldilocks? And if we do, where do we do that?
It's a really interesting question. And so, look, I think the very strong reaction from 2 weeks ago tells you where the market views risk. And I don't think that's completely gone away because there's a portion of the market that just can't quite believe that we're going to manage to pull off a soft landing. And where we are very constructive is on equities. We think for the full year, S&P earnings are between 245 and 255 and moving up from there in 2025. But we do think that the economy is ready for rate cuts.
Okay, so that's by the dip where? Small caps, cyclicals, industrials, tech?
A couple of areas. So first of all, you have to be brave when it comes to buying the dip. So we can look back in hindsight now and say, over the last 10 days, it was a great time to add to positions. We do think it makes sense to broaden exposure from here. Maybe you have a little bit of a nibble at small cap. I don't think you go completely back in because there are some potential headwinds if we do see a little slowing in the economy. But you want to see the rally broaden and not just be so tech focused, even though we do like the tech sector.
I am curious about what's going on outside of the U.S. I mean, obviously, you know, we're doing great, at least if you believe all the numbers. And I'm talking both in terms of the economy and the market. But we've also seen some rallies start sort of bubble up in Europe, even Asia this week. I mean, we've seen China actually rebound nicely over the past 2 weeks here. Is there an investment case for investing outside the U.S. at the expense of whatever positions you have here?
That's a really interesting question, and I think that what we're looking at here is the momentum. You know, you think about how some of those markets have behaved over the first 8 months of the year. China has had a terrible first 8 months, so let's remember that we're seeing a rally from a very low base. Certain markets in Europe start to look more attractive. The central banks there are ahead in terms of cutting rates. You look at the Bank of England, there's an expectation that we're going to see more rate cuts there. But look, you want to make sure that it's always got the right policies to support growth. And that's the key for the US, where we've seen a much more robust economy. We've seen much more supportive policies for corporates, and that's why we've seen the stronger equity market performance. So all told, despite where we are today, we still think the US represents better value than international or EM.
All right, Sinead, always a great conversation. Have a wonderful weekend. Sinead Colton-Grant, Chief Investment Officer at BNY Wealth. As we kick you off to the close, we do have some breaking news involving Disney, Fox, and Warner Brothers Discovery, and Fubo TV. Those shares higher by about 20% here after a judge has now blocked Fox, Warner Brothers, and Walt Disney from launching that sports tie-up that they had announced just a couple of months ago. Remember, this was going to be a mashup of their streaming sports services. It was immediately challenged not only by Fubo, but by some other streamers as well. A judge, at least for right now, issuing a preliminary injunction that is going to block that service here, I guess, as they sort through the lawsuit. We'll get you some more details on that and get back to the markets when we come back after the break. This is The Close on Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money. If I had invested with you, which I wish I had, what kind of rate of return would I have had over that 10-year period of time?
Over 100% a year on average. On average.
100% a year, that's pretty unusual.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Next week, Bloomberg is live at the Jackson Hole Economic Symposium, bringing you news and interviews with Fed leaders and other economic experts. Tune in for continuing coverage leading up to a special episode of Surveillance August 23rd at 9 a.m.
Conceivably, there can be points in the business cycle where you might want to say the 12-month forward probability is less than 15%. I'd be reluctant, though, given the political uncertainty and the uncertainty around economic policy, to go significantly below 15%.
That was Jan Hatzius, chief economist, global economist over at Goldman Sachs, weighing in on the odds of a U.S. recession. Well, joining us now is Neela Richardson, chief economist at ADP. She joins us now as well. Hey, Neela, what do you think? We have so much uncertainty ahead of us, whether it's with the election or with rate cuts from the Fed or even with earnings. How does the economy play out in the next 6 months?
Hi, Alex. Well, let's just recap the week, shall we? I mean, what we see is the inflation print has come down. We finally have a 2-nut handle on headline CPI. We go down to jobless claims. They're now lower than they were a few weeks ago. And then finally, we hit the retail sales number, and we find that the consumer is still resilient. So if I just look at the data this week, I'm looking at some numbers, a lineup that's really strong heading into this third quarter. And I think that's where the economy is heading. Despite fears of a recession, the U.S. consumer continues to be strong, and the U.S. labor market continues to be solid.
So does that mean that we've kind of rewind from a disaster and a hard landing, and now we're back to soft, back to Goldilocks?
The narrative around soft versus hard has, gone from extremes. And I think it's that uncertainty question that you've just raised, because no one really knows what normal is. We know that we are slowing and cooling from something to something, but no one knows what we're slowing and cooling to. We only know what was happening before the pandemic and during the recovery. And absolutely, there is a slowdown from that high hiring rate of the recovery period when consumers wanted to get out of the house and they were spending like crazy. We're no longer there, but what we are seeing is something very much like 2019. And so what we're going into is a very moderate, meh economy. It's not high, it's not low, it's just kind of middling right now. And that might continue through the end of the year.
I mean, and so Neela, though, for the purposes of a lot of investors, I mean, and they look at this economy, they see the cracks, but they also look at financial conditions, and they say, at least in their view, that financial conditions are still easy, the liquidity is still there, the money's still flowing, and at least from a financial aspect of the economy, all things should be good to go, are they?
Yeah, they are. And I know that's a hard answer to accept right now, because what we're seeing is also interest rates at 2-decade highs. And we're seeing a housing market that is pretty much on standstill because of interest rates, yes, but because of low inventory. In my view, the Fed doesn't really have a labor market problem right now. They have a housing problem. And that's what you saw. That was one of the things in the CPI I was particularly attuned to, that those month-over-month shelter costs went up again. And housing is something you can't discount, because it's going to be so critically important to inflation and to how much discretionary income consumers actually actually have to spend, and we haven't solved that yet.
And
so there is weakness there if you look for it. The headline numbers look good, but obviously no economy is perfect.
But on the housing front, though, I mean, how much control does the Fed have over that? I mean, certainly they don't have a whole lot on the rental side. Obviously on purchases, obviously a drop in interest rates would help things to a certain extent here. But I'm sure you saw the home building numbers this morning for new home starts. And of course, when you look at some of the past data that we've gotten with regards to other sort of metrics like building permits, et cetera, here, they're not moving in the right direction.
That's right. Well, I would argue that the Fed doesn't have a lot of control either on the housing market or the labor economy. They can't force small firms to hire. What gets a small firm to hire is having that demand there. And so in some sense, the real economy is a challenge for the Fed right now if they want to move the needle in terms of growth. The housing market is in particularly concerning because it's been in a decade-long inventory shortage. And even the inventory that we've seen is inventory.
Looks like we have an issue there.
I think we have some issues with Neela's feed there, Alex. I don't know exactly how she was going to finish that thought, but she seems a lot more optimistic than maybe some of the other folks we've had on. And I guess, again, this gets to this whole idea of a lot of these data points being a bit of a Rorschach test, right? I mean, some of these numbers are good. You dig a little bit deeper, you can find bad if you want to.
And with the starts, that could also be, Hurricane Beryl in the south was impacted. So you have to take all those factors in as well. But it's a supply problem, right? It's not a demand problem. So how does the Fed help that point?
Yeah, absolutely. Here, of course, we do get some more economic data next week, but we're really going to have to wait until September. The next, of course, employment report, and then, of course, the big Fed meeting in mid-September. In the meantime, we want to keep things rolling here with an eye on the markets and get right to our top calls, where we take a look at some of the big movers on the back of analyst recommendations. And we start off with Lumen Technologies, chopped down to underweight today over at Wells Fargo, with the firm uneasy about a continuing decline in legacy revenue and limited free cash flow growth. Lumen did recently announce $5 billion of hyperscale AI fiber deals, but the analyst admits that might not be enough to move the needle. The shares, though, nevertheless, actually going up for a 6th straight week. Next in line, let's take a look at Bumble. TD Cowen falling out of love with Bumble, downgrading the stock to hold from buy, viewing the dating app's near-term growth opportunity as uncertain, given some of the gradually worsening user trends. A price target going from a street high $22 all the way down to $7.50 here. Nevertheless, the share is getting a modest bid on the day, up by about 2%. And finally, let's take a look at Fox Corp, scoring a touchdown over at Wells Fargo with a double upgrade to overweight all the way from underweight. The analysts bullish on the stock's potential, noting that the sports streaming segment is more of an opportunity than a risk. The price target there set at $46. The shares moving higher on the day by about 1%. And we should just add a little bit of an asterisk to that. We did have some breaking news just a few minutes ago here that big tie-up between Fox, Warner Brothers, and Disney for that new sports streaming service now being blocked by a judge because of some legal challenges by Fubo TV and some other streaming players. We do want to stay in the sell side space and keep things moving along with another double upgrade. And this time it's on Nike. Williams Trading lifting its rating to buy, saying that Tom Petty's return to the company as head of U.S. wholesale indicates a return of the swoosh. Sam Poser, senior equity analyst covering footwear and apparel at Williams. He joins us right now. All right, Sam, I mean, I think a lot of people were excited to see his name crop up. How much can he really do here?
Well, I think it's indicative of sort of an evolution and sort of an increase of the, for lack of a better term, mojo at the company. And while I don't anticipate that, sales are going to inflect anytime soon, I do think that this is indicative of just sort of a better way of looking at the business, and having, given his, from what I understand, relationships and knowledge of the U.S. wholesale marketplace, to really get in there and dig in and better understand what these guys are doing.
I am curious about this push. So when his name first popped, everyone said this was going to be the push, where that big push that they made into DTC, that maybe they moderate that a little bit, repair their relationships with wholesalers. And I bring that up because we got some earnings out of On Holdings and some of their other competitors that are now actually doing the exact opposite. They're basically saying they want a bigger direct-to-consumer presence here. Is Nike moving in the right direction by re-embracing the wholesale side of this?
Nike. I honestly, what happened was with Nike, when they shifted to such a aggressive direct to consumer market, they basically didn't stop paying as much attention to their wholesale customers. Not only the wholesale customers that, of course, they got rid of, but the wholesale customers that were still there. So now they'll have to redecide how they're going to, reapproach maybe some of the wholesale accounts that they dropped. But I think the bigger issue is the wholesale accounts that are still around. They really didn't prioritize that. They got rid of a lot of support mechanisms for them, and with Tom Petty coming back, that seems to be indicative that that's changing, because it didn't need to be let's go do wholesale or let's do direct to consumer and then drop the ball on wholesale. They didn't have to be mutually exclusive.
Mm-hmm.
You could increase your DTC business and continue your support of your wholesale accounts. That was the decision that was wrong back at the time.
So I'm looking at the stock. Yes, it's gotten beaten up, but it's had quite a run. It's been up for 9 days. We haven't seen that kind of streak since February of 2016. Just in the short run, are we a little overdone on the stock, or do you think there's a little bit more upside just in the short term?
I mean, I'm going to answer it this way. If you read my note, I said very clearly that this is in for the long haul here, because as things evolve to get the product right, to get it in the right places, and so on and so forth, that's going to take a good amount of time. And they're pulling back on core product right now, be it the Air Force One, the Dunks, the Jordan 1s. They're pulling back on that fairly aggressively, and they don't have a lot of big new ideas that can really drive the boat just yet. And that takes time, and it has to be done in a very measured, brand-centric way, which, again, going back to Tom coming back, I think is, he grew up at Nike that way, and I think he didn't think that was about to evolve that way. He wouldn't have come back.
The area of just, women's athletic gear, if we just take that slice, is super fragmented. How do you think that Nike can differentiate within that fragmentation? Just taking a look at that.
You're talking about from a product perspective, or a
product to then increase sales?
How do I describe this? I mean, remember that the product never is good enough. And if you think about a brand, I mean, I'm not talking about Nike, but let's talk about UGG back in 2005, everybody thought it was a fad. Their business went crazy. In 2011, they raised prices. They overdistributed the product. It went down. And it took them a while to get it back, and they got it back because they changed the strategy. I think that, of course, you have to have good product, but you also have to bring it to the consumer, men, women, doesn't matter, in a way that captures their imagination and says to them, I understand you. In sports, I'm going to make you better. Or we're going to do this that no other brand can do for you, and then have the product that they have support that idea. Because we've seen lots of great product that fails because it's been, mismanaged. And we've seen some good product. We've seen bad product, or product that I personally didn't like at all, do much better than I anticipated because it was well managed. And right now we're in the bad managed part of it.
Right.
And that's the evolution. It doesn't matter if it's men's, women's, kids. It just doesn't matter.
Yeah.
All right, fair point. Hey, Sam, we appreciate it. Sam Poser over at Williams Trading joining us there. I'm still just struck on, how much some of these guys like On Holding, for example, have gained so much popularity and market share in such a short amount of time.
Yeah, well, I think it's part of it's great marketing, right? And I mean, I think, look, I say this as somebody who's a big Nike fan and primarily, but they've lost a step. I mean, it's just not the same. And you can see it in the way they market to you, the emails you get, the styles are just kind of the same old, same old. I mean, it's not exciting. And, let's face it, this fashion is about kind of keeping people engaged and excited.
Totally, and sales. Well, for me,
and let's
it's
face it, most people are buying these shoes not to run, and they're buying them for fashion.
Yeah, it's a fair point.
Yeah.
Or they're buying it to rush. Did you see this one? Nike is the official sponsor of the University of Alabama.
Wow.
Starting Sunday, the campus is going to be flooded with brands like Nike, Lululemon, Golden Goose, and Hermes as incoming female freshmen participate in sorority rush, which is basically a massive fashion popularity contest.
So, you know, my one side of my family, they're all from Alabama.
Okay.
They all went to Alabama. So this is like, you know, their time to shine here. I get totally disgusted by this, by the way. I just, like the amount of money they have to spend on this just to be part of this club.
It's bananas. I would never do it. This is Bloomberg.
What are your thoughts on fast fashion? It's been transformative. It gives the masses access to fashion, but there's a cost to it, downside to it.
My first notice is too much waste. I think it's also how I grow up, you know, making your own clothes and making something that's well special and well unique. It's like timeless. And now you see that everybody is looking the same, like wear sweatshirts and wear t-shirts. And for me, it's just like when they wear something that's special, they feel empowered.
Is there a need for fashion to be more mindful of the impact it's having socially, environmentally?
Definitely.
Is it happening enough?
I think it's happening. It's gradually happening. All the designers are doing, everybody is thinking about this subject at this moment, thinking how to be more sustainable, how to be more environmental friendly.
Do you think the fashion industry is doing enough, you know, to ensure that it is sustainable? There's so many targets out there. Are they even realistic in wanting to achieve them?
I think some of them are just like they're using sustainable ideas as a marketing concept only. They're actually not really doing it. I think as a designer, you know, it's really important to really make it happen. Every collection, I think about how to do it and how to tell the customers. I think that is our responsibility to educate our customers.
Billionaire Gautam Adani founded one of India's biggest and most controversial business groups. After being rocked by accusations from short seller Hindenburg Research last year, Adani is now preparing for the company's future in a real-life succession story. Meet the family members he's hand-picked to take over the business as we deep dive into the facts and rumors surrounding the Adani Group. Inside Adani, a Bloomberg exclusive replays all weekend, only on Bloomberg.
Good morning from our world headquarters in New York. I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. So we heard from Vice President Kamala Harris about an hour ago with her economic plan. And one part of it was her housing proposals, either giving first-time home buyers some kind of subsidies, but also tax incentives for home builders.
Yeah, this is interesting. I mean, I don't know exactly how you pay for all this stuff, but there's been a lot of talk on both sides of the campaign here about how you make our housing situation more palatable. So obviously making it more affordable for renters and also making it easier for folks to buy or to build homes here. You know, again, this is something that she doesn't have direct control over. Ultimately, this is something that's going to have to go through Congress, and you're going to need buy-in.
I mean, yeah, that's pretty much for all the economic plans. But the point is, it's also about supply, not necessarily only about demand. So I'm taking a look at the S&P Home Builders Index, slightly higher today. Well, actually, it's down by 0.7%, while the S&P is up by 0.2%. Toll Brothers is coming out next week, so we're looking at that. But one thing that could help the housing market, if you did need the demand push, is lower rates. That could be a boon for other struggling areas like the commercial real estate market. Joining us now for more is Chris Merrill, CEO of Harrison Street Partners, which is big on real estate investing, has more than $55 billion in asset under management. Chris, you say the second half of the year is gearing up to be a very active transaction market. Where and how?
You know, thank you for having me. You know, we think there's going to be active areas around education and healthcare from the real estate market. And so we've been extremely active in focusing around student housing, things in the medical office, senior housing, data centers, self-storage. So it's going to be a very active push towards the end of the year here.
Is that structural, or is any of that going to be dependent on lower rates from the Fed?
You know, the beauty of some of the alternative segments is certainly rate cuts will help. But what we've seen, and as you were just discussing, there is such a supply shortage right now. So when you think of student housing or senior housing, you have such demographic tailwinds. You've got increasing enrollments. You've got the aging population. And supply has just been absolutely choked off. So what you're seeing is solid year-over-year rental rate increases, well in excess and absorbing any of the sort of interest rate increases we've seen.
When you see that, though, I mean, are there geographic differences, Chris? And I'm talking about from an investment opportunity perspective. Yeah. Are there parts of this country where you're going to get more of an upside than others?
You know, so it depends on the asset class. So when you take student housing, you know, the beauty of a student housing strategy focusing on the public universities is you can invest across the country in many major markets. So when you think of student housing, we want to be at the largest public universities across this country that have seen 5-6% enrollment increases. When you think of senior housing, you can go into many markets where obviously the aging population is across the country. So when you think of some of these alternative segments that are demographic focused, you really can be across the country. Much different than asset classes like office and in some cases multifamily, where you really have to think carefully about where is job growth, where are jobs being created to drive that demand.
When we talk about, Chris, this idea of what most people assume is going to be a new interest rate cycle, interest rate easing cycle, excuse me. Obviously, we could potentially have a change in the political tea leaves here in the U.S. as well. There's been a lot of talk here about how the housing market, how the commercial real estate market is going to be affected by this. So whether we get new policies out of Kamala Harris or new ones out of Donald Trump here, does that at all factor into your long-term planning? I know as an investor, you have to think much more longer term than just the next 4 years, but how much does that factor into it?
It factors into it for sure. I mean, when we think about it, you know, trying to focus on resilient asset classes geared towards demographic allows you to ride ups and down in political changes or in the economy. If you have asset classes where demand is consistent through economic cycles, again, it's a stronger, in our opinion, investment thesis. But some of the things that you're hearing, you know, listening to Kamala talk, I mean, some of the things were admirable. I mean, again, if we can reduce red tape, I mean, what's the challenge right now in the housing market is the lack of supply. We've got 4 to 5 million shortage of homes. We need to be embracing developers, working with them on local zoning, local entitlement rule to really help them in this building. So that's really going to be important going forward. Is rate cuts are one piece of it,
right? But
regulatory, how can we form partnerships with developers in local towns, municipalities to really help them, you know, get through that progress, get more density so that we can get more units built.
Chris, going back to commercial real estate for a sec, are there any good deals right now, particularly as we're headed into a potentially lower rate environment?
Absolutely. I mean, there's tremendous opportunities in real estate. And when you think about, like I said, student housing, you know, you're seeing 6 to 8% year-over-year growth. Good university markets are very resilient. Senior housing, look at the demographic wave, the aging population. We're seeing strong opportunities in medical office, life science, self-storage, data center. So there's many asset classes that are almost like social infrastructure, that they're part of really the fabric of our economy. And so For us, those are great opportunities because what you've seen is a huge reduction in capital flows. So from an opportunistic standpoint, it's a great opportunity to be an investor. These next few years are going to be fantastic vintages if you focus on the right asset classes and the right markets.
All right, Chris, gonna have to leave it there. Great stuff. Chris Merrill, he's the CEO over at Harrison Street Partners. A closer look here at what's been going on in the real estate sector, particularly on the commercial side. And you'll always hear investors like him, Alex, always looking for opportunities, and they continue to find it out there, even with rates where they are. And maybe if rates come down, they get a bit of a boost. There was an interesting headline that just crossed the wire. We got the weekly CFTC positioning data. And for the first time since 2021, hedge funds are net long on the yen.
That's really interesting.
And this is a big deal because there was a great couple stories over the last couple weeks about the return of the yen carry trade, which, of course, had the big blow up, what was it, 2 weeks ago or whenever it was here, and how everyone was piling back in, of course, and that, of course, puts value underneath the yen. And now we're seeing that reflected in the data, at least here as far as U.S. hedge funds go.
It is really interesting. And if that continues, does that eventually wind up blowing up yet again? Like, are you borrowing yen to buy NVIDIA? And then if you go long, you got to flip it and sell NVIDIA? Like, is that what we're going to wind up seeing?
That's what I was just wondering. I mean, either this is a really smart trade or people have very, very short-term memories.
Both? I mean, maybe both are true. I mean, I don't know.
All right, recouping almost all of the losses that it had coming from that big blowout here. The latest headline here, U.S. hedge funds now positioned net long on the yen for the first time since 2021. When we come back, we do want to talk about that big sports streaming tie-up between Disney, Warner Brothers, and Fox. It was challenged immediately in court, and now a judge has said that at least for now, that needs to be put on hold. This at the request of Fubo TV. Those shares higher by 21%. It's our stock of the hour, and it's up next. This is The Close on Bloomberg.
On the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that.
Don't miss Bloomberg's interview with the
The names that move markets are on Bloomberg.
Don't expect we're going back to zero, because zero was the product of huge global shocks. I think to get to there, something really bad has to happen that we're not currently expecting. So it'll be somewhere obviously in between. I think we've made a big point of saying policy is currently restrictive, so you can deduce from that it'll be lower than where we are today, but I think it's very clear that we're not going back to zero.
Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything. The top names in tech are on Bloomberg.
AI tools can help democratize storytelling and turn everybody into a creator. Our vision of the future is individual creators will look like Disney. They'll be able to go from an idea to a final story. They'll be able to publish that. They'll be able to merchandise it. They'll be able to do it across the franchises and stories they create.
Nobody covers technology like Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Time now for our stock of the hour. Keeping an eye on shares of Fubo. This is the streaming television company, rising about 20% here. This after we learned that a judge is going to temporarily block Fox, Warner Brothers, and Disney from launching that combined streaming sports service. Bloomberg's Chris Palmieri joining us now for a little bit more. And Chris, maybe you can just set the scene for us as to how we got here, because I know in the past we had Disney and some of these other big cable companies were trying to actually push some folks into these streaming services because of the loss of traditional cable television. Charter was also trying to do the same thing with Fubo. And then you had this whole little sports deal that Fox, Disney, and Warner Brothers Discovery decided to do themselves. Fubo held his hand up and said, why can't we get a piece of this action? Where do we stand today?
Exactly. So, the people are canceling cable. And Fox and Warner Brothers and Disney said, well, why don't we just offer people, cord nevers, a package that just includes sports for the diehard sports fans. And Fubo, which is an online TV provider, said, hey, wait a second, we've been trying to do this for years and you wouldn't let us do it. We have to take 90 channels and charge people $75 a month. You won't sell us the sports. And in fact, one of the things the judge in this decision keyed on was the fact that the big media companies had said, we're not going to let anybody else have these rights for 3 years. So that was her decision, that this was just anti-competitive. And whether this opens the door to these companies now licensing these rights directly, just the sports channels, Disney does have plans to offer an ESPN streaming, Papa ESPN product, because they already have ESPN Plus next year. And so how this all shakes out, we don't know. Presumably the companies will appeal, but it was a 68-page opinion, pretty strongly. The judge said basically she didn't see any real people supporting this product, and a lot of people arguing against it.
Hey, Chris, what do Warner Brothers, Fox, and Disney do now? I know you mentioned appeal, but then what do? If they lose it, what are they left with?
Well, I think the stock reaction to this ruling is telling, and Fubo is way up. The other companies I think they're still up for the day, haven't really moved that much. This is never going to be a huge deal. Fox CEO Lachlan Murdoch said in 5 years they were going to have 5 million subscribers, which is about how many Fox lost last year because of cord cutting. So this was like kind of stemming this erosion, but it was never going to be a huge product. So if they ultimately abandon it, it probably wouldn't have a significant impact.
But is there an issue, though, if this does drag out in the courts or something, does it sort of at all upend whatever economic model they were trying to move to, or is this just kind of deferred, I guess, until they sort all this out?
Well, it's certainly a problem because they won't be able to launch before football season, right? So,
which is like in 2 weeks, right?
Might abandon it all, this season. Again, it was sort of like trying to stem the losses rather than open up some great new business opportunity for them. So it certainly kind of would make sense to just abandon it and try to figure out some other avenue to monetize these sports rights, and that's, really what this is about.
Does this preclude, say, Fox, Disney, Warner Brothers tying up for other things? I was reading an article, I forget where it was, maybe it was in Barron's, that talked about here are 5 things that Warner Brothers could do to help itself. And one of them is partner up more, a la Venue. Now what?
Well, this has really been already the year of bundling. I mean, you can buy, for example, a Disney package that includes Warner Brothers Max service. And already, you can go on Amazon and subscribe to these other streaming services. There's so many avenues, and we're really just beginning to see the start of this. Mm-hmm. I mean, people, whether it's Walmart or Instacart, they're throwing in streaming services. There are just so many deals being cut that don't involve a strict joint venture exclusively for these 3 companies. So we're going to continue to see all kinds of ways of mix and matching streaming because these companies know it's getting really confusing. It's hard. You got to subscribe to all these different services. And the people who subscribe to bundles tend to stay longer than the people who just come in and watch a few seasons and then cancel. So we'll definitely see more cooperation.
All right, Chris, we appreciate it. Chris Palmieri, thanks for jumping on with us. You know what they should do, Romaine? They should bundle up all the kind of apps that I can get. not on cable, on streaming, and then sell that to me.
That is a novel concept.
What?
Wow.
That sounds brilliant, does it not? All right, we're about 15 minutes away from the close of trading on this Friday. You're looking at S&P up 0.1%. Gold, though, at a record high, 25.05. Steve Sosnick, Chief Strategist at Interactive Brokers, will be joining us next. This is The Close on Bloomberg.
Today's CFOs focus on much more than just revenues and margins. Their impact goes far beyond the balance sheet.
The world is coming at us faster than it ever has. Our first job is to intimately understand and anticipate the consumer's needs.
You need to identify opportunities.
It's an incredibly fun job.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. New episode September 11th, only on Bloomberg. Brought to you by Workday.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing
1 minute remaining now for the market on close imbalance.
Capital. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
So we're looking now to the market on close imbalance. S&P 500, 1.1 billion to the sell side. NASDAQ 100, 400 million to the buy side. So S&P 1.1 billion to the sell side. The Dow 30, 480 million to the sell side. Mag 7 stocks, 50 million to the buy side.
You have to be brave when it comes to buying the dip. So we can look back in hindsight now and say, over the last 10 days, it was a great time to add to positions. We do think it makes sense to broaden exposure from here. Maybe you have a little bit of a nibble at small cap. I don't think you go completely back in.
Sinead Colton-Grant, the Chief Investment Officer at BNY Wealth. She kicked us off to the close just about 50 minutes ago, Alex. With green across the screen here, and I think you alluded to this at the top of the show, if you had been asleep for the past 5 sessions here, you would have no idea about all the turmoil we saw in the middle of the week.
Which is also just kind of crazy. I don't know if that's a good thing or a bad thing. We re-rated so quickly. I appreciate we're only up 1/10 remain, but we're still at its best weekly gain so far this year. You have to go all the way back to November to see this kind of rally within the S&P in terms of a streak. Also, Nike having a killer day, as we talked about earlier. You also have NVIDIA doing really well, the kind of winning streak we haven't seen weekly since back in March. I mean, these are risk-on signs.
Not only risk-on, but it was a much broader rally, too, right? I mean, at least on a weekly basis here. So I guess that is the good as everyone still kind of searches for the bad, not finding it, at least for right now. As we move closer to those closing bells with just about 8.5 minutes to go, Steve Soshnick joining us. He's the Chief Strategist over at Interactive Brokers, and he joins us today here in Studio 2. Great to see you.
Great to see you.
Maybe you could just kind of make sense of the last really 2 weeks. I mean, let's just go back to end of July, beginning of August. We had that payrolls report. You had whatever the heck happened with the yen carry trade and a lot of stuff in between there that looked like this market was headed for the toilet, just put it mildly. We've recouped all those losses, where now we have an S&P, not doing much today, but within spitting distance of another record high here. What do you make of it?
Well, a few different things to unpack. I mean, first of all, there was the weakening job numbers, which seems like ages ago. That was literally 2 weeks ago. Then, of course, you had as the yen carry trade blew up, also you had a dispersion trade blew up. You had a lot of people selling index volatility and buying individual stock volatility, which works really well when stocks decorrelate, when you have a narrow leadership. The problem is, as the yen carry trade imploded, people went into VIX as a hedge. That boosted VIX. That blew up the people who were short the VIX against the individual equity options. And poof, you had what we had 2 Mondays ago. Since then, it's sort of, people have decided whatever doesn't kill you makes you stronger. And, the same old playbook worked. People have been sort of conditioned to buy dips, and it does tend to work over time, and it worked really well this time. And we're back sort of playing with the same playbook, the same FOMO-induced, the same FOMO leading the market. And, we find ourselves, and, to me, the most telling thing is VIX is below 15. So it's telling me people have no desire to hedge anymore. Forget it.
Well, that's what I mean. Are you encouraged by that? I mean, to go from whatever the intraday was, 60-something, down to below 15 today, I mean, that's just kind of one extreme to the next. I mean, do we not have any middle grounds left in this market?
Well, one would think there should be, shouldn't we? And that's the issue we're looking at here, is we really don't seem to have a middle ground. We lurch when you lurch from one extreme to another, that's not really a stable situation. Where's the equilibrium in that? And the other thing to keep in mind about VIX is, remember, VIX is really the market's, it's not specifically a fear gauge. I sometimes say it's not a fear gauge, but it plays one on TV. But it basically is, it's really the market's best estimate of volatility over the coming 30 days. And it functions in more or less as institutional demand for hedging. So institutions have no demand for hedging, and people don't see a lot of volatility over the coming 30 days, despite Jackson Hole, despite NVIDIA earnings, and despite what we've just gone through.
Or is the middle ground now gold?
Gold is definitely taken on a shine. That was a terror. I did not intend to say that. But gold has definitely come to shine in this market. In some ways it's the anti-dollar. In some ways it is a bit of a hedge. It's also, if you do believe that rates are coming down, gold is less punishing to own, because the opportunity cost of owning gold is lower. So yes, and anecdotally, since I have no real insight into what they're doing, anecdotally I've heard all kinds of stories about stockpiling in China and India and other places. So you've got the source of demand. All that adds up to a higher gold price.
Yeah, I was wondering if the safety is not in the VIX, or the hedge isn't in the VIX, it's in something different. I'm super curious as to what you see in terms of flows from the CTAs, risk parity, the vol-controlled funds. I was so obsessed with them selling for a while, and I'm wondering if they're now back to buying.
They never stop buying. That's the crazy part, is our customers have been net buyers. They were net buyers the way up. They were net buyers the way down. Really? They're net buyers again on the way back up. They just have an undying faith in the market. It's a little more balanced when I look at option flows. They seem to be more two-sided, so they may be using the options more to trade, but they continue to be net buyers. And it's where you think it is. It's the big cap tech stocks. And why buy Qs if you could buy triple Qs? Why buy stocks if you could buy triple levered stocks? And so we see all that activity going on.
Do you think the carry trade has more unwind to go?
It should, shouldn't it? But it's like everybody put it behind them, and I think the key will be the yen has been helped ever since ever since they basically said the Japanese minister, the Bank of Japan said they're not raising rates. Yeah. It's calmed down quite a bit.
Are you rooting for the carry trade, or are you like a carry trade truther or something?
Yeah, I'm a carry trade truther. I'm just all these things I was obsessed with for like 48 hours. Now it's like, nah, we're done. Don't worry about it.
So look ahead then, Steve. I mean, like, what's kind of like the next big kind of inflection point? I mean, I guess the Fed meeting next month, and I know we get Jackson Hole next week. Do you think Powell would even use Jackson Hole next Friday? I think it's a week from today, right, when he gives his speech. Do you think he would even bother to use that as a platform to articulate where Fed policy?
Absolutely. He did that 2 years ago. Right. Think about 2 years ago. I happened to do some work on this morning. So 2 years ago, everybody was looking for the Fed pivot, which, by the way, 2 years later, we're still looking for the Fed pivot, mind you. And he basically put the kibosh on that. He came out and said, we're not slowing down here. We're going to continue to raise rates. We're going to continue to fight inflation, and we're going to continue to do QT. Now, we've backed off some of the QT. He's given the sort of go ahead to one rate cut. Yeah. But is he going to come out and say, by the way, you're getting both a good economy and 4 rate cuts, despite the fact that nothing in the SEP, the dot plot, implies that? That he can use that if he's uncomfortable about this.
Is he going to have that much confidence, though? Because 2 years ago, and that was that whole mic drop moment, I mean, he had the data to really have that confidence and to be that bold in doing that. When you look at the data we have now, I don't know. I mean, can you be that forceful?
I don't think he's going to be as forceful as he was then, because the data, in that sense, the data was pointing all in one direction. Yeah. Now you do have conflicting data, but he's going to reiterate the data dependence. He's going. I do think there's a real element to the fact of, like, look, you guys have been always so far ahead of us. You've been looking for a pivot 2 years ago. You were looking for 7 rate cuts in January. You're still looking for 4 rate cuts, and we only have 3 meetings left. You guys got to slow your roll a little bit. Is my fear of what he might say. Yeah. And if he says that, the market is not going to particularly enjoy hearing it.
All right. Well, we're definitely going to check back in with you following that speech in 1 week's time. Steve Soshnick, Chief Strategist over at Interactive Brokers, helping us count you down to the close with just about 2 minutes until those bells here. Stocks right now, Alex, hitting session highs.
Yep, by that dip, out of disaster into soft landing. That's what we've now seen.
A wild week here and a full breakdown of all that happened. Coming up right now, this is Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Alex Steele, taking you through the Closing Bell, a global simulcast. And it starts right now, joined by Scarlett Fu in the television studio, Carol Masser in the radio booth, Jess Menton filling in today for Tim Stenovic here on a Friday. Carol Masser, the stocks once again are in the green across the board.
And first of all, Scarlett, I'm so glad you got the memo on wearing red. I'm a little upset with you, Alex, and a little bit upset with you, Romaine. But having said that,
Did you lose our numbers or something? You couldn't just text us?
I don't know. I'm looking at home builders. They're actually higher today, right? Some weak housing data, and nonetheless, we see that move. Some optimism as we head into the weekend, and I feel like what's going to be maybe a big week next week.
That's right. S&P 500 on pace for its best week of the year. Of course, we've been talking all day about that, but when you look from the low that we had earlier this month, the S&P 500's added about $3 trillion in market value, Scarlett.
There is a little bit still of people kind of taking a breather after what we saw this week, but I definitely felt at this start of today's trading day that it wouldn't be surprising if you saw things kind of drift lower into the close because of so many big events next week, whether it's the Fed minutes or Jerome Powell's speech or even the Bank of Japan governor's speech coming up on Thursday night, Friday morning.
Also, guys, volume is really terrible. Yeah. It's like, if you look at S&P volume is like down 21% versus the 10-day moving average. So, like, I mean, let's be honest, there's not a lot of people trading right now.
There was nobody on the subway platform this morning. Nobody.
Yeah. The telltale sign.
Yeah.
All right, well, a lot of big moves here across the market space. Of course, a big week for yields, a big week for the dollar, and of course, a big week for stocks, too. Not quite how I think a lot of people thought this week would shape up, but this is what you have. 5 straight days of gains, 7 straight sessions, really going back to last week. and that continues today. 100 points higher on the Dow Jones Industrial Average, or about 0.2%. A similar percentage gain for the S&P 500, as well as the NASDAQ Composite. And the Russell 2000 is going to finish the day higher by about 6 points, or 0.3%. All the major indices higher on a weekly basis.
All right, back to the S&P 500 I go, and 319 names, guys, in the index posting gains in today's session. 180, Scarlett, to the downside, 4 unchanged.
All right, let's take a look at how the sector performances shake out, because on the face of it, it is a mixed day with modest advances in the S&P 500, in the Dow and the NASDAQ as well. So if we could pull that up, we've been having a little bit of problems. It's been on a bit of a delay.
On technical day.
Okay, we don't have that right now, but